Of a pop overnight, but it is far still from its all-time highs, which it has hit not too long back. It's at 3,345 at the last look that I had. The dollar index, by the way, is shuttling between 99 and 100, and it's not moving above 100. In fact, it's moving closer to 99. So at this juncture, you have cuts of about 8% or more than 8% in the year-to-date for the dollar index. Brent crude has slid just a tad bit, but remains very close to that $65 per barrel mark. What happened in the treasuries? You had US bond yields that fell on the shorter end of the spectrum by as much as 7 basis points. And as a result of that, what has happened in the recent past is that yields on the long end have gone up and the yields on the short end have gone down, as a result of which you had a steepening of the rate curve. Now, what else are we talking about? As I mentioned, the dollar index is down about 9% in 2025. That bodes well for emerging markets, and we've seen that play out. And we'll talk about what is happening with the Indian equity markets very soon. The relief rally that has been pushing risk assets higher globally seems to be fading just a tad bit in the US, and that was what was evident overnight. Uncertainty is leading to consolidation as big earnings in the US are eyed, and economic data is also eyed. Amazon, Apple, Meta, Microsoft are all set to report their earnings this week. 180 of the S&P 500 companies, in fact, are set to report their earnings this week. What's on the cards today? You have Chinese earnings, quite a few heavyweights from there. You have the Bank of China, HSBC, as well as China Construction Bank and ICBC, all that will be reporting numbers. Of course, you're also watching for any information on stimulus. Seemingly, the Politburo and the administration in China have held back on announcing any major stimulus. What has occurred, of course, is the bringing forward of stimulus, and that is seen as positive for the Chinese economy. Now, US consumer confidence will also be out for the month of April, and that's going to be critical to watch as well. So that kind of sets the tone. Of course, by the way, you have the futures in the US market that are trending positive at this juncture. Last I looked at it, in fact, you had the Dow futures that were up as much as 0.2%. The S&P futures are up about 0.33%, and the Nasdaq is up about 0.4% or thereabouts. So at this juncture, it looks like a positive setup for the Indian equity markets. What happened yesterday, though? Right.
So I think yesterday, what markets factor in was the phrase that no news is also good news, and probably the idea of the trade war is being reduced substantially, and that is why probably the markets did bounce back. A rebound was seen after 2 days slump in Nifty as well as Sensex yesterday. In terms of the benchmarks, the Nifty 50 approximately ended 1.2% higher, and there was a significant bounce back seen in both Nifty and Sensex in the last hour of trade. Sensex also jumped around 1.3% and closed, in fact, 1.3% higher. Both Nifty and Sensex snapped their 2-day losing streak. Reliance Industries and BPCL were the top gainers on the Nifty 50. In terms of broader markets, the Nifty Mid Cap 150 did move in lockstep with the benchmarks, closed around 1.4% higher. But and overall, Mid Cap was led by the defense pack. You had your Cochin Shipyard, Bharat Dynamics, Mazagon Dock, all in green, and closed over 6% higher. In terms of the Nifty Small Cap 250, it closed around 0.5% higher. This was led by RBL Bank on the back of its earnings. There was Garden Reach, there was Sonata Software leading the Small Cap 250 gains. In terms of sectoral performance, well, the Nifty Oil and Gas emerged as the top sector of the day. This was led by Reliance Industries as well as BPCL, both seeing significant amount of gains, and of course heavyweights. In terms of the Nifty Oil and Gas, the Nifty Auto, the Nifty FMCG, all three of them snapped their 2-day losing streak. For Nifty PSU banks, private banks as well as financial services, the overall BFSI space, that also snapped its 3-day losing streak. In terms of what happened with respect to FI and DI buying, well, foreign portfolio investors stayed net buyers for 9th straight session. The net buying stood at 2,817 odd crores. For the domestic buyers, they were buyers for the second day in a row after Friday, and DI is bought worth 2,474 crore odd net. That was the net buying number for DI. So this is with respect to how markets fared yesterday, but what is the tone set for today's markets?
Well, I think it's really fascinating if you think about it, right? Because you've spoken about how you saw a bounce from the low point of the day for the benchmark indices. We ended with gains of about 1.2%. Take a look at that intraday chart for the Nifty 50, by the way. And we can follow that up with what happened with the Nifty Bank as well, because the Nifty Bank also ratcheted up, ended at 1.4%, very close to the high point of the day. But if you look at the market breadth overall, the advanced decline ratio was pretty much even Stevens, and if at all, just about shaded in favor of the advances, just about. And this is quite interesting because you saw quite a bit of green on the screen across the board. We just talked about the broader markets also ended positive. So therefore, despite the gains, you had the breadth that was not very strong, and that's certainly something to bear in mind heading into trade today as well. The India VIX gave up just a tad bit yesterday. It ended about 1% lower, but it still remains more or less elevated. So that indicates a little bit of caution. Foreign institutions, as Mahima just pointed out, have had inflows once again, and that seems to also be supporting market sentiment as things stand right now. The inflows at this juncture for the last 8 sessions, which have been tremendous for the Indian equity markets, stand at 32,500 odd crore rupees, and that is quite significant. In fact, yesterday you had both domestic institutions as well as foreign institutions that ended up net buyer. What's the setup for today? Well, it's always difficult to talk about levels. You saw what happened in trade yesterday. You have the Nifty 50 that's currently below that 23,450 mark. I guess that would be one to watch out for on the upside. That has been the case for the last 4 sessions as well. The support seemingly is being seen around that 24,000 mark, and perhaps you'll see the way that the open interest distribution is currently racking up. Puneet will tell you how that looks, and the key levels we'll talk about based on that as well. But seemingly the resistance coming in at 24,550 for the Nifty 50 as well. What about the Bank Nifty? The trend remains strong, but there seems to be a tug of war, as there normally is, but more so now between the buyers and sellers. A key support zone for the Bank Nifty is seen at 54,000 and above that at 54,300 or thereabouts. We are considerably above that at 54,432. It's going to be a busy day on the earnings front as well. Bajaj Finance and Bajaj Finserv will be reporting their numbers. Company that Mahima tracks, Trent, is going to be looking at reporting numbers as well. And the stock, if I'm not mistaken, has been on a bit of a tear recently, as early as this week, if I'm not mistaken. Let's pull up the chart, in fact, and look at yesterday. It ended about 0.2% lower, but if we can pull up the 1 month chart, perhaps. Trent. Okay, so maybe I'm mistaken. So, but there is a bit of a bounce midway through over the course of that 1 month. BPCL also is something you should watch out for, and Ambuja Cements. There are quite a few, in fact, beyond that as well in the financial space that will be reporting numbers. But let's take a look at the derivative picture as things stand right now. I'd be interested to find out about the delivery data as well, Puneet, because you had a couple of heavyweights really swinging for the fences yesterday.
Well, definitely, and we closed above the 24,300 mark. We spoke about it yesterday. That's one of the key levels to watch out for in trade. And if we can maintain that support level going forward, we have a larger support at 24,000, but 24,300 will be one of the other levels to watch out for in trade. Again, today we are seeing an implied open in the green again for the Nifty. Open interest is also inched up. Let's look at the Nifty Bank as well. Another key level to watch out for here was yesterday, which we spoke about, 55,300. Much above that level, we are trading currently at a premium of about 238 points. Let's look at finally, the open interest distribution, because we've seen with calls and puts, the range had narrowed in April, and that's something that's significantly still happening because 24,500 has become essentially the support for the calls now. We've seen maximum open interest there. On the put side, we've seen again an increased spike in interest in terms of the puts at 24,000 level. We had seen some kind of correction yesterday in that level, but the open interest has again inched up at 24,000 for the puts. We've also seen some other out of the money calls also have some inch up, but the 24,500 level remains key. In terms of open interest distribution, gainers and losers, let's look at some stocks now, of which had some long build-up as well as short build-up. Some short build-up seen in L&T Finance. Largely, we've seen that also backed by fundamental factors of what's happening either in Tamil Nadu as well as the company's results. Some long build-up seen in KPIT Tech. A decent set of numbers for the company yesterday. Some more on SRF as well, while some short build-up is seen on JSW Energy. in terms of open interest losers. We've seen some short covering actually on Oracle Finance. Numbers were largely in line on Friday. So another positive one. Apart from that, RBL Bank also sharp 10% up move yesterday on quarter 4 earnings, as well as Tata Technologies also seeing some short coverings, despite seeing some not inline set of numbers essentially. So overall, the key levels of course will be to watch out for is 24,300 as I mentioned, and as you rightly said, Alex, a lot of nifty earnings today to watch out for.
No doubt, no doubt, and certainly the Bajaj pair. Thanks so much, Puneet, for getting us those details. Now, let's talk about a few stocks that we've lined up for you. Of course, we'll take you through the watch list as well, but these are just stocks that we saw based on fundamental developments that we think you should keep on your radar. We looked at the earnings of Adani Green Energy, and this seems to be a very good set of numbers. Take a look at the fine print here. You have the revenue that is up about 22% or thereabouts, 3,073 crore rupees is the number. The EBITDA is up as much as 59.85%. It's quite a considerable gain, and that is on the back of a very significant expansion in the margin in the quarter gone by. The margin is coming at 74.83% versus 64.29% in the comparable quarter. The net profit as a result is up as much as 53% on a year-on-year basis at 230 crore rupees. What has helped with earnings? You have a 37% increase in the power supply revenues to 2,666 crore rupees. The revenue and EBITDA growth has been driven by a capacity addition which is to the tune of 3.3 gigawatts. Now, what is interesting is that the capacity is set to rise even further from 14.2 gigawatts to as much as 15.2 gigawatts with an additional 1 gigawatt near completion. So there's going to be considerable addition to capacity in the near future as well. The second stock on the list is also a thumbs up, and this is PNB Housing Finance, and it's a very strong set of numbers by this housing finance company. Let's take a look at the key numbers here. Net interest income has risen to 728 crore rupees. It's a rise of about 17% on a year-on-year basis. There is a reversal of provisions to the extent of 65 crore rupees, and that has aided the bottom line. You have the PAT that has come in therefore at 550 crore rupees, and that's up as much as 25%. It is marginally, not marginally, well, it is considerably higher than the consensus estimates, more than 5%. So therefore, it is considered a beat on the PAT number. And the NIM, the net interest margin, is a key metric to look at in the context of falling interest rates. Generally, you see a compression in the NIM, but in fact, in the case of PNB Housing, as has been the case for a few other financial companies, you have an expansion of the NIM to the extent of 5 basis points sequentially to 3.75%. As a result of which, that margin expansion has aided the return on assets. That is coming at 2.76%. It's an improvement of 25 basis points on a sequential basis. And I think this is going to be looked at very, very strongly by the street. What else? Asset quality is actually very positive, because take a look at the gross NPA ratio. It's coming at 1.08% compared with 1.19% in the previous quarter. It's an improvement of 11 basis points. And the net NPA number has also improved and come in at 0.69% versus 0.8%, which is also down about 11 basis points. Remember, I mentioned that there is a reversal of provisions, so overall asset quality for this company looks incredibly good. The assets under management, and this has come through in the quarterly update as well, so just a reiteration of that, AUM growth is about 13% on a year-on-year basis and 5% sequentially. Deposits have actually fallen 1% on year, but they've risen about 2% sequentially. All of that bodes well for the company. It seems like this is going to be one of the stocks to watch in trade today. IndusInd Bank, and this is a bit of a tough one because the latest development is that Arun Khurana has resigned as the Deputy Chief Executive Officer with immediate effect. And the reason I say that it's a bit of a tough one is because this bank has been, it has had an overhang, quite a considerable overhang since those discrepancies with regard to derivatives came to light. But then Khurana has said that the recent accounting discrepancies in the bank's derivative business were the trigger for his resignation. In fact, a day earlier, IndusInd Bank had said that an independent investigation had identified key people that are responsible, and that investigation had pointed to a financial hit of 1,960 crore rupees. This is the second major exit after Gobind Jain resigned as Chief Financial Officer in January. And the RBI has also, by the way, and you probably know this because we've been tracking this for you over the course of the last several weeks, it has cut MD and Chief Executive Officer Sumant Katpalia's tenure to March 2026, and the board is set at this juncture to name a suitable successor by October. Of course, that will also have to be ratified and approved by the central bank, and so it's not likely that that will get resolved very quickly. The only reason I say that it's for now a sentimental positive is because the overhang from the management that perhaps investors and the street will look at as culpable, or at least that oversaw this kind of a problem, is going to be making way. That is something that the board clearly stated. That seems to be underway as well. And over the course of the last 1 month, you've had a significant up move by IndusInd Bank in the stock market. It's bounced back, of course, from very low levels. And still, a lot of people have pointed to the fact that valuations are significantly below the long-term average for good reason. So bear in mind that this is a bank that is likely to witness some pressure in the near term. The Q4 numbers are going to reflect the implications of that financial discrepancy, and so Q1, don't expect it to be very positive. They're facing a little bit of trouble on their deposit book as well. So all of that needs to be borne in mind and put alongside this latest development of the Deputy CEO resigning.
Right, absolutely. So those were the stocks that Alex has addressed. Now, 3 stocks on my list. Tata Technologies is the first one. Sources to NDTV Profit have told that American private equity player, that is TPG Rise, is set to sell around 1.58 crore shares. This is roughly 4% of the total equity, and this could be in the price range of 670 to 699 a piece. This suggests a discount of roughly 5% to its yesterday's closing price, and the overall lock-in for the remaining shares will be for the next 60 days. Now, just for viewers' context, Tata Technologies did come out with its earnings on Friday post-markets, where revenue and margins were a miss in terms of estimates, but profit did meet its estimates. The service segment revenue was flat QOQ. Technology solutions segment revenue did see a downtick at around 261 odd crores. The attrition rate came higher at 13.2 versus that of 12.9 and closed around 17 odd deals in FY25. In terms of numbers, revenue was down around 2.4%, net profit was up 12%, EBIT down 1%. Margins came slightly higher at 15.7% versus that of 15.5%, and a total dividend of 8.35 per share was also recommended. But for today, definitely a thumbs down, because around 4% of the equity will be sold if this deal takes place. In terms of the next counter, HG Infra Engineering, well, thumbs up for this one. The arm has received a provisional certificate from NHAI. The order is for around 1123 odd crores, and this is for development of a 6-lane highway. The time period for completion of this particular project will be 730 days. In terms of recent order wins for HG Infra, GUVNL declared the company as a qualified bidder to set up a standalone battery energy storage system as well. In terms of the stock performance, the stock has been under pressure in the past 6 months. 5 days, the stock is down around 7 odd %. 6 months, it's down around 19 odd %, and YTD, the stock is down around 28 odd %. The next one on my list is First Source Solutions. Good set of numbers this quarter. FY25 overall has been a transformational year for this particular company. Growth is led by 2 particular sectors, that is your banking as well as communication, media and technology. They signed 4 new large deals in this particular quarter, and average contract value was up over 60% in FY25. In terms of numbers, revenue was up 3.8%, EBIT was up 13.4%. EBIT margins came at around 11.5% versus that of 10.5%, so 100 basis points uptick there. And net profit was nearly flat at 161 odd crores. In terms of what could move the stock possibly higher is the guidance that the management has given. The management has said that the overall FY25 revenue growth will be between 12 to 15%, and this also includes a 3% inorganic growth contribution. Margins will be in the range of 11.25 to 12% by FY26, and after that they are expecting further improvement of 50 to 75 basis points each year in margins. The management is also confident about mitigating the macro headwinds that lie ahead of the company. Nuvama did come out with a note with respect to where earnings stand. They've retained hold with a target price of 350. They've said that solid Q4 earnings and they believe that First Source Solutions shall sustain both growth as well as margin momentum. However, current valuations leaves a limited upside potential, but definitely a key stock to watch out for in trade today on the back of its earnings. Then definitely for earnings, a thumbs up. Those are the three stocks that are on my radar here. What are you picking up?
So 3 stocks that I'm picking up on earnings. The first one is Oberoi Realty. It's very interesting. Reason being is real estate is where people were putting their bets on recently in spite of that pressure that was coming in. However, if you talk about the overall numbers, there has been a slowdown in terms of collections. The pre-sales is something which has seen a degrowth of around 47%, and this is mainly because there were no new launches with regards to Oberoi Realty during the quarter. Now, the profit uptick, however, which has come in is mainly on the back of that is in the land acquisition cost. Now, overall, if you see what has led to the fall in terms of profit, so 1, the rise in land acquisition cost, 2, the interest cost has gone up, the depreciation has gone up, and to counter this, your other income is also down 74%. So that's one of the stocks that is on my list. That's a thumbs down. Secondly is AWL Agri. Now, they've recorded the highest ever revenue in the 4th quarter. And overall, the volumes for the company have grown by around 8%. The price hike that they had taken during the quarter is what has led to this kind of a revenue growth as well. Apart from that, if you see in terms of their segments, edible oils has seen the biggest growth of 45%. Your industry essentials have also grown in double digit, but it's around 17%. And food and FMCG is on the downer around 9%. So it clearly tells you that, yes, there is a slowdown in terms of consumption as a sector as well. So that's with regards to AWL Agri, a thumbs up coming in there. And very lastly, you have a UCO Bank again, which is a thumbs up because this is mainly on the back of the asset quality improvement that they've seen during the quarter. If you talk about the operating performance, that has been absolutely strong. The credit costs have gone up, but that is coming in on a lower base. And lastly, if you talk about the net interest income, that is up around 23%. Your operating profit is up around 33%. Provisions, a 42% increase at around 663 odd crores. And in terms of the asset quality, net NPA is at 0.5% versus a 0.63%. So an improvement on that front as well. So overall, a thumbs up coming in for a UCO Bank. So whole host of stocks that you should be watching out for. But let's quickly slip into a short break. On the other side, we'll be joined by Kunal Rambia and Sunny Agarwal with their top trading calls and a NDTV Profit deep dive on alkylamines.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
.361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the
Welcome back to India Market Open. Now, after a strong end to the trading day in terms of yesterday's session, you've gone through what the trade setup looks like. Clearly, a 54 points up move is what implied open is indicating. You're looking at Nifty futures at around 24,450 and Gift Nifty at around 24,500. So those are the levels you should be tracking as well in terms of opening trade. But on to NDTV Profit special segment, Deep Dive, where our research team gets you a detailed analysis on a stock idea. Today, that is Alkyl Amines. The chemical maker has lost over 4% in value this week and is trading flat on a year-to-date basis. But what is it? Are valuations matching the business performance? And what is not working for them? Varsha joins us with more. Varsha, over to you.
Thank you for that. So we are basically finding out the reasons and analyzing whether the 52x of valuation given to a chemical company, is it justified? Let's see what is actually not working for the company. What are the challenges that the company is facing? Starting with the declining sales that the company has seen. So the stock in last 1 year is down almost 13%. But let's
head to the operating metrics for the company. We have seen declining sales and profit over the last few years. If you see from FY20 to 9 months FY25, the sales have been declining, and also the profits for the company has also been declining. So this is actually not working for the company. We'll find out the reasons why. But the other highlighting factor is declining volume growth. So there was a time in FY20 when the volume growth was at 17%, which has declined to 10%. So clearly a declining trajectory when it comes to volume growth. Next, let's see, what are the reasons why we are seeing the declining sales, profits and volume growth? One is, the competition and pricing pressure from the Chinese players. We all know that the chemical industry is going through a pressure wherein we are seeing a destocking, lot of supply, dumping which is coming from the Chinese products, which is actually affecting the sales of the chemical companies. Next, if you see, there's been uncertainty when it comes to capacity additions that the China is making, which is actually leading to a high supply base and which is affecting the realization of the end products of the chemical company and hence affecting the revenue. So this is one of the reasons why we are seeing the declining sales of all the chemical companies, including Alkyl Amines. And the raw material prices, lower raw material prices is actually affecting the sales realizations for the company. Next, if you see, the highlighting factor of this deep dive is the margin trajectory. If you see, just in Q3 FY25, the margins for the company were 19%. By FY27, they are expecting 20 to 22% of the margin. But over here, if you see, over the years, the margins have been on the declining trend. Now, in FY25, the margins were 35%. Will Alkyl Amines go back to margins of 35%? No. Management itself says that the margin trajectory that they can see is almost 20 to 22%. Then why were margins high in FY20 and 21? Now, because of the price surge in one of their chemicals, acetonitrile. So, if I were to give a number, acetonitrile price surged from 160 to 180 kg to 279 to 280 per kg. Now imagine the raw material sitting on your balance sheet is at very low price, and the end product that you're selling is at a very high price. Hence, you're seeing the extraordinary margins which all the chemical companies saw in FY21 and 22. So these margins are not going to come back. So this is one of the challenges that the company is facing. Next, if you see, the other challenging factor that the Alkyl Amines is facing, huge capacity expansion by one of their competitors called Balaji Amines. So they are actually coming up with a methyl amine capacity, which is again a chemical used in a pharmaceutical and rubber products. And also Aarti Drugs, which is one of their customers, is coming into the methyl amines. So your customer is becoming your competitor. So these are the few challenges that the company is facing. Next, if you see, not everything is bad about the company. So, some positive things, if I were to talk about, the anti-dumping duty in acetonitrile will actually help the company to regain the market loss that the company has seen. They are targeting 5 to 10% of revenue contribution from the new products. So they are also going into specialty products, which will actually help the margins of 20 to 22%. And lastly, the key question is, despite all these challenges, the company is
the market participants, the investors are giving a valuation of almost 52 PE. If I were to fast forward, basis FY26, the valuation for a chemical company is 36 PE. Now this 36 is back on the 15% growth that the company has seen. If company will not see the 15% growth, which they have not, the valuation will go to almost 40 to 40 P. So imagine a chemical company which is going through all the challenges is garnering a PE of 52x versus Balaji Amines is having a PE of 23x. So lot of challenges are actually facing, and we feel the valuations are at a premium considering the challenges the company is going through.
And thanks so much for that very detailed analysis of everything from the revenue trajectory to the margin trajectory, which has been a little bit of a challenge for the company, and lastly on the valuation. So I'm going to be curious to find out what our experts have to say about NDTV Profit's deep dive into alkyl amines. We're joined this morning by Kunal Rambia, who is the founder of The Street, as well as Sunny Agarwal, who is the head of fundamental equity research at SBI Cap Securities. Since we've just spoken about the fundamentals and the valuations of alkyl amines, let me go first to you, Sunny, and find out what you think about that. Because if you're talking about FY26 price to earnings at 36 times, and which implies a 15% growth, which is not going to take place, then is there a case for a downgrade in those multiples? And what is your own estimation of the value?
Yeah, good morning, Alex. Good morning, everyone. I think, yes, definitely. I think the entire chemical space, especially those particular chemical where we are seeing a dumping from China. So there is a lot of uncertainty on that aspect. So alkyl amine has filed for an anti-dumping duty, which was expected very soon on amines, and that can protect the industry to some extent. But again, in an uncertain environment, I feel that a valuation of 35, any P multiple above 30 times is a tall ask for any chemical company, especially in an uncertain environment. So I feel that there are many other chemical players which are relatively better placed compared to amines. Case in point, SRF, which is a fluorine-based industry. So SRF or Navin Fluorine, they are relatively better placed as compared to the amines at current juncture.
Okay. All right, so that's the view on the chemical space. But let me go across to Kunal as well. Kunal, very good morning. First of all, in case I forgot to mention that, good morning to the both of you, and thanks so much for joining in. Kunal, we saw an interesting day of trade yesterday with an end at the high point, right, or very close to that for the benchmarks, and you had a few heavyweights that were contributing, but incidentally, and we pointed this out, the breadth was not very favorable. If anything, it was even Stevens towards the end. What does that mean for today? Globally, we're seeing a little bit of a cool off of that bounce back kind of a situation.
Morning, Alex. Morning to everyone. It's always great to begin our day with NDTV itself, so no need to wish actually. Coming to Nifty now, Nifty is actually what you say is absolutely true. In fact, the large caps were doing good, and this is what is likely to happen. And this is what we were even discussing even in the past, right? That if the indices are now moving in, it's the time to move to large caps rather than small caps. And we saw Reliance outperforming. I think this rally is likely to continue. We also discussed about Bank Nifty now going into sideways consolidation and Nifty outperforming. And the only sector which can probably contribute is the IT and, those few large caps which have not really performed. So it's advisable to stay with large caps, heavyweight counters, and keep finding buying opportunities till the time Nifty remains above 23,900 to 23,800. I think it can be a buy on dip opportunity. And on the upside, we can expect at least 24,800 to 24,900 as the first target on Nifty.
Kunal, in terms of the Bank Nifty, what are the levels that you are observing for trade today?
Good morning. So yes, in Bank Nifty, we saw the first breakout near to 54,000. Day before yesterday was a retesting, and yesterday again the rally continued. So I think on the upside, we can first expect 56,500 as a level, which is 1,000 points away from the present level. And the selected counters in this entire space can be ICICI, HDFC, and Axis.
Interesting names, 3 stocks which have already run up. Expected to see a further upside from here to aid that 1,000 points rally on a Bank Nifty. Kunal, what would your top picks be apart from the 3 names that you already mentioned with your target price and your stop loss?
So yes, the three counters, two among them are actually small caps and one is large cap. The first is Indian Overseas Bank. Again, this counter has seen a substantial drop and really bounced well from the levels of 33 and a half. Right now it's trading at 38 kind of levels. Considering this up move, I think one can initiate a fresh entry onto this. Stop loss can be 37 and the first target can be 43. The second is JK paper. Again, this counter was beaten down significantly, made bottom near 275, now trading at 330 and 327. And this entire uptick can clearly be seen in terms of higher top, higher bottom. So considering that up move, one can initiate a buy on JK paper. Stop loss can be 320 and the first target can be 360. And the third one is Infosys. Now, this is the counter which we had discussed previous week also. I think this move is likely to continue considering this recent up move. Stop loss can be 1460. One can initiate a fresh entry onto this counter with the target of 1575. And in all three, it is advisable to trail the stop loss rather than booking profits at the target level.
Sunny, I'll come to you on Indigo. Yesterday, BofA came out with a note. Today, HSBC has come out with a note on this particular counter, and both of them are indicating that there might be a little impact of the Pakistan, overall airspace closure. HSBC had said around 4% of total Indigo's capacity will be directly impacted. However, there will be almost negligible impact where it comes to profitability as per HSBC. But BofA has said that it will overall impact around 6% of Indigo's capacity and higher unit cost pressure, but no operational disruptions overall for the particular counter. And long flying distances could probably add 0.3 to 0.6% of Indigo's overall unit cost structure. So first thing, how are you overall reading this? Because this will have a slight impact going in Q1. But Q4 is expected to be a strong quarter for Indigo, considering the entire ticket booking for Mahakumbh as well. So your view on this, this first thing, Pakistan air closure, the idea of Pakistan air closure thing, as well as the overall view of the stock that you have.
Yeah, I think you have rightly pointed out that ultimately there will be some impact because of this closure of Pakistan airspace because the airline has to take a long detour to cater to that area. So to that extent, there can be some increase in cost in terms of unit economics, and at the same time, because of this war-like scenario, obviously a sentiment to some extent travel do get impacted in that particular belt. So yes, I think 3 to 4% impact can definitely be seen. And as you rightly pointed out, the impact will be seen during the first quarter or second quarter of the fiscal year 26. So we don't know till what time this closure will be maintained. So, but Q4 again, we are also expecting a very strong quarter from Indigo. The basis that basically the capacity constraint earlier that was there till the December, that has eased off till in the fourth quarter, and at the same time lower crude oil prices, at the same time buoyant air passenger traffic demand, and wherein Interglobe has maintained their market share of north of 60%. So I feel Q4 should be a good quarter in terms of earning growth. To minor impact can be seen in Q1 and 2, but let's see how much duration for how much duration this restriction lies in terms of closure of Pakistan airspace.
And speaking of the border tensions and the geopolitical situation very close to home, the entire pack of defense stocks was buzzing in trade yesterday, and for obvious reasons, you don't need to spell that out, but everything from a Cochin shipyard to Bharat Dynamics, Mazgon, HAL, the defense index as a whole was up over 4%. But Kunal, the question is whether or not you should play this rally, or do you sit on the sidelines, one, and if you manage to get in perhaps last week, do you take money off the table at this juncture? Because at this point we know nothing that is very clear, so there is going to be considerable uncertainty. Do you take money off the table?
See, Alex, again, in technicals, I give a lot of importance to trend and look at the volumes which are created in this counter. Yesterday, HAL was up by around 5.5%. Almost 4 million shares were traded, and that is higher than the average by almost 50%. So yes, it's a clear breakout. The trend is absolutely positive. If someone has already initiated position, I would say trail the stop loss and hold the position. We don't know whether it's railing only because of the recent geopolitical stress, or it can be because of something else. But yeah, the trend is absolutely strong. I'm very bullish on HAL, Mazgon. These are counters which are looking attractive to me. considering yesterday's low as a stop loss, one can even create new positions in upcoming sessions. And the targets can be minimum 10% on the upside with very minimum downside at least.
I mean, a good upside coming in there. In fact, yesterday, India and France have also signed a deal for, I think, 26 Rafales. And that is one of the key positives coming in for HAL in trade, and all your shipbuilding companies were in the positive as well. But moving on and continuing with the Gensol saga, the companies' woes don't seem to see an end. Now, the ED has also stepped in, and they are reportedly reportedly conducting searches and seizure operations at the companies Ahmedabad and Gurgaon premises. They've done this yesterday. To tell us more about this, my colleague Agni Dev joins us. Agni, what has the ED found at these premises?
Right. So, like you said, the Enforcement Directorate has carried out search and seizure operations at Gensol's Ahmedabad and Gurgaon premises. Now, the Enforcement Directorate has found some documents, including electronic devices and financial records that have thus been seized. So, under these documents and the searches, these all were conducted under the Foreign Exchange Management Act and also under the Income Tax Act. And a notice has also been issued to Axis Bank, HDFC Bank and ICICI Bank. Now, remember, we had earlier told you that the Enforcement Directorate has put out a lookout circular against Gensol promoters Anmol and Puneet Jaggi, and Puneet Jaggi was also subsequently taken into ED custody and questioned for over 7 hours. Now, the sources had told us that the Enforcement Directorate is looking into the issue from an angle where it thinks even cryptocurrency was involved for the round tripping of funds, and foreign remittances to the tune of 200 to 300 crore rupees were being used by these promoters to facilitate their round trips. So this is a developing story. As of now, we don't know what was on the documents and devices that the Enforcement Directorate seized, but do stay tuned.
We'll come back to you, I'm sure, when you have more developments. Thanks so much for getting us those details. In trade yesterday, of course, you saw Gensol take quite the battering, and it ended, as you've seen, at a lower circuit. It ended about 5% lower. No buyers in the stock as things stand right now. But a stock from the automotive pack that we've been looking at, and in fact, yesterday our expert in studio guest, Parag Thakkar, spoke about this very positively, TVS Motor. And the fact that it was going to book all of its PLI benefits in the fourth quarter, that has actually aided the company as well. We've got several brokerage notes that have come through that are also positive on the stock, I believe. Puneet is joining in to tell you about whether that is the case. Puneet, good set of numbers and a beat on several parameters. What stands out?
Well, definitely, Alex. It was a really strong set of numbers for TVS Motors. We saw a 0.5% benefit of PLIs out of the EBITDA margin. So 0.5% of the EBITDA margin was actually a straight benefit of PLI. And that's largely because of the company's electric vehicle ventures in iQ, which is its electric vehicle two-wheeler maker, as well as the TVS King, which is its electric three-wheeler. That's also been gaining a lot of traction. Apart from that, we had brokerages such as Macquarie, Nuvama, as well as Citi come out with views. Macquarie has maintained its outperform rating. They've said that it's one of the top picks with a target price of roughly about 3,045 rupees per share. And they've said that the company is well positioned for growth and margins going into FY26, and exports will likely recover in the African markets in this year. Last year, there was impact of currency devaluation in major markets like Nigeria, while the other aspect is that they remain buoyant on the new entry of TVS into markets like LATAM in this particular year, something that the other peers like Bajaj have also done very considerably on the back of slow growth in Africa. Nuvama also maintained its buy rating. They have actually increased the target price to 3,200 versus 3,100 earlier. And the key aspect they're mentioning that they expect TVS has been gaining continuous share in domestic as well as export market, and the share has actually risen from 14.8% in FY19 to almost 17.6% in FY25. They're also expecting these market share gains to persist going forward as well, and they expect TVS is better positioned in EV market specifically compared to its other peers across the broad portfolio and different battery ranges. And finally, in terms of Citi actually has a sell call on something like a TVS, but they've increased their target price to 2,050 rupees per share versus 1800 earlier. Now, because they have also mentioned that the results were largely in line, but it's only because of valuation concerns that 35 times price to earnings, the highest and the most expensive two-wheeler stock, hence the sell rating. But all three brokerages positive on Q4 as well as FY26 outlook for TVS.
Actually found that very interesting. So they've continued to say it's a sell rating. It's a 27% downside from the current market price, but it's a very considerable increase in the target.
But it's still below, right? But that's, I mean,
It is
they
below.
will
I
have
find
to
it
look
very
at it, right?
interesting,
As to what's the fair value. That's what the analysts are starting to provide. But that's an interesting one. In fact, Sunny, how are you looking at a TVS Motors? And with that, if you have to then now place, you know, the other two-wheeler makers as well, your view?
Yeah, so coming to TVS Motor again, we are also very bullish. We believe the fair value of the business is close to 3100, 3200 rupees. Although the company will be one of the expensive one in terms of valuation, but looking at the way the TVS is delivering growth across all its segments, whether it is two-wheeler, the recent launch of electric three-wheeler, that there they have got a very good response, and overall outlook seems to be very optimistic for FY26. So I believe that TVS will continue to command premium valuation compared to its peers. So TVS again will be a consensus as well as our top pick among the two-wheeler play. Hero MotoCorp again trading at a reasonable valuation, but growth is missing. So I feel maybe trading close to the fair value at a current juncture. After TVS Motor, my next pecking order, next stock in the pecking order will be Eicher Motor. So Eicher Motor, we are seeing that volume growth has been pretty robust, although the company has been sacrificing something on margin to gain the volume. So Eicher Motor buy on dip is the right strategy. We feel the fair value of Eicher Motor is close to 5,800, 6,000 rupees.
Right, yeah, so the Royal Enfield play is something to watch out for. We've been speaking about when the recovery in urban demand comes through, but remember, this is a company that has beaten expectations in the past on volume, so keep a look at that. And of course, the numbers that come through later in the week on these volumes in the first month of the new financial year are going to be tracked very closely as well on the first and the second of the month. But very quickly, Kunal, on automotive companies, we've seen a couple of numbers come through and reactions to them. Maruti Suzuki earlier in the trading week. What would you say about the pack as a whole? And I will actually invite you to look at not just the OEMs, but the broader auto ancillary plays as well, and to say, is there any opportunity to buy, if not for the very short term, but any trends that you're seeing that perhaps indicate upside for a one-year time frame as well?
So Alex, the entire pack is actually looking very attractive to me because the risk-reward ratio is favorable. Just have a look at Maruti for the sake of it. 13,700 was the peak, and right now it made a low at around 11,250, and that's consolidating near the low with good volumes. So, you know, these are the counters which are offering good risk reward, but I'll be very, very selective. So on the two-wheelers front, I was just checking TVS Motors or say Hero Motors. I mean, they are near to the highs compared to these four-wheeler segment. So again, very selective, comfortable with Maruti as of now. Even when you look at Tata Motors, for the sake of it, counter has not really participated itself in the rally, consolidating near 670 levels. I'm very comfortable with that. When it comes to Hero Motors, again, the counter is near to the low, though it has not really participated, but momentum is also missing. So I'll avoid this. TVS Motor near to the resistance. So again, I'll avoid that counter for now. So specifically comfortable with four-wheeler segments over two-wheeler segment for now.
Sunny, in terms of first source solution, overall FY25 has been a turnaround year, but valuations are still not cheap at this moment. How are you reading the Q4 numbers and your view on the overall tech earnings now that we are at the fag end of IT earnings? Sunny, I think you're on mute.
Yeah, sorry. So coming to IT, I think the numbers has been mixed back. So again, the commentary, if you see, there is a lot of uncertainty in terms of demand environment, and most of the companies are unable to guide in terms of what will happen over the period of next 1 or 2 quarters, especially a case in point KPIT, despite of delivering very strong set of number, they were still uncertain, and they have not given guidance for next 2 quarter, maybe during the mid of FY26, we will hear guidance from them. Coming to First Source, I think the company has delivered, if I look at on a full year basis, at least they have delivered on what they have promised at the start of the year. Coming to the fair value, what we believe is that the fair value of First Source as per our computation is close to 425 rupees. Keeping that target in mind, one can approach the First Source. But again, overall, as of now, we would like to remain underweight on IT as there is a lot of uncertainty regarding the demand environment and the way AI is going to impact the business as well as the growth outlook. So maybe a right time to wait and watch, and maybe post first quarter number, we will get more clarity as far as the growth for FY26 and 27 is concerned.
Now, speaking about IT earnings, let's focus in on KPIT Tech. It's posted a strong Q4 number. However, the management has not given any revenue or margin guidance for FY26, which is why brokerages are a little bit cautious, if you can call it that, on the stock. HSBC has maintained a hold rating and cut their target, and there are more updates, of course, to tell you about. Puneet is joining us to tell you about what they're saying. Puneet, I wouldn't blame them too much, considering the kind of uncertainty that they have. A lot of companies globally are saying we can't give you outlook for FY26.
Well, definitely, Alex. But the only, I think, one of the key factors has been that the growth in the dollar terms has now slowed down. In this particular quarter, the constant currency growth is just 0.7%. It used to be 6% on a quarter-on-quarter basis in terms of constant currency. I think that is one thing that the street is picking on in terms of, at least the financial performance. Apart from that, we've also seen that while the EBIT margins has largely remained in the 17% range, it might be under pressure going forward. And I think that's one of the key other aspects to watch out for. In terms of, geographies as well, we saw Europe down 7% compared to the previous quarter. And Europe is a very big automotive hub essentially, and for an ER&D company like KPIT, that could be one of the worrying signs ahead, and in terms of uncertain outlook, and hence the FY26 guidance, not given in this particular quarter is slightly, it's actually a big negative, to be honest, not slight, it's a big negative in this environment, because most brokerages are anticipating some guidance or some visibility ahead from managements, and HSBC has also mentioned this. They've cut their target price to 1,325 per share versus 1,440 earlier, and they've said that quarter 4 was not, and I quote, not an easy swim against the tide for a company like KPIT. They've said that the industry headwinds are currently too extreme to fully offset essentially the market share gains and thereby impacting growth going forward. They've also said that Q4 had the weakest growth over the last 18 quarters for the company, and management, while guiding for only any pickup in growth in second half of FY26, might be still a very uncertain time. They've essentially had to moderate growth as well as stabilize the margins at these levels, and hence that is a negative. And Kotak also cut its target price to 1,000 rupees per share from 1,150 earlier, citing similar negative instances. So stock, while highly valued, might be under pressure today on this aspect, and the FY26 guidance not being given is definitely a key negative.
All right, so that's a view on KPIT. By the way, one of the stocks that was in focus, or rather pair of stocks, M&M and is SML Isuzu, and that's because of the announcement of the acquisition. M&M was up about 2.3%. It was looked at as a very good move for them to acquire this company, majority stake at 555 odd crore rupees. Not so good for SML Isuzu. Why? Because the acquisition price is 63% lower than Friday's closing price, and that reflected in the stock price. By the way, the open offer price was also about a 13% discount to Friday's closing, which means that at this juncture, at 1,596, we're not too far away from that open offer price, and 26% of stake is being looked at to be acquired. So the question, Sunny, is that if there is considerable selling even today, and if we move below the offered open offer price, then if you're a retail investor, does it make sense? And this is the second time I'm asking in 2 days, does it make sense to tender your shares in the open offer, considering that there's a possibility, based on the acquisition price, that the shares will continue to go lower?
Yeah, I think there is no point in tendering in open offer. I believe you're talking about SML Isuzu, right? Yeah. Alex, sorry, I missed the stock.
Yeah, I'm speaking about SML Isuzu because we're very close to that open offer price, and the acquisition price is 63% discount to Friday's closing. There is a possibility that stock drops further. So do you tender your shares?
No. Obviously, I think when open offer price is significantly lower than the current market price, there's no point in tendering the share. In fact, I don't know. I mean, people will get chance to exit in
Sunny,
the.
let me clarify. Sunny, let me clarify. The acquisition price is 63% below Friday's closing, but the open offer price is only 13% below Friday's closing, which means that we're very close to the open offer price right now. We're likely to fall below the open offer price today if the stock opens gap down. So in that context, would you tender your shares?
Yeah, definitely. I will tender. Apologies for my misunderstanding on the number. So yes, the open offer price is far way above the acquisition price, and it makes sense to tender the share in the open offer at a current juncture. And the way the deal has happened at a significant discount and close to 7.5 times EV/EBITDA, I think there is a possibility that stock may continue to correct and go to the levels of 1,000 or maybe 1,100 rupees. So it makes sense to tender the share in open offer.
So that's the view on SML Isuzu. We've got more stocks to talk about. Kunal as well as Sunny, do stay with us. We have to slip into a very quick commercial break. We'll be back on the other side to talk about the pre-open session and stocks that you should watch out for. Do stay tuned.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible
Welcome back. You're watching India Market Open. Let's take a look at the implied open rate. There you go. It's up 54 odd points right now. The GIFT Nifty at 24,500. The Nifty Futures at 24,450 odd number. Sunny, I'll come to you for Trent. It's expected to post its earnings today. Yet another quarter observe 50% growth. I think now the new normal for Trent is 30% odd growth in terms of revenue. How are you reading the numbers, and what do you think of how the stock will react, because the stock has been under pressure since the past few months?
Yeah, I think again, no doubt that the kind of execution which Trent has delivered during the last 3-4 years, again December quarter, which is March quarter, again we will see a very strong set of number from Trent. But having said that, on one aspect, on one hand, business is doing pretty well in terms of growth. But on other hand, because of an expensive valuation, we believe that it's better to ride this retail story through some other stocks rather than Trent, because in an uncertain demand environment, in case there is 1 or 2 quarter of earning miss, then there is a further possibility of correction or derating in terms of valuation multiple. So I would like to stay away from the Trent at the current juncture.
All right, so stay away from Trent at this point. Okay, but let's also take a technical view on this one. Stay away on the fundamentals for now. But Kunal, if you're holding the stock, anything that you should watch out for on the technical levels?
So again, Alex, Trent has been consolidating for a while near the zones of around 5,000 levels. Just look at the historical data. June 2024, counter actually started really from 4,800, made a high of around 8,350 or kind of levels, and back to the same level, 4,750, 4,800 kind of levels. Now it's consolidating near that level. So till the time counter remains above this 4,700 ballpark figure, I think it's absolutely fine to hold on to the position if someone is willing to create new position. Now I think momentum is missing for now. 5,450 or 5,500 can be a good breakout on the counter for short-term trades. But otherwise, if someone is holding, hold with the stop loss of 4,700.
We've spoken quite a bit about financial stocks in the recent past, Sunny, and I do want to ask you about PNB Housing. It came through yesterday. I wonder where the first few ticks are for this particular company, because it is a strong set of numbers that was reported. It is up about 3.4% in pre-open. Let's see how that pans out over the course of the session. But the way that it looks, Sunny, is that the street is looking at this positively, and there's a good reason for that. 5 basis point improvement in the NIM. You have a reversal of provision, improvement in asset quality, and ROA increasing by 25 basis points sequentially. All seem to be ticking the right boxes. And valuation comfort, would you agree, is still there? Would you go out and buy?
Yeah, definitely. I think very strong set of number from PNB Housing in line with their earlier guidance. We believe the fair value of PNB Housing is close to 1100, 1150 rupees. Keeping that price target in mind, one can approach the stock. Anyway, the entire housing sector will benefit out of this, the recent rate cut cycle, which has initiated by central bank, and at the same time for PNB Housing, I believe the ascent rating upgrade is also aiding the further aiding in lowering the cost of fund for PNB Housing. So I think yes, this performance should continue for FY26 on PNB Housing, and we believe the fair value is close to 1100 to 1150.
Okay, another stock that is doing particularly well. Let's run through a list, because you have quite a few earnings that have come through post-market. I want to look at TVS Motor, because you have the commentary that came through in a very positive set of numbers. Okay, so it's maybe a little bit low at the start. Let's see if that changes over the course of the session. But something like an Adani Green is looking particularly strong today. At least that's what I saw on my screen. It's up about 3%. There you go. So it's a strong set of numbers, because the profit has risen quite considerably as a 10 percentage point increase or expansion in the margins in the quarter gone by, and that's all on the back of an increase in capacity, and capacity set to increase quite a bit going forward as well. RBL Bank, you have Society Generale that is bought stake. Let's see where it is at. It's okay, it's about 0.5%, but the stock reacted, remember, very sharply to the earnings, so a cool off is on the cards. It's something that is par for the course. Let's look at something like a Fino Payments. It's another strong performance, and the stock was up and about yesterday, is up about 1% or so yesterday. But again, very strong set of numbers, and it moved in trade yesterday. Something like a Castrol, you had volume growth that was stable, but if I'm not mistaken, the margin picture was not great. Let's see if the stock is reacting. Okay, so there you go. It's just about flat right now. HG Infra, there's a considerable order that has been bagged, 1,123 odd crore rupees. Again, there's not too much movement. Let me go across to Sunny. Sunny, very quickly on Adani Green. The numbers look really good to me, and quite a considerable increase in the bottom line. The margins have improved quite considerably. The prospects are great, considering that you have capacity addition also on the cards, as much as 3 gigawatts that is going to be added in the near term. What is your rating on the stock?
Yeah, I think I have not gone into very detail, but looking at the broad number seems to be a very good set of number from Adani Green. But again, here the case is very similar to Trend, where the company has been doing well, and at the same time, growth outlook is pretty robust for Adani Green. But on valuation front, again, the stock is trading close to now 1.5 lakh crore market cap number, and the annual profit potential of the company is close to 3,000 crore. So I think trading at a very expensive valuation at a current juncture. So again, I would like to stay away from this stock.
Banking pack as a whole is looking very attractive right now. Let's pull up something like a UCO Bank up 4%. There's PNB Housing doing well, up by about 4.5%. Central Bank up by about 4%. Some counters in the defense pack, the pre-open rates look again attractive. Yet another day of gain. Paris Defense up 3.6%. Let's pull up something like AWL Agribusiness as well. The numbers seem strong, but overall there is a volume impact that is being seen in the numbers as well. Let's also shift focus to the big brokerage call of the day. Jefferies has maintained a buy rating on Kaynes Technology and hiked the target price to 6,600, which was earlier 5,400. So this poses roughly a 24% upside from its yesterday's closing, and we have Harsh joining it with more details on that. Harsh, what are you picking up?
Yeah, slight bit of change, around a 12% upside to yesterday's closing. Now, given pre-open, maybe a 10% odd upside. In terms of what we can expect, right, multiple levers to actually ensure that growth for Kaynes Tech sustains is what Jefferies believes. In terms of one of those levers, it's the OSAT business, which is the outsourced semiconductor assembly and test business, which is expected to start Q4 FY26, around 3,500 crore in terms of top line expected by FY30 with regard to this business. So this will be quite a decent contributor in that sense. In terms of asset turnover, the company should continue to churn 6 to 7 times in terms of asset turnover with regard to its core EMS business, which should also aid the top line in terms of its growth. In terms of new orders, that's the other positive. Margin accretive segments is what it's focusing on, aerospace and the like, and those should also aid the margins in terms of how it plays out going forward. There's also 1,000 crore smart metering business which is expected to come through over the next year or so in terms of top line. The other piece is with regard to the business model. It's almost fully backward integrated, and it's one of the very few players which has done that within the EMS basket, which is why Jefferies believes that's a positive. Also, its operating margins are decent, something around mid-teens, which also helps the business do better operationally. Last off, 5 new customers expected to be added. 1 USA-based customer already added, so customer pipeline remains strong. They're expecting FY25 to 28 revenue CAGR of around 40%, PAT CAGR of around 45%. They're giving this a price to earnings multiple of 67 times, and they've upped their FY26 and 27 EPS estimates by 1 to 3%. All of those likely leading to that 66.60 being the target price on this one.
Okay. All right. Thanks, Harsh, for that. And keep that on your radar. Stock is looking like it's going to open positive. Let's see if that continues to be the case. I want to look at IndusInd Bank because it's had a little bit of a choppy start. At one juncture, it was down about 5% or thereabouts. It's up about 1.4%. Of course, we've talked about the latest development, and it is the resignation of the Deputy Chief Executive Officer. This was expected to happen. I'm just wondering whether Sunny has an opinion on this. Sunny, a lot that is taking place with this particular bank, and we've identified, or rather the internal investigation has pointed out the implication, the cost of that. It's going to be about 1,900 crore rupees or thereabouts. But assuming that you don't have more skeletons out of the closet, and assuming that there is going to be a cleanup of the management and a change at the helm that will take place over the course of the next 6 months or so, October is when we will find a replacement to Mr. Katpalia. What would you do with this stock if you're holding it? One, if you're not holding it, would you venture out and buy?
Yeah, so in case if somebody is holding on to the stock, I would suggest that they remain invested, because I assume that there is no further damage that is expected from on the balance sheet of IndusInd Bank. And at a current valuation, at a current market price, valuations are pretty reasonable, trading at less than one price to book. And I believe on the management change in place, obviously the bank will be on the growth path again. So those who are holding on to the stocks, they remain invested. Those who are planning to invest, I would recommend them to wait and watch. Maybe this is a time to encash on the stocks which are in a strong upward momentum. Case in point, ICICI Bank among the private sector bank or HDFC Bank, where we are seeing a continuous up move. So it's a kind of techno funda pick over there. So I think for time being, better to stay remain invested in a stock which are in a strong upward momentum.
An interesting point, and also the point that you're making on the valuation is something that has drawn a lot of attention, Sunny. But the only worry is whether or not the deposit franchise, which has taken a bit of a beating as this question mark has come up, is that going to be a headwind in your opinion? Quick answer relatively. If you see, for example, in the next quarterly update or in the next update that they have, that there is a further deterioration of the deposit book and they are losing CASA as well. Is that going to be a red flag for you?
Yeah, definitely. I think in a current scenario when all the banks are struggling to mobilize deposit, any headwinds on deposit mobilization will be taken as negative by the street. But what I feel is that most of the negative news is already in the price. So maybe downside is very limited at a current juncture. For upside, we need to wait for clarity in terms of the growth outlook from the management and clarity, further clarification that there is no more skeleton which are likely to come out from this IndusInd Bank.
Kunal, Oberoi Realty, the pre-open rate suggests it's down by about 3%. The stock has taken a significant beating in the past 6 months as well. Year to date, it's down by about 30%. Do you think the bottom is hit for this particular stock, or there is still further downside?
See, I've been talking about realty space since quite a long time, saying that the comfort is still missing. Reason being, though the trend is sideways, but the momentum is missing, right? So coming to Oberoi Realty, just have a look at the overall formation in last 3 to 4 months. Sideways consolidation, support is near 1500 and the resistance is near 1700. So until the counter comes out of that, I think one should not assume the bottom. It can be a good trading bet if you get the opportunity to buy near 1500 with the stop of 1450. And on the upside, 1700 can be the target. Once the counter comes out of this band and gives a breakout above 1700, I think then we can expect the trend to continue. But till then, I think the sideways momentum is likely.
So, by the way, Hiral had pointed this out as one of her 3 stocks, and she had put a thumbs down on it. Several issues that have been highlighted. There is a rise in land acquisition cost as well as an increase in the interest cost. The depreciation is up as much as 79%. Several reasons why. Slow collection as well year on year in the quarter gone by. And by the way, there has been a run up in realty stocks as well in the recent past, bounced back quite considerably from the December lows. Sunny, anything that you want to venture into here in the realty pack, or would you stay cautious for now and wait for maybe some of the benefits of the lower interest rate cycle to play through?
Yeah, again, I think a few stocks which we feel are trading at a reasonable valuation. So one of them is Brigade Enterprise, which is predominantly play on a Bangalore market. So Brigade Enterprise, we feel after delivering a very robust set of numbers during the December quarter, March quarter should be again a pretty good set of numbers from Brigade. From a large cap pack, Macrotech developer Lodha, so there we have seen again a very strong commentary, the balance sheet deleveraging. So Macrotech developer, maybe buy on dip is the right strategy for Macrotech at a current juncture. Again, among the smaller mobile players, realty.
Okay. So, Kunal, what about the rest of the realty pack? So we've already taken his Sunny's picks on the fundamentals, but would you book in any of these? Would you stay on the sidelines?
I would prefer to stay sidelined until this momentum, gathers the strength at least.
Now, we've had the pre-open session. We're about 2 minutes away from the open. Would you spot anything? Have you spotted anything that is interesting, maybe from the broader market, something that you've not looked at before?
So yes, I think Adani Green is giving the first sign of breakout of broader consolidation. So with the stop, if the counter sustains near this for at least 15-20 minutes, then with the stop of around 935, one can go long, 1050 can be the target. And the second is HCC. I think the mid-cap counter, but yeah, it's looking attractive to me. If the momentum picks up really well, I think with the stop loss of 2550, one can go long and the targets can be 31.
Kunal, I found what happened in the IT pack yesterday was quite interesting because you bounced back quite considerably from the low point of the day. Of course, it was an underperformer, but I found the intraday move quite interesting. On the technical side, what are the rules that you will follow?
See, again, in those counters, as we mentioned, as we discussed last week also, right? If the higher top, higher bottom continues, just stay, hold on to it. And the simplest rule which one can follow is keep the stop loss as of 2 days low. Just go back and check out the 2 days low. That can be good stop off. That is on a broader space. I think Infi and TCS, which we discussed, are likely to outperform, and that can be held on for long term also.
Okay, Kunal, quick view with respect to where AWL agribusiness stands, where charts are concerned.
So I just checked the chart when you were discussing previously. I think sideways consolidation is likely. Immediate resistance on the chart is around 290 and the support can be placed at 260. This sideways consolidation is likely for at least a couple of weeks.
Okay, so we've kind of taken you through practically everything that you need to know before the start of trade, and the setup was that yes, you saw an up move in trade yesterday, but remember the market breadth was not terribly exciting. It was more or less even Stevens at the end of the session, though you saw green across the screen. And so consolidation is something that is already playing out in several markets around the globe. And based on the kind of up move that you've seen in the Indian equity markets, don't be surprised. There's a little bit of consolidation that you're able to witness on the screen today. So there you go. A cautious sort of an open, about 0.2% for the Nifty 50. The Nifty Bank is also up about 0.33%, so nothing too much. IT is also about 0.2%, 0.33%, so very narrow ranges. Okay, so mid-cap index is looking good. It's up about 0.6%. Let's look at the small cap index as well. It's up about 0.8%. So if large cap was in focus at the start yesterday, you have the mid cap and the small cap that are going to be the focus at the start. Let's see if that continues to be the case through the day though, or whether some money gets taken off the table. But as things stand, the start seems to be good for the broader markets. Let's also take a look at the sectoral picture and see what is moving today. Yesterday you saw defense that led. Okay, so it's a pretty picture. It's green across the screen. We're led by PSU banking names. That has been a pack that has been in focus in the recent past. A few of the names doing particularly well and catching up, one would argue, with their private sector peers, the likes of HDFC Bank, the likes of ICICI Bank, which have moved very smartly higher in the recent past. What else is doing well? Defense is building on the gains that it had in trade yesterday. It was an over 4% up move in trade yesterday. It's another percent or so in trade today. Small cap index is up about 2% right now, so keep that on your radar and keep it on your screens as well. Consumer durables not too bad. You have the likes of energy, metal, all doing well today. It's a very positive session, so to speak, though you have the Nifty 50 that is not doing too much at this juncture. Let's take a look at the heat map as well and see what is moving the benchmark Nifty 50. Yesterday you had a few heavyweight stocks that led the gains and pushed it all the way up to that 1.2% gain. At this juncture, on the top of the screen, you have IndusInd Bank. We spoke about the fact that it might just be a sentimental up move right now, and that is in fact playing out. You have the Deputy Chief Executive Officer that has resigned and has spoken about the reason for his resignation being those discrepancies that we've been speaking about in recent weeks. What else is moving? BEL from the defense pack, no surprise there, it's doing well again in trade today. Tata Motors rebounding a little bit from the low point. Of course, in the recent past, we've had less headlines on trade tensions, on tariffs, and so that means it's positive news. No bad news is good news for Tata Motors at this juncture. Trent ahead of its numbers, looking reasonably good. SBI from the banking pack, not bad. It's up about % or so. Not too much in the way of gainers, big gainers. Apart from that, Reliance Industries, which was the star yesterday, only about 0.2% higher in trade today. And not too much in the way of declines either. Cipla, the worst performer on the Nifty 50, down only about 0.5% or so. Sun Pharma, so pharma seems to be a little bit soft in trade today. You have Grasim, you have Bajaj Finance ahead of numbers that is trading a little bit lower. From the broader pack, let's take a look at whether or not there are some reactions to the earnings. Let's pull up something like an Adani Green if we can and see what the reaction to the stock is. It's cooled off just a tad bit from where it started, but it's up about 0.7% to 0.8% right now. pull up something like a First Source Solutions. Let's see where it's doing. It's about 0.5% or so. PNB Housing was something that I pointed out on the back of earnings. Very strong set of numbers, and it is at the high point of the day right now. Perhaps one of the stocks of the day today, gaining as much as 5.6%. What else? Tata Tech, it was set to be a weak start. Let's see if that has actually panned out, and it has in fact panned out. TPG is to sell a near 4% stake in the company, as a result of which it's under pressure today. So several stocks reacting to news updates. I'm just wondering, Mahima, there are a few more I'm sure that are reacting in the broader markets. What are you seeing?
Right, so HT Infra is one of them. Order worth 1123 odd crores. There's CSB Bank, good growth in advance and deposits. PAT jumps despite of higher provisions. There's Fino Payments, strong top line growth in terms of PBT, also good and strong growth. PNB Housing, margins have expanded. The overall write-backs have aided profitability for the counter. There's Adani Green, net profit up 53%. The stock's doing well on the back of that. What's helped the earnings? Well, 37% growth in terms of power supply revenues. There's also IndusInd Bank that Alex mentioned earlier. Oberoi Realty, pre-sales degrew by 47 odd percent. No new launches. The stock under pressure. There's AWL Agribusiness doing fairly well, although volumes have been impacted, but the stock is seeing a downtick on the back of that. Kunal, I'll come to you. How are you reading the overall market opening right now, and what are the levels that you're watching out for trade today?
The Nifty and Bank Nifty has really opened well, and in fact, the Bank Nifty rally continues after 3 days or 4 days of consolidation. If the low is taken care of, then we are heading for 24,800 to 25,000 on the Nifty front. When it comes to Bank Nifty, the consolidation is still pending, but 56,500 is likely to watch out for as the first target. And now when it comes to stock specific, I think the PSU banking theme is doing good. We mentioned IOB in the morning itself as the opening call, right? And it's up by around 3.5-4% right now. Similar is the case with Ken Bank. I think these are the fresh movers. And if the Bank Nifty continues to perform well, I think PSU banking should pick up the pace now to catch up with the private sector banks. So very bullish on PSU, at least looking at the opening.
Okay, so that's interesting. PSUs is what is in focus. Two IT names from the broader markets is a KPIT Tech and a Exaware. Both of them have reported numbers, both under pressure right now. KPIT, yes, they've deferred the guidance, and that's what is concerning the street. Exaware also under pressure. Sunny, how are you looking at both these names? Because the expectation was that your mid-cap IT companies would probably do better than your large-cap IT companies. Both of these names slightly under pressure today.
Yeah, definitely. I think the demand environment is something that is relatively that is uncertain for all the IT companies, whether it is mid cap and large cap, and that is leading to a lot of uncertainty in terms of earning growth, at least for next 2 quarters for all these IT companies. So I think as we discussed earlier, we continue to remain underweight on IT sector at a current juncture and wait for more clarity to emerge on trade war, tariff war, what is happening over there, and how the demand environment for IT shapes up over the next 2 quarters.
Tejas Network is up about 2% or so in trade today, but for the week or over the last week, it's dropped quite considerably on the back of its earnings. I had a cursory glance, Sunny, I must admit, at the numbers, and it was a loss that they reported. And so I'm just wondering whether you've looked at it as well, because there was a considerable contraction in the margins in the quarter gone by. If you're tracking it, what was the reason, and would you venture out and buy at this juncture, considering that it's dropped quite considerably?
Again, in an order book driven businesses, I think there can be a blip in a margin for a quarter or two, and that seems to be the case for Tejas. However, I missed attending their con call, but I think that can be one of the reasons. Otherwise, the company is sitting on a very robust order book. So if you look at the end of the quarter four, the order book is close to 1,000 crore rupees. So I think that's a decent order book as far as Tejas Network is concerned. Maybe gradual accumulation is the right strategy as far as Tejas is concerned.
Sami Hotels is up 5% as we speak, and this stock has been on a tear since the announcement of GIC acquiring 35% stake in this particular counter. Any views with respect to where charts are concerned? Is there a further upside?
Yeah, honestly, not tracked this counter, but just now I saw the chart. I think the consolidation was earlier near to 215 mark. This counter sharply declined in trade, I think till 120, and now it's reclaiming those levels. So the trend is definitely on. If someone wants to trade the short term on this counter with the stop loss of 175, one can take up the position, but have to be cautious near 210 levels. So yeah, the trend is absolutely on. With the stop of 10 points, I think on the upside we can play for 25-30 points.
Okay, so that's with regards to where Sami Hotels go. One of the other pack that we've already spoken about is in terms of auto. But if you have to look at the auto ancillaries right now, Sunny, from a fundamental perspective, how are you looking the auto ancillary pack? Samvardhana, which is up almost 2.5% in trade. Sona BLW, few of these names probably are on a front footing today. Your view?
Yeah, so I think there are some rumors that US may relax some trade tariff on the import of auto components which are used in manufacturing of US automobiles. So to that extent, the companies which have got an exposure to US market, whether it is Sona BLW or for that matter Samvardhana or for that matter Bharat Forge, they are reacting positively in the trade. Apart from that, we are positive on technology agnostic companies. So or a company which have got a more exposure towards the Mahindra and Mahindra, which is doing relatively well in terms of volume growth. So companies like Lumax Auto, we are bullish on that name. SJS Enterprises, again a smaller company which is into this decorative aesthetic product. So Uno Minda, which is a well diversified portfolio company as far as auto ans is concerned.
Can you reiterate, Sunny? I'm just trying to understand the list that you've given. Before Uno Minda, you mentioned a company that I think is looking to diversify. Is that what you said?
SJS Enterprises.
Okay, got it. All right, okay, so that's the auto pack for you. Strong moves in the banking pack. And Kunal, you want to come in and talk about the levels once again, because we're at 55,880 on the Nifty Bank at this juncture, 0.8% higher. Does that strength hold? And I know that you've talked about 56,000 levels. That seems to be on the cards in trade today, not too far away.
Absolutely, Alex. I think this move is really very strong. Anyone who tries to short going contra on the trend probably will get trapped. So unless and until Bank Nifty, breaks 55,450, so approximately 55,500 kind of levels, I think buy on dip can be good strategy. On the upside, we can expect first 56,000, second 56,500. That's 1,000 points rally, which we discussed in the beginning. I think 500 points is done. 500 more to go on the upside. So keep the levels of 55,500 in mind and place the bets accordingly. And as we discussed, I think PSU banks are looking very attractive to me. From risk reward point of view, I think there we can make really good deals on selected counters.
Right. Kunal, one quick one with regards to IndusInd Bank. The stock is the top gainer, right now in terms of Nifty 50 as well. 2.5% is the kind of up move that you're seeing. Are you seeing further strength on this one?
So we had this, I was lucky enough to discuss the same on our channel also near the bottom itself. And this counter is absolutely in strong trend. Immediate resistance is at 875. Now this is a time where I'll turn a bit cautious. 875 is a zone to think of booking the profits if someone has initiated a buy earlier. And if someone wants to play positional, then trail the stop loss to around 820 and hold the position. I think this, if at all, this counter gives a breakout of 875, then we can see the upside in 950 levels.
If you break above 875, that's going to be interesting with regards to IndusInd Bank as well. Gentlemen, please stay with us. We'll quickly slip into a short break and we'll be right back with lots more on NDTV Profit.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow.
Gold Plus Optimistic Reflective Glass लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to around compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
Welcome back. You're watching India Market Open. Few of the other names that are probably slightly on the losing end in terms of today's session. Let's pull up names like Cipla, Bajaj Finance, Sun Pharma, Nestle, Dr. Reddy. So there is some bit of pressure coming in terms of where the pharma majors are concerned to an extent. Kunal, what are charts indicating if you have to look at a Cipla, Sun Pharma, Dr. Reddy's? Would you take this as an opportunity to buy, or would you stay away? Are you seeing further weakness because results are not yet out?
So, I'm very comfortable with these counters, especially when they are in the trend. Sun Pharma has bounced from the levels of 1550, trading at 1825. If someone is bullish, if someone wants to stay positional, I think this is the counter to buy on dip. The support level, which one can keep in mind, is 1785. Considering this as the support, one can initiate the trade. On this counter, actually, there is no negative trend itself, though it's been sideways consolidating since last 3 months, but overall trend is still bullish. So buy on dip can be good strategy on Sun Pharma. As far as Cipla is concerned, again, the trend is sideways and the resistance is right now at 1560. So out of two, if I were to select one, I'll go with Sun Pharma as buy on dip, and Cipla is something which I'll avoid for now.
And what would your target be in terms of Sun Pharma if you're looking at a buy on dip strategy, level to buy and the target price, and what should the stop loss that should be maintained?
So support level is the 1775 level, right? So that can be a good level to initiate buy. Not at this elevated level, let the counter come down near the support. 1775 can be good level to initiate buy. Stop loss in that case can be 1750. And the targets in the immediate time can be 1900 to 1950 kind of levels.
Okay, I just want to pull up the Nifty 50 intraday chart. We've cooled off just a tad bit with about 1/3% higher, and the Nifty Bank now also cooled off just a bit, now trading at 55,730 or thereabouts, 0.5% higher. Broader markets continuing to hold strength. So pull up the advanced decline ratio about half an hour or so in. The advanced decline ratio should tell you that the market breadth is significantly better than it was yesterday, but it's closed the gap just a tad bit. It's not looking like it's not looking like it's going to close very dramatically anytime soon, but keep an eye on that, one eye on that. I'm just wondering whether there are any opportunities from the defense pack that you're seeing today. They have been in focus, and another percent or so, Kunal, on the upside today. That something like a BAL is up about 2%. Let's pull up a HAL, let's pull up a Mazgon Dock Shipbuilders. Oh wow, so Paris Defense another 6.6% higher, HAL another 2% or so. So the trend seems to be intact, Kunal.
Absolutely, Alex. So the two most favorable counter right now, I think our first is HAL, where the fresh breakout has happened today. We were discussing about it before the opening itself, right? So yesterday's low can be a good support. That's 4,200 now. That's far away. So trail the stop loss to 43.50. Create new position even at this elevated level. It's absolutely fine because momentum is picking up. The targets can be 47.50, and if someone wants to play positional, don't keep the target. Just keep trailing the stop loss. First is this, and second, which you mentioned, Paris Defense is also looking very attractive. Fresh breakout on charts at 1175. It has already given breakout. So keep the stop loss of around 1125 and initiate a buy. The immediate targets can be 1320. Out of two, I think Paris can be short-term trade and HL can be positional one.
So that's with regards to where the defense names are concerned. Kunal, two stocks I want to talk to you about today that will be reporting numbers, Bajaj Finance as well as a Trent, both in terms of Nifty 50, Bajaj FinServ as well. What are charts indicating? Any trade ahead of the numbers that investors or traders can take?
So again, Bajaj Finance is trending counter, but we have seen some kind of profit booking near 9,300 to 9,350, and now it's consolidating near the support of 9,000. I would say stay away from this counter for now because last week was a good profit booking level, and it has created already a negative candle on the weekly chart. So avoid for now. Wait for the clear signs after the result. The breakout can be placed at around 9,350. and the support is 9,000. So by any chance, if the counter breaks that, we can get a good shorting opportunity on about 93.50. I think it can be a good trending counter to watch out for.
Okay, okay, interesting. So watch out for that. Of course, earnings you can catch live when they do come through right here on NDTV Profit. On that note, thanks so much, Kunal, as always, for taking the time. Always a pleasure having you.
Pleasure. Thank you so much.
All right, let's talk about earnings now. In RFC, the lender, in fact, has posted its Q4 numbers, and it was a muted set of numbers. Total income went up by 4%, but the net profit has dropped by about 2%. We're going to speak to Manoj Kumar Dubey, who's the chairman and managing director, very shortly. But before that, let's get in Harsh to tell you or set the context really for this conversation. Harsh, what stands out here?
Well, growth, essentially, Alex, that's going to be the key lookout. When does growth start to kick through? YOY, there's been very little to no AUM growth. So something with regard to an uptick there could definitely aid the numbers. The other piece is with regard to how they're diversifying beyond railways and how that impacts both growth, yes, but also margins. Would that or spreads, margins, spreads, however you look at it, do any of those numbers actually change materially in case of this diversification? Also, what can be expected in terms of credit cost, who they'll be lending to, and what the risk there could inherently be in terms of what the risk could crop up as, could be interesting conversations to have. But yes, for sure, it's a muted set for Q4. What the outlook is for FY26 will hold the key.
Absolutely. The outlook in terms of FY26 is what is going to hold the key. Thank you, Harsh, for getting us the setup in terms of what the conversation should look like. But joining us further is Manoj Kumar Dubey, CMD at IRFC. We know how the quarter has been. Mr. Dubey, good morning and welcome to the show, and a pleasure to speak to you at NDTV Profit. Firstly,
Very good morning.
My first question coming to you is clearly the street is looking at it as a slightly muted set of numbers, though the stock is seeing gains of around 1.7%. From here on, are you expecting a further improvement in terms of growth if you have to look at the first half of FY26, or a similar kind of performance?
So good morning, and let me first put the picture in a very clear manner. So till FY23, this company was doing a lot of disbursement to Indian Railways. In fact, on the steep side, on the higher side. For the FY24 and 25, there was nil disbursement to Indian Railways. And in the last quarter of the last FY, we decided to go for a diversification kind of model. And in fact, the last 4 months of this calendar year has been really exciting. The context that has been said by your colleague is very, very valid for the fact that this is for the first time that IRFC is lending to the entities other than Indian Railways. And the exciting for the fact that the margins that we are going to get, even through the competitive bidding, is quite higher than what we used to get from Indian Railways, which was 35 bips or 40 bips. Here, 3 bids that you have won, we expect that our margins will be nearly 3x of what we used to get from the railways. So in this context, I look forward to a very exciting time for the company, for the fact that any new loans will be bringing in more to the NIM. And my NIM is going to have a very steady rise from 1.4 that we have right now. I'm expecting that by the end of the year, it should be more than 2% on year-to-year basis.
Okay, that's very interesting. Mr. Dubey, thanks so much for taking the time. This is Alex here as well. Help me understand this incremental change in the texture of the book that you are working towards, because I think that is what a lot of people on the street are also focused on, the diversification beyond railways. So over a period of time, you're saying that the new loans that you disburse will aid your NIMs, and I think that trajectory towards 2% is going to be very keen to watch. But how is the texture going to shift, and what is the kind of percentage shift that you anticipate?
So this is a very good question, Alex, and let me make it very clear that what kind of quality of assets and which areas we are focusing on. So the first thing is, my mandate is to fund anything which has any backward or forward linkages to the railways. Having said that, railways is such an entity that it affects almost everything in the ecosystem of the infrastructure, right from power generation to ports, to any kind of logistic aid which is coming to the system of the system of the logistics, railways is always at the center. So my focus is going on to the any renewable or thermal power generation which is going directly to the railways. We are also looking very keenly on the rapid transformation of the metro railways. In fact, we want to be a substitute to bilateral loans to the very fast-growing metro railway ecosystem in the country. To summarize, my focus is the whole of government approach. So my assets which are on the focus is the rated assets, A-class assets. In fact, whatever we funded right now are all AAA or A+ kind of assets. So obviously we are looking for the assets which are having very low risk, negligible risks. We want to maintain our zero NPA status. And having said that, with that access to the cheaper source of borrowings, we want to improve on NIM continuously quarter after quarter.
Okay, so that's with regards to the strategy that you have in terms of your non-railway business. So let me understand, currently what percentage of your book is non-railway, and to what extent are you planning to extend it to in terms of contribution to the AUM?
So it is just a beginning. So if you want to have a percentage, it's less than 1%. But you see, the 14,000 crore that we mopped up in just 4 months of this calendar year is all non-railways. So going forward, you will find that my books with non-railway assets per se will be having a steep rise. And any improvement in non-railway assets will be having a direct bearing on positivity of my NIM. So what we look forward is quarter after quarter, my yields would be better, and it should have a very positive impact on my profit after tax. So this is a strategy we are going to follow. And going forward, say from next FY onward, anything coming from the railway side, any demand from the railway side is going to be icing on the cake for this company's portfolio.
When you say, and I take the point that you made, Mr. Dubey, about the quality of the assets that you are getting or the loans that you're dispersing. But can you give us more clarity on that? Am I right in assuming that it is going to be primarily, of course, infrastructure, but within that, it's such a wide space to play with. Where are you going to be focusing on?
So very clearly, we are going to focus on the rated assets. And there are two ways you get the loans. One is across the table discussions, and the other is RFP participation. And any good asset is coming out with RFP participation, and that is our areas where we want to focus. In fact, 3 RFP we participated. We were trot L1. That is our strength, and we want to play on a strength for the fact that our overhead cost is abysmally low. That is less than 1% of my revenue. So in this arena where any RFP is coming for any rated assets, we believe that we have a very fair chance of being lowest, and those are the assets which are very quality assets with a very negligible chance of risk. So that is the area where we want to play, and we don't find much competition there.
You've approved raising up to 60,000 crores for FY26. What does that take you? I mean, overall, any impact in terms of cost of funds?
Cost of fund, we are still able to garner the cheapest kind of cost that we are doing in terms of domestic bond as well as in terms of 54 EC and zero coupon bond. They are very cheap sources. We wish to be one of the NBFCs whose cost of fund is cheapest as well as the overhead is cheapest. These two things taking together are giving us a lot of leg room to participate into any of the RFPs coming for good quality assets. In fact, we are not competing only with the NBFCs, but we are beating repeatedly the banks also. So that is giving us a lot of comfort for the fact that we believe that we can be the lowest in all kind of good asset biddings and still earn more than what we used to earn from the railways. So that is a very exciting proposition going forward for this company, and we wish that we should stabilize somewhere between 40,000 to 60,000 disbursement on a year-to-year basis in the coming FYs.
You know, when you talk about the funding to railways as well, what's interesting is because you finance the acquisition and creation of assets which are leased out to the Indian Railways or any entity under the Ministry of Railways, right? In the last 2 budgets, the trend with regards to railways has been slightly muted, if I have to talk about any of the railway-oriented companies. Now, let me tie that together to get an understanding from you as to what are the kind of spends looking like right now for the railways, and 2, are you seeing that kind of orders that are being booked for which you're funding?
So let's understand in a very clear manner. So the funding to the railways is coming for two ways, three ways in fact. One is government budgetary support. Second is extra budgetary resources where we are funding. And third is the PPP mode. Now, for the last 2 financial years, as you rightly mentioned, the government budgetary support were almost enough for them not to come to us for raising the funds. And that is where we found a scope of coming out of only as railways as single client and look for the whole railway ecosystem. Now, the answer to your question that what is the ticket size? Nearly 2.6 lakh crore is being spent by railway directly, and we feel that nearly another 2.5 lakh crore is needed to be spent every year to cater to the whole railway ecosystem. That is inclusive of the metro railways also. Now, for this 2.5 lakh crore additional that is to come from the market, we want to position ourselves as the leaders in that kind of bracket, and we believe that our platters are full with the kind of response we are getting. And going forward, it will be a very exciting mix for the company where if railway wishes to lend from us, we will be giving them directly as the first choice. And apart from that, anything required in the railway ecosystem, partly including the PPP projects, we'll be having a very close look on that.
Okay. Mr. Dubey, I just want to understand a couple of things. One is, we've already seen interest rate cuts of 50 basis points. We're likely to see another one. At least that's what the street is anticipating in June, the way things are going, and the accommodative stance by the Reserve Bank of India's Monetary Policy Committee. Now, in that context, I'm just curious about your cost of funds. What is the kind of trajectory that you anticipate, and the spreads, particularly when you're talking about the railway business, which, as you pointed out right now, is the bulk of the business. Do you see that improving?
You see, we are equally excited with the fact that the repo rate has been cut. In fact, if you are following the bond markets, we raised the fund even the last week at a very attractive rate of nearly 6.85%. So that gap between the bank rate and our rate is bond rate are still there in our favor. Apart from that, there's something called 54 EC market, which is nearly 15,000 crore market. There, the cost of fund is only about 5.25%. Then there is something called zero coupon bond, where we are eligible to raise funds through that also, where the cost of capital is in terms of 6.25%. Mixing all these together along with ECB, we believe that, I can't give you numbers, but we are very comfortably placed to be very, very competitive with any banks leave aside the NBFCs. And what I mentioned, Alex, which is very important to note, that our overhead cost is less than 0.1%. Now, in the industry, nobody can match us. The nearest competitor is around 0.8%. So that gives a lot of legroom to be very, very competitive, and we want to leverage this kind of driver that we have in our hand to be a leader in financing anything in the railway ecosystem, not only limiting to the Indian Railways.
One last quick question, Mr. Dubey, if you can leave us with some understanding on the trajectory. You've already given us a view on the NIM. But for FY26, if I were to ask you AUM growth, where do you peg that?
You see, I'll be talking more about my sanctioning of the loans and the disbursement. That gives a better and clear understanding of the business. So yesterday we got the board sanction of 60,000 crore of loan sanction and disbursement. What we're looking forward to is in terms of 30,000 crore minimum in this FY. Already 14,000 crore loan has been sanctioned, and disbursement is very quick and fast in this. So understand one thing, Alex. If I'm going to disburse 30,000 crore in FY26, this is akin to nearly 90,000 crore of what I used to disburse to Indian Railways, for the fact that margin there were only 0.4 bips, 0.4% or 40 bips. Here my margin will be more than 100 bips. So that will be a very exciting proposition, and we believe that quarter after quarter, my bottom line will be showing very good improvement, and the business will be there very steady manner for the next many years, as we are finding, because of the infrastructure need of the country.
Right, so this is going to be an interesting outlook from here on. The stock slightly cooling off as we speak. But thank you so much for joining us on the show and sharing the views. We'll quickly slip into a short break, and then we'll be back with Kishore Patil, co-founder and CEO and MD at KPIT Tech, to speak about the company's outlook going ahead, taking into consideration that they've deferred the guidance from here on. Please stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post.
Welcome back. You're watching India Market Open. KPIT Technologies. Now, clearly in terms of the quarter, a good set of numbers, but because the management has not given any guidance for FY26, I think that's the concerning area. The stock is down 2%. Let us first get in my colleague Puneet to decode the quarter and the outlook going ahead and what could be in store, and then we will get you the management conversation. Puneet, over to you.
Well, thanks for that. So, rupee revenue was up about 3% this particular quarter, but the dollar revenue in terms of constant currency compared to the previous quarter was just up 0.6%. And that's one of the key negatives. It's the slowest growth in the last 18 quarters for the company. And as you rightly mentioned, the guidance for the company not given, essentially withdrawn for FY26 for KPIT. Europe in this particular quarter was down almost 6 to 7% in terms of revenue compared to the previous quarter. So that was again a key negative, and those are some of the key questions that we had posed to the management, and you'd spoken to them, Hiral, and some things that we needed some questions on and answers essentially.
Right, thank you, Puneet, for getting us the details. In fact, let's also hear out my conversation with Kishore Patil, co-founder, CEO and MD at KPIT Technologies. I understand it's a good set of numbers, the environment is tough. However, the street is concerned about the deferment in terms of the FY26 guidance. I understand you're awaiting better visibility. The demand and pipeline conversion is what you're watching out for. But where is it that you're seeing concerns?
I think I may just say that we should celebrate what we have done in the last year first. I think it has been a pretty good performance by the team and done well, especially on profitability where the whole of the industry has struggled. It just gives us a very good runway into the next year as we go and, as we have the different challenges face the overall situation globally. The point we have talked about is if you look at consistently the kind of closures we have made every quarter, and especially the last quarter, it's amazing. It's one of the best of recent times. And also we have announced also a specific partnership with MBRDI. And that shows that there are new clients, there are new things which are happening. The last year, quarter 2, we were a little unsure. Quarter 3, we talked about seeing some good interactions with the client and demand picking up. Q4, we are building on that. I think the current situations in US is a bit of, I would say, interruption. And I guess the dust should settle down in a quarter or so. And otherwise, I see no reason. There are reasons why OEMs have to spend, and there is a reasons why KPIT is going to win a larger part of it. So I have no concerns on that, but this is something which is we are watching closely.
Okay. So, Kishore, when you talk about the dust should settle, would it be right to say that the deal ramp-ups could probably only start in the second half of FY26? The first half could remain muted. And secondly, the sporadic instances of cancellations of smaller projects that is coming in, not only for KPIT, but for the industry as a whole. What is the kind of quantum you're looking at currently?
The first thing I want to answer is it's not that everything is going to start after quarter 2. That is not what we are saying, actually. Actually, many of these clients are in a hurry to actually engage because it is for them to really have some of these technologies adopted. It is for them to have their production program well in place earlier. They have already started engaging. Some of these we are transitioning when we are, taking over some of these this work from OEMs, or in other works also we have started work. I think the scale up is a bit slow, and which I believe will start growing after that. From your question on the things which are falling down a little bit here and there, not too many. There are few discretionary deals. Again, we are not seeing something completely falling down. I think some cases it doesn't get renewed, but it's not a big portion for the large OEMs. Where we see some issue, if at all, is the tier one, which is not a big part of our business, but that's one where there is some kind of volatility. But rest, I think there are many areas of growth, right? India, Asia are still growing reasonably well. So I think overall, I think that should be the balance. And I believe once, whatever, I think a quarter, 3 to 4 months, 5 months, I think things should be on the right course.
Okay, that's an interesting one. So overall, if you're talking about the OEM segment, now KPIT's exposure is really high. If there is a potential slowdown in the R&D investments by auto OEMs, that's what probably will hit a KPI, right? KPIT. What is the trend that you're picking up so far that we've already done the first month of the first quarter of the financial year? What is it telling you?
I mean, what is telling me is there are bigger deals being discussed, there are bigger deals being closed, there are bigger deals being announced. I know there are actual problems on the ground, specifically European OEMs want to really make some change in their ecosystem, build engineering quicker, faster, bring innovation, and end-to-end view. So they want a very reliable partner. There are many OEMs who are struggling for the next year SOP, as we call, and they are very keen to move forward. So if you, I mean, at a generic philosophical level, if somebody is in a problem, then also he needs help, and they are all our very esteemed clients. So we will do whatever we can do for them, and fortunately, we are in a very good position to bring the solutions to the client, and we understand the client requirement very well. So that is one point I would just like to say. The second point, as we have been talking about off-highway and commercial, I think we have started winning few, and we see another place where we can grow. And we have also expanded into few markets which are still building, like either you look at India, you look at some of the other markets which are in Asia, but not China or Japan. And there are certain markets in Europe. So I think there is enough in the world which is okay. And in all these parts of the world, there are different problems to solve. And I think we are in a reasonable position to address those problems.
Okay. In terms of your deals, now with regards to the Mercedes deal as well, what's the kind of scope? Because I think some part of the deal TCV is already included in the third quarter of FY25. What portion would be coming in the coming quarters? And are you expecting further expansion there?
Yeah, I mean, when we, as you have seen in the past, typically we engage with the client on a strategic basis. It's a long-term engagement. We are not on the project-to-project basis. We typically get into a platform or a longer-term program. And so absolutely we see it's a very strategic step, and something on which we will build over the period more.
That's huge. That is a biggie. It's on.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
Welcome back. You're watching India Market Open. But one quick update before we look at stock-specific action is with regards to the Pahalgam aftermath. Now, the Jammu and Kashmir government has gone ahead and shut 48 resorts. In fact, half the tourist sites in Kashmir have been shut down. That's the latest update that we're picking up on that front. And this is mainly on the back of security concerns. So lots of developments that are happening across Indo-Pak border. But currently, tourism is something which will be on the back burner. There could be some bit of an impact as well in terms of the bookings that have happened, refunds that would have to be given out. So watch out for aviation counters. But 48 resorts that have been shut down, more than half of the tourist destinations have been shut on the back of security concerns. That's the latest update that is coming in on the back of the Pahalgam aftermath. But one stock now staying with the IT pack that is in focus is Hexaware Technologies. Let's quickly pull up that stock on the screens and see what a Hexaware Tech is doing in trade. It has recovered from the day's lows. 0.5% up move is what you're seeing on the counter. If you talk about the quarter, the net profit has gone up around 2% in terms of Hexaware. The EBIT margins have been largely maintained. Most of the segments are seeing slow growth on a sequential basis. And if you talk about the second quarter, they're expecting to deliver reasonable but not sharp growth. Revenues up 1.7%. The margins have seen a growth of around 42%, and the net profit number is up around 2%. Their constant currency is down around 2% on a sequential basis. If you talk about the voluntary attrition for IT, that is at around 11.2% versus a 10.8% on a sequential basis. So the attrition has also gone up. Overall, if you see in terms of the growth, travel and transportation, though it's a small segment, that's the only one which has seen growth in terms of double digit, that's 10%. The highest contributor is in terms of financial services, which has seen a growth of around 5%. Healthcare and high-tech and professional services, both of them have seen a degrowth in the tune of almost 1 to 6% respectively, and your manufacturing consumer has been absolutely flat. If you talk about calendar year 25, they've said reasonable growth, but not sharp uptick that could be expected in the second quarter. Third quarter, they are expecting to see some bit of acceleration in terms of growth and to buck up in terms of the usual pattern. In fact, similar was the commentary from KPIT Tech as well, by the second half of financial year 26 is going to be good. Around 1,800 to 2,000 IT people is what they are looking to hire in the second quarter in anticipation of the third quarter ramp up. So that's an interesting aspect that we need to focus on. And improvement in the margins. I mean, 17.1 to a 17.4 number is a tall ask, taking into consideration they are at around 14.3, Alex.
Yeah, very interesting, and certainly something to check with the management as well when we do speak to them. Hiral, another important story that we're tracking this morning that is playing out in the bond market as well. We don't track it enough. We don't track it as much as we do the equity markets. But the RBI has announced its calendar for open market operations in the month of May. And it has announced that in multiple tranches, it will be buying government bonds, and through that, it's going to be infusing a further 1.25 lakh crore rupees into the system. What is the implication of that? Already you've seen bond yields move down. On the 10-year treasury, on the 10-year, not treasury, on the 10-year bond, you have the yield that has come down about 5 basis points from yesterday's close, because the implication is that the RBI is going to buy more, the prices have gone up. So that is a context. Harsh joining in to tell you about the implications for the banking system, because we are already in surplus, Harsh. We're going to move into considerable surplus beyond that. And you've seen that play out in the overnight rates, the call market rates, which have moved below the repo. What is the implication for the banking space?
Well, yeah, just first off to put some numbers in context with regard to quantum of liquidity. 1.25 trillion, which is 1.25 lakh crore, is the liquidity push which is going to likely happen in May. This is quite unprecedented insofar as the last 3 months are concerned. The way in which the RBI has focused with regard to liquidity and push the system, or rather push the liquidity into the system, is one of the key positives which is playing out both on the Nifty as well as the Bank Nifty. Now, in terms of what this means, one, the quantum is unprecedented both in pace as well as in pre-announcements. Mind you, RBI has been consistently making pre-announcements with regard to dates on which they will continue to do open market operations. Second is with regard to durable liquidity. It remains at around 2 lakh crores, so it's certainly not low in that sense. It's returning back to normalized level. But OMO plus RBI dividend could take durable liquidity to over 5 lakh crore, which is another key positive for the banking system as a whole. Announcements seem to be targeting not just the quantum of liquidity, but more so the price of liquidity. And therefore, it's aimed at trying to tweak both the supply side as well as the demand side with regard to credit growth. Could this lead to a stronger credit growth? Well, Citi believes it will likely ensure that there is transmission of rates that happens, both and allowing for good supply of credit as well as demand for credit. So something to look out for.
And you know what else is beneficial is that the mark-to-market gains for treasury for banks is also positive in a scenario where yields are falling. So certainly watch out for that, and also watch out for your hybrid mutual funds, where you have allocation to fixed income. The benefits that you will accrue through allocation to equity and fixed income is certainly positive, because the fixed income component will benefit from the falling yields. But let's talk about another entity in the financial space, Nifty 50 company, Bajaj Finance. The stock is under a tad bit of pressure, down about 0.5% ahead of its numbers. The numbers, of course, I think will come out later in the day, possibly after market hours. But Harsh is here to tell you what to expect. Harsh, we've already seen the print in terms of their quarterly update. What would you be tracking closely for Bajaj Finance?
Well, two things, Alex, which I'll be tracking really closely. One is the margin number. And in terms of the guidance, and that holds the key, right? Bajaj Finance has been on point with regard to guidance, and therefore what FY26 holds in terms of margins. Again, we spoke about transmission of rates, whether Bajaj Finance will be actually transmitting the rate which it gets in terms of the benefit of cost of funds, whether it transmits that or not, will be one of the questions which I'll look out for. Likely, partially, transmission might happen, but how much of that margin can they hold on to in FY26 will be the question. The other piece will be with regard to credit cost. Now, in terms of the way in which credit cost has moved, FY25 has been a tough year in that sense, in relative terms for a Bajaj Finance. But what is the Q4 number going to look like, and thereafter, what does FY26 look like in terms of outlook will hold the key. They've suggested a tapering down with regard to credit cost in FY26. Again, some bit of reiteration with regard to that number of what we can expect in FY26 will hold the key. Overall, you're expecting decent growth. Net interest income expected up 25%. Provisioning continue to remain elevated around the 2100 crore odd. Profit after tax expected to rise by 16%. So That's how you're expecting the numbers to play out.
Right. So that's with regards to Bajaj Finance. The stock is down almost 0.6% as we speak. It's going to be an interesting day. The numbers, though, will come after market hours, so the reaction will come in only with regards to tomorrow's session. So let's see where we are headed from here on this one. But moving on, the other stock that will be reporting numbers is a Trent. Mahima is with us to tell us more. Mahima, what's the expectation? Because Trent has been a spectacular stock to look at in terms of the ups and downs it's seen in its stock price in the last couple of months.
Right, absolutely. So I think it's going to be yet another quarter of sub 50% growth, and I think this is going to be the new normal for Trent. In the past 3 quarters, the average growth has been around 30% when it comes to revenue. This quarter also revenue is expected to see a growth of around 30%, EBITDA to see a growth of 27%, and net profit might see a fall, and this is on the back of 2 things. First, Q4 FY24 had an exceptional gain of roughly 576 odd crore. And this was a one-time gain, and if you remove that part from its net profit, then profits are expected to grow around 2 times this particular quarter. But we'll have to wait and see as to how the overall impact of management commentary of upgradation of smaller store plus overall store addition will have an overall impact on the profitability as well. In terms of Q4, it's going to be, in terms of West Side, it's going to continue to deliver a steady growth. Star Bazaar might see competition playing its role in terms of quick commerce eating share of Star Bazaar. In terms of Zudio, there is expectation that there could be rise in its overall market share, but overall addition of stores might cannibalize each other, and we'll have to see as to how revenue per square feet grows for Studio. And lastly, in terms of competition coming from online players and how competition fares out from tier 2 and tier 3 cities is also something will be a key monitor to watch out for.
Okay. All right. Thanks so much, Mahima, for getting us those details. So keep Trent on your radar. By the way, you had a bit of a cool off in the equity markets as things stand right now. We're just about treading water on the benchmark Nifty 50. We can pull up the intraday chart. So there you go. It's a little bit of chop and churn, at least for the benchmark index. The broader market's also seeing a little bit of a cool off, and pull those charts up as well. The mid cap index trading with gains of about 0.5%, small cap index about that same amount as things stand right now. And really the culprit seems to be the banking pack, which has cooled off from those elevated levels that you've seen now with gains of only about 0.1%. But to talk about the slightly longer term trends in the equity market, I'm joined this morning by Manishi Roy-Chaudhary, the Chief Executive Officer of Emma Capital Partners. Manishi, thanks so much for taking the time. Pleasure having you on the program. Let me start by asking you what your assessment of earnings growth is going to be, because that is going to be the central driving force amidst this elevated uncertainty globally. So we just had a couple of people come through and say that you're likely to see possibly nominal GDP growth being tracked by the top companies, maybe the top 200 companies in India. Do you think that that's going to be the case?
My guess would be that in fiscal 26, earnings growth would possibly be in double digits to early teens. So that's marginally higher than nominal GDP growth. I mean, nominal GDP growth for India is currently in the range of maybe 10 to 11% if you have a longer term time horizon. Usually, corporate revenue growth and corporate earnings growth is slightly higher than that. Because GDP growth is, after all, coming from 3 sectors: agriculture, industry, and services. Agricultural growth is a lot lower than the other 2, but the other 2, industry and services, the relatively high growth sectors, they are the ones which contribute to corporate revenue growth. Right, so I would think that maybe somewhere around 12 to 14% for fiscal 26. We also have to keep in mind that it's coming up from a low base. Fiscal 25 is hardly about 5 to 6%, which is way lower than the long-term average that India has exhibited over the past several years. So, yeah, in a nutshell, that would possibly be my guess about the medium term.
Manishi, good morning. This is Hiral on this side. That's an interesting take. On a lower base, you're talking about a double-digit mid-teens growth in terms of the earnings. However, if you have to look at the tariff-linked sectors, the global sectors that contribute almost 40 to 45% of your earnings, are you factoring in a risk of downgrades to these sectors as well in terms of the mid-teens estimates? And if yes, is there a possibility for downgrade that could be coming in any of the sectors?
In some of those sectors, yes. In fact, I would rather say that the danger to the export-linked sectors in India comes not from the tariffs, but from the potential slowdown that we could see in the United States. Whether it's going to be a recession or a stagflation, we don't know. But there's almost certainly a degree of hesitancy, a significant degree of hesitancy on the part of corporates to invest or for consumers to consume. In that situation, I would think IT services would possibly have a much bleaker outlook than they have had in the past. And we have partly seen that in the kind of commentary that we saw in week before last from some of the large IT companies. So that is one sector I would be careful about. I'm almost certain that there would be earnings downgrades in that sector. For the others, let's say some of the consumer discretionaries or metals, other materials, which are also globally linked, we would obviously have to watch out for how the bilateral trade negotiations play out. But again, I would be more concerned about how global demand pans out, particularly for materials.
Okay, so let me stretch that a little bit, Manishi, and given the context that you've given us, we've talked about earnings growth expectations. We've talked about what the implications of a slowdown in the US will be. And I think you're focusing on that more, as you pointed out, than the tariff situation, because I don't want to put my, maybe, whether you want to put your neck out, but I'm putting my neck out to say that maybe we've heard the worst on the tariff front, right? But having said that, what would you be putting your bets on? Would it be the financial sector? Would it be domestic-focused entities, and what would they be?
I would point out three sectors. Financials, undoubtedly, particularly the private sector banks. Second in line would be industrials. We're likely to see a continuation of infrastructure spend. We would also see an increase in defense spending. We are seeing it all across the world for very unfortunate reasons, and we're likely to see that in India also. I would also point out some of the consumer discretionaries. There's additional money being thrown at the consumers. The most recent tax rebates, now about 12 lakh of income is tax-free in India. And that would necessarily translate to better consumer sentiment for discretionaries, not so much for staples, but more for consumer discretionaries. So those are the three sectors in the medium term that I would focus on.
You did mention about consumer discretionary, and that's where I think you've been positive about. I think the last time we spoke to you back then in March as well. But when you're talking to companies like a Havells, etc., they are of the opinion that the summer has been delayed. The concern is that demand is muted. Now, if you have to look at this kind of a scenario, in spite of that 1 lakh crore coming in the hands of individuals on the back of the budget, you're not seeing that transition happen into purchases. Would you still say that this would be a time to look at consumer discretionary, or would you say that, I mean, on the durable side, or would you say that just stay put for the moment on this sector and wait for things to emerge?
I would think that, for that, economic or fiscal logic to translate into better consumer sentiment, we would have to wait for a few quarters. So maybe in the second half of this fiscal year, we should be seeing that. Right now, there are just too many uncertainties across the world. And we must also not forget that the employment generation situation in India has not really, turned around the corner. I mean, the biggest employment generators were the IT service companies, and there the situation is quite pedestrian, I must say. There are some other areas like the GCCs, the global competency centers, which are doing a lot better, and there's a, likely a skyrocketing expansion likely to happen over there. So it's kind of a mixed bag, but once these two things get sorted out, when the money actually flows into the hands of the consumers, there's also a new pay commission, which would revise the compensation of the government workers. So all this is falling in place together. And, when we do have some degree of turnaround in the employment generation situation, that's where we would be able to, sort of hang our hats on the consumer discretionary sector. But I think we should be able to see that in about a couple of quarters from now.
Manishi, how would you play the consumer discretionary then? And would it be, for example, would it be air conditioners? Would it be the allied companies? How would you play it?
Mostly, I would say autos, household goods, and even the value chain, the manufacturers, like the EMS companies, the electronic manufacturing companies. So, consumer discretionary is obviously a very large sector. I mean, some, analysts, some investors would also include the paints and other, sort of quasi-commodities or the process industries there. But I am looking at a slightly more restricted definition. So autos, more the four-wheelers than the two-wheelers, and, some of the household goods. Those are, the kind of core focus that I have. So, yeah, I think that's what the investors should look at. One should be careful in this sector about valuations also, because there is a wide range as far as valuations are concerned, particularly when it comes to growth-adjusted valuations. If you look at the future earning growth over the next 2 to 3 years and juxtapose it to the price earnings or price to book multiples that these companies are trading at, that measure is actually what one should look at.
Yeah, just to follow up on that, since you've talked about autos and a few of them in focus, Maruti Suzuki, for example, had a bit of a soft quarter. Tata Motors has been under this pall of gloom, if you can call it that, because of Jaguar Land Rover and the implications of auto tariffs. So therefore, if anything, if I were to point out one company in the automotive pack where valuations have taken a real battering, that is Tata Motors. Where do you find comfort valuation-wise? What names are you looking at? And not recommendations, but what names are you studying closely?
I would definitely look at the market leaders in the domestic focused sectors, so then the names pretty much become obvious, right? Because we think that market leaders which have pricing power, they are the ones which would be able to weather the storm in a far more efficient manner. That is if in every sub-segment of the auto industry, if one looks at the market leaders which have a significant moat, protecting their market share and their margins, then I think that's almost a surefire way to, to invest, to look at this sector.
Manishi, interesting point that you mentioned about, what's happening on the valuation front is what you need to consider as well. So far, with the companies that have already announced numbers from Nifty 50, would you say that it's weak corporate performance, or how would you, actually talk about it? And from here on, do you see further room for, valuation cut that could be coming in, which would then make your Indian markets much more attractive?
In fact, to both your questions, the answer would be yes. I would think that this particular quarter that we're right now in the midst of would not be too great. We have seen the large cap frontline IT companies. There's been a bit of a disappointment over there. We have seen some of the large consumer staples companies, which have also talked about a continued, not quite a slowdown, but kind of a pedestrian demand situation over there. Now, when we come to the big banks, that would be the real test. But on the whole, I would not be very positive about this particular quarter. I also think that this quarter, the Jan-March quarter being reported now, is possibly the worst. After that, some impact of the cash coming in the hands of consumers, some impact of government expenditure in infrastructure would begin to seep through into the economy and demand. So going forward, the April-June quarter, and particularly the July-September and the subsequent quarters should be better. Now, the valuation question is interesting because India was recently, if you go back to around mid-March or so, or early March, the Indian valuations relative to the Asian peers had actually come down to reasonably attractive levels. They have again shot up. So I would think that if the valuations do come down, and I would expect them to, sort of moderate a bit further, then that would be a more attractive opportunity for investors to enter.
Okay, so Manishi, I don't know if I should be asking you this. If you're seeing further pressure in terms of valuations that should be coming in, or the valuation should get richer, I would say. I don't know how to put that one for you, but if we are going to wait out for, valuations to come down further, what are the levels that you would be tracking in terms of Nifty? Because it's sporadic right now, right? So what is that fair perspective in terms of Nifty and Bank Nifty according to you?
Right. So, the way I tend to look at it is actually relative valuations. Relative to, let's say, the Asian peers, like the valuation of MSCI Asia ex Japan or any other large frontline index. On that perspective, India is currently at somewhere around 55 to 60% premium. The average premium, if you look at the last 15 years, is somewhere around 40 to 42%. So that means that if this premium comes down, suppose the Indian market declines somewhere around 8 to 10%, or if the Indian market stays pretty much where it is, but the other markets in Asia, and particularly the large markets in North Asia, move up significantly, I think that would be, possibly a more relevant way of looking at this.
Then let me ask you this. The reason why people are maybe ascribing that higher multiple as things stand right now is perhaps what CLSA said, which is the return of TINA. There is no alternative. In elevated uncertainty elsewhere, people are looking at a growth story in India. Even at a slower pace, you're talking about 6% growth. So do you think that therefore those higher multiples are warranted?
There's some merit to that argument, no doubt. Because we are seeing these tariff-related uncertainties, which are much higher in rest of Asia, and particularly more so in Southeast Asia and pockets of North Asia, like Korea and Taiwan. But at the same time, one has to sort of consider what is an appropriate premium. Is it 40%, is it 50%, or is it 60%? I would be more comfortable, especially with the current earnings growth profile, if it's really 12 to 14%, going forward in the foreseeable time horizon, and I'm playing about 20 times P multiple, I would be a little circumspect about jumping into the market right now. Also, if we do see bilateral trade negotiations being actually, being put through and being successful over the next maybe 3 or 6 months, then some part, I mean, not all, but some part of this, tariff-related uncertainty could actually settle down. And therefore, the markets which are looking really suspect right now, they could again come back into.
Okay, I think we just lost Manishi right at the last moment, but the point that he was making is well taken. Manishi, thanks so much for joining in. By the way, if some of you were listening to me say Tina and saying ye kaun hai, what that actually means is there is no alternative. And CLSA put out a note recently saying that in the global context, amidst this elevated uncertainty, it seems like with the capital moving out of the US, the Indian equity market is looking more attractive because there is no alternative. That is the point.
That is the point. And if valuations are expected to come off further, I mean, we should be bracing for some correction. It could be a blip, but there could be some bit of consolidation, some bit of correction that could be on the cards. And this is taking cues from Manishi, what he is mentioning. And probably you could probably be sitting on some bit of cash to put in and take your positions once that time comes in. But completely out of time. With that, it's a wrap on this edition of India Market Open. Thank you from Alex, the team that put this show together, and myself. In fact, lots more lined up on the other side. If you have any queries on the stocks that you're holding or you want to buy, please log on to the next show, that is Ask Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy?
Welcome, you're watching NDTV Profit. I'm Mahima Vachrajani and this is Ask Profit. Before we move on to the queries for the day, let's take a quick look at as to how the markets are panning out to be. Well, in terms of the Nifty 50, trading almost at its low point right now. The Nifty 50 did take a hit around at 9:45 odd AM, and since then it's turned into red, trading around 0.6% lower. In terms of the Sensex, let's pull up that. Of course, moving in lockstep with the Nifty 50, down by about 0.1 odd percent, almost trading flat. Let's pull up the broader market and see the Nifty small cap 250. It's trading almost 0.3%, 0.4% higher. The mid cap 150 is trading flat as well. In terms of the Nifty mid cap 150, it's trading around 0.2% higher. Let's also pull up the Nifty heat map and see as to what counters are buzzing in trade today. There you go. There's Ultratech under pressure on the back of its earnings. There's Dr. Reddy's under pressure, Nestle under pressure. But some counters doing well. Reliance holding up by about 1.6 odd percent. There's L&T up 1%. Indocent also holding up by about 1 odd percent. Let's also pull up the advanced decline ratio. Well, the graph is quietly skewing towards the declines, and right now we have around 1200 odd advances versus that of 930 odd declines. Let's also pull up the sectoral heat map and see how our sectors faring in trade today. Well, in terms of the overall sector view, Nifty Defense is at its 8th month high, up by about 3 odd percent. There's Nifty Oil and Gas for second day in a row, trading in green, up by about 0.7 odd percent. There's Nifty PSU Bank up by about 0.4 odd percent. Nifty Energy, Nifty Bank also doing pretty well in trade today. Something that's not doing well, there's Nifty Pharma down by about 1.17 odd percent, Nifty FMCG down by about 0.5 odd percent, Nifty Metal down by about 0.3 odd percent. Let's also pull up the BSE 500 and see what counters are leading the overall markets. There's Paras Defense up by about 8 odd percent. There's Whirlpool India up by about 8 odd percent. PNB Housing on the back of its earnings, data patterns. So a lot of defense names, of course, buzzing in trade today, followed by banking names. Something like a Prestige also doing well. Something that's not doing well, there's Sterlite, there's TVS Motors, Hudson Agro, AWL Agri business on the back of its volumes not picking up. Sterling and Wilson or a Pharma down by about 3%. So that's with respect to where markets are concerned. With that, let's also welcome in our guest for the day, Kush Bora, founder of kushbora.com, and Astha Jain, senior research analyst at Hem Securities, joining us now. Welcome to both of you and a very good morning to you. Kush, I'll come to you first. There's a significant amount of beating that we've seen in the past few odd minutes in the markets. How are you reading the charts right now for both Nifty as well as the Bank Nifty?
Hi, Mahima. Hi, Astha. First, a very good morning to you and the viewers. Well, I think there is this time for consolidation. We've seen the Nifty correct quite sharply on Friday, then a rebound, I think. But the range has now been cast, which is 23,800 to 23,900 support zones on the downside. On the way up, this 24,350 is proving to be a bit of a resistance for the last 3 to 4 sessions. I think even today, if you don't close above that, then there's a possibility that this might be the line in sand to test. On the way up, you're looking at 24,800 as the next possible target for the Nifty. So consolidation with positive bias is something that I'm going with. Any dip towards the 24,000 mark should be taken as an opportunity to accumulate with a stop loss around the 23,800 level.
So that's the view with regards to where charts are concerned for the Nifty 50. Let's take the first query of the day. Shashidhar from Bengaluru is writing. He's holding around 150 odd shares of Kaynes Technology, bought at 5,600 a piece. He's sitting on a profit of roughly 46,000 odd rupees right now. He wants to know whether this is a good stock to keep holding for the next 1 year in terms of fundamental analysis. Astha, I'll come to you on this one. Jefferies did hike its price today for this particular counter at 6,600. Do you also agree to that kind of hike in target price?
Hi, good morning to all of you. Talking about Kaynes Technology, I think fundamentally it is a very, very strong counter. Now the reasons behind it, first of all, robust orders which they are having, which gives us strong revenue visibility. So I think and what we can see in the near future is that we can see a strong rise in the margins as well. So I think these all factors will really help the company in instilling good performance in the future, whether it is stock wise or whether it is financial performance wise. Definitely a hold from our side with a price target of 65.
So that's the view with regards to where Kaynes Technology is concerned. Our next question is from Iam, who's writing in from Riyadh. He's stuck at Gensol Engineering is what he's saying. He's bought 40 shares at 830 a piece and wants to know as to what should be the next course of action for this particular counter. Asa, I'll come to you again for this. The entire saga of Gensol Engineering seems to be never ending. There was a raid that happened at their Ahmedabad and Gurgaon office yesterday. And we're seeing the impact of that on the counter as well. Do you think that it's the right time to exit the counter now?
Yes. So first of all, I would like to know the cost price. What is the cost price for this counter?
It's at 830.
830. Okay. So I think here the price has fallen a lot from the cost price, definitely yielding a very strong losses. So idea here is, yes, a partial exit can be done because these kind of fundamental news and the day-to-day news which is coming in this counter is not keeping well with the counter, and we are seeing continuously a downside momentum. So yes, one can partially exit from the counter. Yes, the losses will be high, but I think there are various good counters where one can make the entry in. Whatever losses they will be generating in this counter, that will definitely recover from the other good counters, in which we find bank to be very, very strong. ICICI Bank being our the top pick, and I think one can make entry at that counter. So definitely some losses can be recovered.
Okay, so that's the view with regards to where Gensol Engineering is concerned, and Asa has given her picks against that. For viewers, just a quick reminder, you can either call us on the number that's flashing on your screen down there, and also WhatsApp us your queries on the number that's flashing above on the screen. Let's take the next question then. The next question is from Mohammad Ali. He's writing in, and his question is on Adani Green, holding around 850 in quantity, and wants to know whether he should hold or book his losses right now. He's bought it at elevated levels of 1,400 rupees right now. 1,400 rupees. In terms of charts, Kush, I'll come to you. What are the charts indicating for something like an Adani Green?
So for the last 2.5 months, to 2.5 months, the stock's been consolidating within this band of 850 on the downside to about 975 on the upside. My suggestion would be continue to hold. If it's a positional trade, then you might want to keep your stop losses at the lower end of the band, which is 850. If that gets broken, then I think this consolidation might perhaps fizzle out. But if the 975 upper end of the range is tested and is broken, then the stock could head higher. I think his buying price is slightly elevated, so he might have to start exiting, in a loss. But a good level to start exiting is about 1050, and then about 1200 or so. So hold on, 855, 850. That's your stop loss. You could see further momentum once the 975 threshold is taken out.
Okay, standard disclaimer, Adani Green is also a part of the overall Adani group of companies, and NDTV is also owned by the Adani group of companies. Let's take the next question then. Sanjay from Delhi is writing in, he's holding 12,500 odd shares of Ratan Power and wants to know whether he should hold or sell. Asta, I'll come to you. Any view on this particular counter?
So yes, Ratan India Power is the counter which he's talking about. I think one can remain invested in the counter because what we feel that the kind of tailwind the industry is having, I think definitely can help the company in moving ahead from present levels. So just on the basis of the power sector which the company is operating in, and it is a small ticket size stock. So I think there is no sense of exiting at this point of a time. Remain invested in this counter. However, would like to see the results, and in case if results will come on the expected lines, this stock can move up till the level of 12 rupees to 13.
Okay, that's the view with regards to where Ratan India Power is concerned. Our next caller, Govind is calling in from Hyderabad. Govind, a very good morning to you. How can we help you?
Yeah, very good morning, madam. Very good, all of you, sir. Yeah, actually, I have Reliance Industries 200 numbers at the rate of 1220 there. Can I add some more, madam? At least 300 to 400 shares for long-term investment for 1 to 2 years.
Okay, got your point, Govind. I'll quickly go to Asta on this one. Asta, RIL came with its earnings yesterday. What was your reading? And Govind wants to know whether he could add more of this counter to average out.
Yes, because the results that were come were above the expectations. So we were very much positive on that counter. And we expect that this counter has a potential to move till the level of 1435 to 1450. So these are the price targets which we are giving or recommending to our clients for this counter as of now. So definitely on dips, because right now also what we can see that this stock has already up by 2%. It's better to take or accumulate it on the dip at around the level of 1380 or 1370 odd levels. But yes, this stock has a potential to move till the level of 1435 to 1450 and in the longer term 1500 levels.
Okay, so that's the view with regards to where RIL is concerned. Our next question is from Rama Mohan, who is writing in and asking about Amara Raja. He's holding 64 odd shares bought at 1203 a piece. And he's a long-term investor is what he's saying. So he wants an outlook on this particular counter. Asta, I'll have to come to you again. What's the outlook like for something like an Amara Raja?
So what we are seeing in this space, that is the battery space as a whole, there is a strong momentum which is going on right now. Now, if I talk about this counters especially, I think this counter is a good long-term story as they are the flagship company of the Amara Raja group. And we know that there is a strong demand in the lead acid business. And I think that will help the company in posting good numbers. So and this business, basically, if I remember correctly, it contributes 96% of their revenue. So I think there is a good demand in this segment, and this will help the company posting very good set of numbers. I'm very positive on this counter, and we are recommending a hold. Good long-term prospects are there. Right now, it is quoting 995. We are expecting this counter to move till the level of 1150 to 1200.
With regards to where Amara Raja is concerned, our next caller, Vasu, is calling in from Tamil Nadu. Vasu, a very good morning to you. How can we help you?
Good morning, ma'am. See, I'm calling from Coimbatore. My name is Vasu. I'm holding Shriram Finance 1,000 shares at 641.33. What is the future?
Okay. Vasu, just help me understand one thing. Are you a long-term investor in this particular counter?
I can hold for 3 months.
You can hold for 3 months. So you want a technical view on this particular counter. All right, Kush, I'll come to you. Shriram Finance posted its earnings yesterday. In terms of how Q4 panned out, well, PAT was completely a miss on the back of higher credit costs. But this is where fundamentals are concerned. But with respect to where charts are concerned, how are you reading them? Do you think this is the right time to enter or keep holding?
So I think you should continue to hold with the stop loss around the 590 mark. Now, while as you've pointed out that the numbers weren't really to the expectation of the street, some of it was already showing in the price where you could see two legs of a negative RSI divergence. So even as the stock was moving higher, the strength was actually starting to wane off, and hence you are seeing some sharp profit taking in the last 3 to 4 sessions. Today also the stock is lower, but it's trying to hold above yesterday low that it had made around the 595 596 mark. Hence, with a bit of a cushion, 590, that should be a stop loss. The medium term trend in the stock is actually quite favorable, quite bullish. So I would hold on. If 590 is taken out, then this trend could be negated and the stock could head lower. But with a 3-month time horizon, I think there is sufficient time for the street to absorb these results and perhaps move higher as well. So with 590 as your stop loss, continue to hold Shriram Finance.
Okay, continue to hold is the view coming in on Shriram Finance where technicals are concerned. Our next question is on Tejas Networks. Ekam Barai from Hyderabad is holding 150 odd shares of Tejas Networks at 1204 a piece and wants to know whether he should continue to hold or book a loss since the results were not very good. Asta, I'll come to you on this one. I had a cursory glance on this particular counter. In terms of the net loss, it did come down. I mean, it was a net loss of 71 crores versus a profit of 147 crores, and the EBITDA was down around 61%. Not sure as to what went wrong with the counter, if you had the chance to look at the earnings and of course the outlook for the counter.
Yes, we did look at the earnings, and there is one more point. In fact, in their quarterly results also, they have posted losses if I exclude other income extraordinary items, and for the full year also, it is a loss in the books. And now what we believe, along with this loss, the company is quoting at a very high price to earning multiple. If I compare it to the industry average of around 29, they are quoting at a price to earning multiple of 27. So I think along with the poor financial performance, the valuation seems to be stretched at this point of a time, and definitely that makes the case for the stock to fall more. So yes, Tejas Network is looking right now in the downward momentum. Maybe the stock can fall till the level of 700 to 680 odd levels. But if the view is purely long term, that is more than 8 months or a 12-month view, then a person can remain invested in this company.
Okay, remain invested if you are holding this stock from a longer term perspective is the view coming in from Astha on Tejas Networks. Our next caller, Shweta, is calling in from Andhra Pradesh. Shweta, a very good morning to you. How can we help you?
Hi, very good morning, Megha. My question is regarding Castrol India.
Okay.
I have 240 shares at 208 rupees.
Okay.
I would like to know if I can add more. And I want both, if possible, I want both fundamental and technical view about this stock. I would like to hold it for long term.
Okay, you would want to hold it for the long term. Then I'll go to Astha quickly. Astha, in terms of Castrol India, because they follow the calendar year, it was the Q1 results for them, where overall earnings, stable volume growth was there, and this was despite of the external pressures. Plus, there were new launches, and they've also expanded their distribution network. What's the view with regards to, of course, the Q1 earnings, and from a longer term perspective, should she continue to hold the counter?
One can continue to hold the counter, but please don't add more. Why? Because the results were not that exciting. If I look after Q4 numbers, it was merely a single digit growth, that is less than 5% growth in the bottom line. So the results were not that encouraging. And in fact, on the volume front also, we are not very much optimistic as of now. So yes, one can remain invested in this counter for the longer term, but please don't add more at the present level, because we feel that the counter is poised to move more down side from here.
Okay, so that's the view with regards to where Castrol is concerned. Our next question, Kush, this one's for you. Tata Motors is the counter. Amar has bought 50 pieces at an average price of 876 and wants to know as to when can he expect his break even, because he's been holding it and sitting on a loss of 10,000 rupees right now. What's the view like where charts are concerned for something like a Tata Motors?
Well, I'm afraid the outlook is not as rosy or as positive as he'd like it to be. I mean, the buy price is close to the 200-day moving average, which is some distance away. If at all, you can take heart from the fact that we've spoken a few times on the show on the channel that 600 is a historically strong support zone, and by that I mean historically, as in for the last 7-8 years, that's the kind of level that the stock has respected. Even this time around, if uh, if you give a concession of a couple of sessions, the stock actually respected that 600 level and is starting to rebound from here. Momentum seems to be picking up, but I think given the kind of massive downturn that the stock has taken, you will see selling pressures along the way. So it could be a while before he sees his price, 2 maybe 3 quarters on the way up. What I would suggest is that if you want to lighten your positions, then 695 is one level where you should start considering. 750 is another level to consider to go light on the position. You will obviously be incurring a loss, but it will be relatively lesser to what you're incurring currently. So with a positional stop around the 600 mark, keep exiting at these levels, as the stock moves higher.
Okay, so that's the view with regards to where charts are concerned for Tata Motors. Our next caller, Bala Murugan, is calling in from Chennai. A very good morning to you. I believe you have a query on Canara Bank.
Yes, madam. Good morning, madam. I want the technical perspective of Canara Bank, madam. I am holding 920 shares, madam.
Okay. I'll take this up with Kush then. Kush is holding 920 shares, bought at 102 a piece. The stock is currently trading at 100. What do you think? What are the charts indicating?
It's a very clear hold. For now, if you see the run up in the stock, in fact, in the entire PSU pack, it's been very encouraging. And if you were to ask me my top picks in the PSU pack, it will be SBI, then followed by Canara Bank. So fairly positive on this one. I think you should keep a stop loss around the 95 mark. The reason you're seeing some resistance at the moment is because markets have also seen some sort of profit booking. There is some cool off in the banking space after a month and a half of stellar run. And for specifically, about Canara Bank, the 200-day moving average is at 105. Plus, also you'll see some congestion of call writing, happening alongside. That's why the stock is just resisting around the 100 mark. I think once that is taken out, the stock could boom past his buying price to levels of 105, perhaps even 111. So continue holding on Canara Bank. The structure is fairly positive. Some consolidation that you're seeing right now is par for the course.
Okay, so that's the view with regards to where Canara Bank is concerned, and hold is the view coming in from Kush. Our next question is on defense counter, that is BEL. Giri Rao has bought 22,250 shares at 267 a piece and sitting on a significant profit of 10.9 lakh rupees at almost 11 lakh rupees right now, and wants to know whether he should hold or book profits and exit. He's a long-term investor, at least 5 years is what he's saying. Asta, I'll come to you on this one. Defense is on a roll since the past 2 days. I mean, it's over its 8 months high right now, the entire Nifty defense right now. But with regards to where BEL is concerned, should he continue to hold for the next 5 years? He's already sitting on a profit of handsome 11 lakh rupees.
Yes, I think now there are 4 or 5 points behind it. First of all, government trust on defense, especially manufacturing and electronic defense space. Secondly, the robust order book the company is having. Thirdly, their share in the defense, especially if I talk about the electronic share in the defense, that is also very high. And I think the fourth point is about the leadership position which this company is enjoying in this space. Their order intake is around, I suppose, 10,000 crore. So I think all this is cumulative order intake, which I'm talking about till February or March. So all these things are pointing towards a strong future of this counter and the strong revenue visibility as well, as because that is also very, very important. So yes, one can remain invested in this counter. However, would like to give the immediate targets, which can be at around 350 to 370 odd levels. But in the longer term horizon of 5 years, the stock can be a multi-bagger from the present levels.
Okay, so that's the view with regards to where BEL is concerned. Our next caller, Alex, is calling in from Kerala. Alex, a very good morning to you. How can we help you?
Good morning, ma'am. I have a query on RailTel.
Okay.
I am holding 140 shares at the price of 363.
Okay.
I need a fundamental view on this one. Actually, I taken it as a railway stock, but when I looking at the stock, it is into this data center business also. Is it okay to hold for data center business, or I need to add another stock for that data center business like Anandraj?
Got it. Asta, I'll come to you on this one. Railtel is the counter. What he's asking is that should he stay invested in this particular counter, and he also wants an exposure to data centers. So what do you think? He should continue to hold this counter or add more for something like an Anandraj?
So I think this counter one can hold at least till the results, and when are results expected? I think 1st of May. So they are scheduled to come on 1st of May. So there is no harm in holding this stock at least till that time. Now the other positives about this counter is the continuous receipt of order which this company is getting, and in fact whatever results they have shown in the Q3 also, they were also very decent. So all in all, I think the Railtel is the counter which one can remain invested in rather than going with the Anandraj at least till the results come, and then again he can ask his query in the show after 1st May.
Okay. Srinidhi from Udupi, Karnataka is also writing in, and she's bought Anandraj at 528 a piece, and she wants to know whether she should stay invested in this particular counter or not. Kush, I'll come to you. The stock is doing well in trade today, up by about 2.5%, but the overall trajectory for this particular counter has been pretty topsy-turvy. Your view with respect to where charts are concerned for Anandraj?
I think after the kind of massive fall from those 925 levels, the stock is now trying to find its feet. If you see the last 2-3 months, it's held on to 425 for the most part. So I think that's a positional stop that you should have on Anandraj. Sideways consolidation for some time cannot be ruled out, especially because on the way up, the volumes haven't really been as encouraging. In fact, on some of the down days, the volumes have picked up. So I think there could be some consolidation. I don't see a runaway rally coming on Anandraj, anytime soon. So keep a positional stop loss near the 425 mark. If that's breached, then you're better off exiting this one. On the way up, resistance is around the 550, and then the 650, 645 zones will act up. But as I said, there's a possibility that for a quarter or two at least, the stock could just move sideways within these levels, within these bands that I just mentioned.
Okay, so that's the view with regards to where Anandraj is concerned. Our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Very good morning, madam. Thank you very much for taking my query.
Our
I
pleasure,
bought Dodla Dairy.
Yeah.
The recent fall about 8-10%.
Okay.
At 1098, I bought 200 shares.
Okay.
The last week.
Okay.
So I want to add more. What is your view, considering that it is one of the lowest if we compare to other consumables and similar industries?
Okay.
Compared to Arts and Agro or Heritage Food or Dr. Baker. Dr.
Mr. Becker's, yes. Mrs. Becker's, not even Mr. Okay, I'll take this up with Astha. Astha, so what he's trying to say is that he's already holding 200 odd shares of Dodla Dairy and wants to understand whether this is the right pick from the entire dairy space. There's Hatsun Agro as well as Heritage Foods that are peers of this particular counter. Do you think that he should stick to this one or shift to something like Hatsun Agro or Heritage Foods? And he's also mentioned Mrs. Becker's.
I think this is also a good bet buy because they have earmarked 28 crores of capex. In fact, their 9 months results were exceptionally well. They are now expanding their footprints in the Maharashtra. So I think looking after all these numbers, and in fact, they have got a very good demand. Healthy festive demand has led to the strong set of numbers which they have posted in the quarter gone by. So looking after all these factors, I think it's better to stay invested in this counter. So let this counter be continue in your portfolio, maybe for another 10 to 15% upside from here.
Okay, hold is the view coming in on Dodla Dairy where fundamentals are concerned. With that, it's time to slip into a very short break, but we'll be right back answering more queries on the other side, so stay tuned.
That's huge. That is a biggie. It's
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Hello and welcome. You're watching KYC. Now, a lot of the companies that we've been speaking to and speaking about are inward looking, and therefore, to some extent, if at all, that's still part of the equation in terms of investment. It's also tariff insulated in that sense. So let's look at PNB Housing today actually. So interesting because we've seen a turnaround in the business of sorts, very strong numbers that we've seen, 2.5% plus on the ROA number. Can that sustain is the first big question that we'll ask. The second one is, what's the expected credit cost as it normalizes? This is the provisioning number which hits your profit and loss account. So what that number is going to be as it normalizes. They're going into slightly new businesses as well, newer geographies as well. Does that at all impact your credit cost in terms of expectations? The third piece is with regard to risk within the affordable housing finance segment, and this is something of an additional point to what we just covered with regard to credit cost. As it normalizes, what's that kind of number that we look for? What's the possible risk to growth? Because growth has been tough in terms of visibility, at least over the last 3, 4, 5 years. Can that change going forward? That seems to be the guidance. What will be the levers and what gives the comfort that growth is back for good? Now, in terms of the fifth point, asset quality has improved substantially. Can this kind of number start to sustain? Is this the realistic number that we look for? And last off, most importantly, from an investor perspective, are valuations at this point looking fair? That's really the question we'll try to delve upon. And in order to start and try and break this down, as always we do, let's look at the metrics that we'll look at when you're looking at a PNB Housing. Before we look at metrics, let's look at the company itself. First, what do you look at? It's the third largest housing financier in the country. It has around a 98.5% within its entire loan book base. It's got around 98.5% of retail loans. So predominantly is doing retail at this point. It's in that process of going into retail, and rather has now almost completed that process. Within retail, individuals is roughly 72%, and non-housing loans are around 28%. Okay, when we're looking at a further split within the individual mix, look at self-employed, which is 39%, 61% is salaried. So that's a fairly healthy mix on both sides. You may want to have a little bit of more salaried in that segment. In terms of the lending split, around 75,000 odd crore in terms of the loan book value. Prime loans, prime markets are around 55,500 crore. Emerging markets are around 14,125 crore in terms of book size. So around 20% is emerging markets, and roughly 8 odd % is affordable housing. And this book is growing extremely fast. It's grown from 1,000 crore to 5,000 crore in the matter of a year. So watch out for that one. How will that impact margins will be one of the questions that I'd be curious to understand. 356 branches. They had 300 branches at the end of FY24, currently at 356. This is how the branches stack up and the AUM stacks up. Maharashtra is the predominant force in terms of loan share, 22%. Tamil Nadu at around 11.5%, Delhi at around 11.1%, Telangana at around 9.1%, and then so predominantly the top 5 states, and I'll read them out. Tamil Nadu, Maharashtra, Delhi, Telangana, Karnataka account for 60% of the loan share for a PNB housing. Something again to keep in mind. How do they sell? How do they go distribute? In-house distribution is around 53%, and direct selling agents is around 47%. That's how the distribution mix is playing out. Let's look at the borrowing mix, and this is where it becomes important because it will start to impact your cost of funds. So something to look out for. National Housing Bank roughly 13%, term loans is 38%, ECB is around 6%, deposits is around 28%, also the largest deposit taking housing financier in the country. NCDs is around 10 odd %, and then you have certificates which account for roughly 5% odd. So that's how it kind of stacks up in terms of borrowing mix. Let's look at the metrics we'll track today. You have income statement, you have balance sheet, you have operational metrics as we do with all lenders, and we look at asset quality as well on this one. We'll also look at shareholding pattern, valuations, street cred, and street coverage. We look at all of those and try and break it down, and thereafter speak with the management and try and get a perspective as to what can be expected on some of the apprehensions that are there with regard to a PNB housing as well. What are the risks like? But let's start off with an income statement. You know, the net interest income growth has been roughly 16 odd % on a year-on-year basis, CAGR 3-year. That's how the NII growth has been. It's not been very impressive for that top line number. You'd want a better number, but the last 3-year CAGR looks okay. The last 2 years is just 20% absolute. So just about maybe just about single digit in terms of compounded annual return. So something to look out for. But what's really driving the numbers with regard to PNB housing and the profitability number is the provisions number. Provisions have come off sharply. The book has improved quite sharply. Now we're starting to see recovery start to play through. So they are playing an active role with regard to ensuring that recoveries which they have provided for earlier, all the recoveries have started translating on the PNL and are impacting the PNL also. Let's pull up the profit after tax number, and there's a negative 158 crore of provisions. So that's a write back of around 158 crore. The profit after tax is sitting at around 1,936 crore. So not only is it inflated with regard to the 158 crore, which is the net of the provisions made this year versus the recoveries. The recoveries are roughly 360 odd crore for the current financial year. So not only is it that, but the profits have seen a bit of a boost in FY25 on the back of those couple of factors. So profit after tax has gone up 32% over the last 3-year CAGR, but that's also because of this recovery number, something to be kept in mind. So thumbs up with regard to this, because you have decent growth on the top line, provisions which are credit costs which are not translating to the PNL, which is a positive, and then you have profitability which is seeing a surge. may not be fair to look at this profitability standalone, but nonetheless you are expecting FY26 also to continue to see recoveries, and therefore you might see this profit as something which is more normalized in any case. FY27 will be where the real test starts to play out, where the income statement profitability is concerned. So we'll give this a thumbs up for now. On the back of that, let's look at the quarterly numbers as well. Q1, Q2, Q3. The NII number has gone up in a phased manner, fairly decent between Q2 and Q4. Provisions have largely seen write-backs in Q1, in Q2, Q3 and Q4, and profit after tax has been quite steady in that sense, with Q4 being the real outperformer, which is why the stock also buzzing in trade. Now let's look at the balance sheet, and this is where it starts to look slightly difficult. Let's look at FY23, FY24, FY25. No significantly sharp growth that we are seeing on a book size which is decent. You know, we have a Bajaj Housing as a comparable which is growing at a far faster clip. We have some of the smaller ones which are maybe a third of the size of a PNB Housing, which are also growing at a faster clip, but PNB Housing in terms of growth has dragged. Can that change? That's what the management seems to be suggesting, but we'll have to wait and watch whether that does. So the AUM growth currently, 3-year CAGR, is just 7% at this point over the last 3 years. So what's happened to capital adequacy as a result? It's gotten better because profitability metrics have gotten better while growth hasn't happened. So you're seeing a decent amount of capital build up within the company, but growth is where the concern seems to be. Let's look at operational metrics now. Let's look at the margin number. It's largely been steady over the last 3 years, which is a key positive, but it's maybe a minor negative from a perspective that your rates have gone up. You would want at some point, as the rates come down, for your margins to likely get better. Can they do that? Is there scope for that? Will be the question. Your ROA number has consistently gone up from 1.6 to 2.6%, led to a certain extent by recoveries that are playing out, but also by better operational performance. For sure, that is evident. Look at cost of borrowing. From 7.5% in FY23, your cost of borrowing is currently at 7.9%. So your cost of borrowing has gone up, but has come off from the FY24 levels. Can it continue to come off, and by how much will be the question. Spreads largely have come off, also likely because there's a lower risk build up there. OPEX to assets has gone up as they push retail and push towards branch expansion. Some of these metrics versus some of their competitors look okay, all below what one would expect in terms of at least OPEX to assets, well in range, and therefore we've given these operational metrics a bit of a thumbs up. We've seen an upward bias to margins in FY25. We've seen an upward bias to ROA as well. Cost of borrowing has been largely steady, and spreads too have been largely steady. So positive when you're looking at FY25, which is the short term. Positive when we're looking at the long term. A clear thumbs up with regard to this. Let's look at asset quality. Now this is where it starts to get fascinating. Your gross NPA ratios have come off from 3.8% to 1.08% in FY25. That's truly impressive. When I'm looking at the sequential numbers as well, Q2 1.5%, Q3 1.19%, Q4 1.1%. That's the gross NPA number. The net NPA number also looking equally good. 0.8% in Q3, 0.69% in Q4. So an improving trend on some of those metrics. Something to look out for always when asset quality is concerned. As it improves, you would start to see more confidence come in for the bank to grow as well, or a financial institution to grow as well. Whether this is the normalized level that one should expect in terms of a number is something that we really need to keep our eye out on, or whether, given that they are going into new spaces, whether we're looking at some amount of adversity which could start to creep through as well, and therefore where would the NPA numbers be, is something that we'll have to look out for as well. now in terms of, let's look at the shareholding. And this is where it also gets a bit interesting. You have the promoter holding at around 28 odd %. You have General Atlantic, which owns a stake in the company, mind you. You have promoters which currently own 28%, and within that promoter holding, I'm just going to try and spell it out. You have Punjab National Bank, which is the promoter entity which holds PNB Housing. But outside of that, within the FI holding, you have General Atlantic, which holds roughly 7.5%. That's Government of Singapore, my apologies. General Atlantic holds roughly 5 odd % of the company. So again, there's a decent amount of FI interest in this one. Something to look out for again. There's a decent amount of DII interest as well. You have lots of mutual funds which own a stake here. There's an Aditya Birla Sun Life, HSBC Small Cap. You have Nippon, you have HDFC, you have Axis. All of these hold decent chunks within the company, and therefore it's got a decentish participation. But the promoter holding is 28%. They borrow largely on the back of PNB being the key promoter here, and that's why their borrowing cost is low in comparison to some of the other housing financiers. Again, that's something to look out for, because this promoter ownership of 28% likely to stay steady, but any change there could well impact the numbers for PNB Housing. That's how it's playing out. Currently, the public holds around 20.5% stake in PNB Housing. So that's shareholding done. We'll give that a neutral, given the risk. Let's look at valuations now. Let's keep three things in mind. One, your asset quality has improved sharply. That's a positive when you're looking at valuations versus some of the others. Point number two, you're looking at growth which has not been coming through, at least over the last 3 years. So on that count, the slower growth merits a lower valuation, and that's what it is, the 1 year forward PE. And three, you want to see a smaller book grow at a faster clip, but with new businesses coming in, there could be increased risk. So those three factors to be looked out for when you're looking at valuation. 1.5 times price to earnings, certainly 1 year forward, looks cheaper than some of the other counterparts within the housing finance space, but those are smaller than a PNB Housing. PNB Housing has a larger base as well. And you also want to look out for how the last 5 year average price to book multiple is, which is at 1.2 times. So in that sense, it's a slight bit of a premium. Again, we'll give this a neutral, because there is a turnaround coming, and we have seen leadership talk widely about that turnaround, and we've also seen analysts cover that turnaround a bit. So maybe a few of those aspects need to get balanced. Let's look at street cred. Well, it's performed very well over the course of the last 3 months or so. 30% returns. Last 1 month has been 24%. Last 6 months has been 18%, and last 1 year has been 35%. Truly impressive, given the fact that markets haven't done as well in the meantime, especially broader markets. Let's look at street coverage. They have 12 buy ratings, no hold, no sell, and a 14.5% upside on the stock. So a positive with regard to that as well. Let's try and stack it all up and try and give this one our KYC rating, and that's how it stacks up. A balance sheet is a neutral because you want better growth there. Let's look at the next graphic, and within that we look at how shareholding, street cred, street coverage and valuations look, and that's how it stacks up. On our KYC ratings, it gets a 6.5 on 8. Very impressive, at least in that sense, but lots of monitorables, and therefore we bring in Girish Kausgi, who's the Managing Director and CEO at PNB Housing Finance, to speak to us about, of course, Q4 numbers, sir, but more importantly, what the journey of PNB Housing is going to look like in the next 2 to 3 years. Good morning, Girish. It's always good chatting with you. I want to first start off by asking you exactly that. Growth has been muted over the last 3 years. You have guided for a late teens kind of growth for PNB Housing over the next 1, 2, 3 years. 2 questions therefore. How confident are you, and how does the mix change as a result? Because affordable housing is taking a larger share of the pie when it comes to incremental disbursements.
Good morning, Harsh. I think thanks for the detailed and comprehensive analysis of PNB housing. I think very impressive. I think let
Thank
me
you.
first address growth.
Yeah.
If you look at PNB housing, growth on book or disbursements 3 years back, it was flat. It was negative. Now 2 years back, the growth started off with 10% on book. I'm talking about retail book because corporate we had stopped business because of stress. So it was 10%. FY24, the retail growth was 14.1%, and FY25, the retail growth is 18.2%. We had guided a retail growth of 17%. Against 17, we are at 18.2. So from 10 to 14.1 to 18.2, very clearly there is growth. And if you look at the entire mortgage industry is growing at about 13 to 13.5%. We were below industry average. Now we are far higher than industry average. And this is number one. So very clearly there is growth because we are at 18.2 and not many companies given the mix of prime, emerging and affordable. Even if you have to look at growth within affordable, FY25, our affordable growth is 180%. We took the book from 1790 crores to over 5,000 crores in 1 year. The entire affordable story in 27 months, we have built a book of 5,000 crores. Now the book is 5,070. Look at emerging. We started emerging in FY25 because of better profitability, better margin. That has done well. Now the book of emerging is about 14,000 and odd. So overall book now retail is about 74,800 crores. The plan is to take it to 1 lakh. So very clearly, you will see that the growth is there, which is in higher teens, which is 18%. And come a year or two, the growth could be in excess of 20%.
Okay. So how would the mix evolve therefore over the next maybe 2 to 3 years? How balanced would it be in terms of prime, affordable, as well as your mid-tier?
So because of profitability reasons, we started affordable. Today, affordable and emerging, the disbursement mix together is 40%. And we had guided 40% by March. We started off beginning of the year FY25 with 32% mix. We ended up with 40% mix. Today on the portfolio, emerging and affordable, which means higher yield business is 23%. Come FY27, so March 27, the overall book is going to be 1 lakh crore retail book. Out of 1 lakh crore, affordable is going to be 15,000 crores. March 25 is 5,070. March 26 affordable book is going to be 9,500 crores. And March 27 it's going to be 15,000 crores. March 27 emerging is going to be 25,000 crores. So 40% of the book in FY27 is going to be from emerging and affordable, and the balance 60,000 will be prime. Prime, we are by design, the growth rate we have tapered it down because of margin reasons. Now, FY26, we have started one more new vertical called as loan against property, LAP vertical. Now, this also would help us on the margin. Corporate, this year we plan to disburse about 1,500 crores. So the segment shift, we are focusing more on affordable, more on emerging, prime, we're trying to taper it down. The growth will be obviously lower by design, restart of corporate, and a new vertical called lab. All of these things will ensure that growth definitely would be there. I'm sure in next 2 years, the growth will be in excess of 20% given the mix. If you take only affordable, our growth is the highest. If you take emerging, our growth is the highest. FY25 emerging growth is 21% on book, and affordable is 183%, and prime is 12%, and this is by design.
Therefore, where should margins lie and where should yields go?
So margin would be stable. Whole of FY25, a NIM was 3.7%.
Correct.
We will be able to maintain that for next 2-3 quarters, and then the margin will start inching up because of the mix change, because of restart of corporate, because of new vertical called LAP, which we started this year.
And any tailwind you will that the margin will get from the repo rate cut?
See, we are very clear on profitability. We are very clear on margins. So whenever there is a rate cut, we pass on the benefit to the customer. Once we saw that benefit coming into our cost of borrowing, so that we are going to pass it on. Apart from that, consciously on 5 things we are trying to increase margin. In prime, we are trying to increase our margin. In emerging, we are trying to increase our margin. In affordable, we are trying to increase our margin. Corporate will be a restart. It will come at a better yield and therefore better margins. And loan against property will come at a better margin. So these things would ensure that we would have enough levers to increase our yield and therefore better margins.
Got your point. And how much therefore would the normalized margin be at?
So FY27, our NIM should be in the range of 4.1 to 4.2 standalone. So today, for example, we are talking about ROA of 2.6, 2.7. So once this write-off pool is exhausted, our credit cost is going to be 25 bips. So FY24, FY27, FY25, FY26, the credit cost would be quite subdued. It will be neutral. It will be negative. So FY26 also credit cost will be negative, therefore aiding for better profitability. Come FY27 stand alone, our NIM is going to be 4.1 to 4.2. Our ROA is going to be 2.5 to 2.6.
Got it. And your credit cost will be sub 0.3 is what you mentioned.
Our credit cost will be 25 bips.
25 bips, yeah.
In FY27, standalone.
Correct. What gives you that confidence? Because you're lending now to corporate, loan against property, affordable housing, where you could see a bit of an inch up. You've not done that in the past. And therefore, what gives you the confidence that you'll be able to maintain that kind of credit cost number?
So even if you look at a credit cost now, it's in that range, 0.2 to 0.22.
Sure.
If you look at FY25, so the way we are building book, we are very, very sure because now affordable book is sizable. It's more than 5,000 crores. Emerging book is sizable. So we've seen our credit cost panning out, which is in the range of about 20 to 22 bips now. So it will inch up and it will be around 25 bips standalone. Even today, if you take credit cost, it's hardly anything. Because of write back, it is negative. Otherwise, it is sub 25 bips. Come FY27, given the mix change more skewed towards affordable, emerging, new vertical lab. So our credit cost is going to be 25 bips.
Yeah, that's exactly what my worry is. You're moving into these segments. My worry is not the 2.6% ROA if you do 25 bips of credit cost. I don't think that is worrying the street at all. Is there a downside risk to that credit cost number is the only worry. What gives you that confidence? Again, because you're doing all of these new businesses and hence, some bit of apprehension on this count.
All these are new businesses, to us in some way. For example, loan against property. It is not new business. We are doing loan against property for last over 30 years. It is only a focus by having a dedicated vertical. So it is not a new business. The only new business is going to be corporate, and there the plan is to take at a portfolio level to about 5 to 6% by FY27. That will be hardly anything. It will be about 5,000-6,000 crores. There we are very pick and choosy on developers, on the project selection, on the geography and stuff like that. So it's hardly any amount to be really worried about, because rest, whether it is prime, whether it is emerging, whether it is affordable, all the three book, if you see, it is quite substantial and we have enough experience on that. And the new vertical, it's only new vertical, not a new business. Business is old, 30-year-old. It's a new vertical just to bring in that extra focus so that the profitability betters.
Got it.
So because of that, we are very, very sure our credit cost is going to be around 25 bips, because this is something what we have seen for last 3 years.
Understood. Point taken, Girish. Thank you so much for this conversation, for being so candid and speaking with us today on KYC. But completely out of time on this edition of KYC. That's all, in fact, the time we have from myself. Everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo ties. Now there's a buzz of a positive corporate development related to one of the related to its European operations of European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo ties. Now there's a buzz of a positive corporate development related to one of the related to its European operations of European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Hello and welcome. You're watching Profit Buzzers on NDTV Profit with me, Somit Sarkar, and my co-anchor Varsha. Well, Varsha, market continues to remain flat. In fact, Nifty IT is the top sectoral gainer in trade.
Yes, exactly. But let's pull out the contributors when it comes to Nifty 50. As you rightly said, benchmark Nifty is trading flat. And let's see who are the contributors. On the loser side, you have Dr. Reddy's, you have Ultratech, you have iShares, Power Grid and Coal India, while on the gainers side you have BEL, RIL, Tech Mahindra, Eternal and L&T. Let's just pull up the sectorial heat map. Let's see what's happening there. Barring Nifty IT, everything is under pressure. Well, if you see Nifty Auto, it's down almost 0.3%. Nifty Bank is down 0.14%. Nifty IT on the other hand, if you see, is up almost 0.14%. Nifty Pharma, if you see, is down 0.8%. So barring Nifty IT, everything is in red. Let's just see what broader markets are doing. Let's pull out the chart when it comes to Nifty Midcap 150, though broader markets are actually in green, not mirroring a benchmark index. Let's see who are the gainers when it comes to Nifty Midcap 150. All the defense stocks, if you see, are up today. They are gaining now. This is on the back of India-France Rafale deal. India to procure 26 naval variants of Rafale fighter jets. You have Mazagon Dock, you have Cochin Shipyard, which are on the gainers list when it comes to Nifty Midcap 150. On the other hand, Tube Investment, Prestige Estates, Bharat Dynamics are also on the gaining list. When I talk about the losers, you have Tata Tech, you have Adani Wilmar, Oberoi Realty. Now, Oberoi Realty, if you see on the back of numbers, the stock is down almost 2%. Now, the highlighting factor when it comes to Oberoi Realty is lower pre-sales and slower collections that the company has seen. Aurobindo Pharma, if you see, again is down on the back of fire at one of its facility. Let's pull up Nifty Small Cap 250 as well. Let's see what that counter is doing there. It should be up. It should be in green. There you go. So 0.27% Nifty Small Cap. Let's see who are the gainers when it comes to Small Cap 250. Again, Garden Reach on the defense side. You have Whirlpool, Data Patterns, and Honasa Consumer gaining when it comes to Small Cap 250. While on the losers side, you have Sterlite, you have CSB Bank, Sterling and Wilson. Are on the losers side. So Somit, benchmark indices are flat, but broader markets are up.
Well, yes, let's also welcome in our guest Shamila Joshi, founder of shamilajoshi.com. Shamila, at this point of time, how are you looking into the markets, and what's your view overall when it comes to the benchmark and the Nifty Nifty 50?
Overall, I think we're doing quite well. We mustn't forget the fact that the kind of cuts that we saw about 2 or 3 weeks back on the when the first the tariffs were announced, I think that fear is sort of getting absorbed, and there is a growing sense that there could be rollbacks, and there could be so people are looking at May with a lot more optimism than when the news first broke out. Also, I think additionally for India, we are seeing that the earnings season is playing out more or less along expected lines. We've had an interest rate cut, and markets had followed. So market has sort of digested all this, and we saw some good buying coming in when the market went down, especially in large caps. And I think that's likely to continue. So I would really watch news flow in May in terms of global news flow. But overall, I think that we seem to be on a much firmer footing than we were, say, about 3 weeks back.
Right. Thank you for that view. Well, let's move on and let's now take a look at some of the BFSI earnings which were in focus today. Harsh joins us with all the details on PNB Housing, Fino Payments Bank and UCO Bank.
Well, a strong set of numbers across the board, in fact, by many of the financials. I'm going to start off first with PNB Housing. It's a very strong quarter. Margins got better. You got write-backs which aided profitability. Asset quality improved. In terms of the way in which the ROA moved closer to 2.8%, it was impressive. And the kind of growth that we saw as well on the top line, the net interest income grew 17%. The provision reversal aided the profit after tax. But it's been two consecutive quarters of provision reversals now, nearly 100 crore of provisions reversed. So maybe you might see profits going forward not able to sustain at the current level and the ROA may drop, but nonetheless, at least this quarter is a very solid one. The profit after tax number came in at 550 crore. The anticipation was 505 crore, largely aided by this number. Let's look at Fino Payment Bank now. In terms of growth, nothing to complain about. You saw your net interest income jump, but you look at your other income more for a Fino Payment Bank. From 360 crore, the other income has come in at 440 crore. So strong growth on that count as well. Profits are down, but that's largely because of tax. Last year, same quarter, Fino Payment was not eligible to pay any taxes. The current taxes that it pays actually has depressed its profit on a YOY basis, just about 5% down on a YOY basis, the profit after tax. UCO Bank as well, very strong core performance. The operating performance was extremely strong. Operating profit was up 33% YOY. You saw a bit of an uptick on the normalized or on the depressed level with regard to credit cost or provisions, and therefore you saw a bit of a spike there, 12% up QOQ, 42% up YOY. But overall, when you're looking at the net profit as well, the very strong operating profit growth percolated to net profit up 24% YOY. They're set to raise money as well to dilute that government shareholding of 91%.
Well, thank you, Harsh, for all the details. Sharmila, I wanted to have your view, especially on PNB Housing and UCO Bank. Good set of numbers, though.
I think let's talk of PNB Housing first. Overall, I think that the kind of growth that we saw is very heartening. Up to my mind, let me to just put this a little bit more in context. I think real estate as a sector has a very important role to play, where we are as a country. And in that, I think tier 2 cities will contribute a lot more going forward. So if you see PNB housing finance numbers, the kind of retail growth that they've seen, as well as the growth that has come in the affordable segment, to my mind, these are the two factors within the, if you break down the numbers and you look at them, these are the two numbers that I really like, and I think that there is good scope for growth in both these segments going ahead and both these parameters going ahead, and which is why I think that even in terms of valuation, the stock looks okay. So I would figure that from the current levels also we could see a upside in the stock if this kind of performance continues. Coming to UCO Bank, yes, I think numbers, as you said, decent. Valuations also look decent. But I just think that perhaps my attention would be more towards these sort of slightly larger PSU banks, given the fact that overall the sort of environment is favorable. So I would look more closely at stocks like PNB, Bank of Baroda, Canara Bank, stocks like that, rather than the UCO Bank.
Right. Another stock that remains in focus is Bajaj Finance. The company will be reporting its numbers, fourth quarter numbers today. Let's get in Harsh with more details on what the street is expecting out of Bajaj Finance.
Which I'll be tracking really closely. One is the margin number and in terms of the guidance, and that holds the key, right? Bajaj Finance has been on point with regard to guidance, and therefore what FY26 holds in terms of margins. Again, we spoke about transmission of rates, whether Bajaj Finance will be actually transmitting the rate which it gets in terms of the benefit of cost of funds, whether it transmits that or not, will be one of the questions which I'll look out for. Likely, partially, transmission might happen, but how much of that margin can they hold on to in FY26 will be the question. The other piece will be with regard to credit cost. Now, in terms of the way in which credit cost has moved, FY25 has been a tough year in that sense in relative terms for a Bajaj Finance. But what is the Q4 number going to look like, and thereafter what does FY26 look like in terms of outlook will hold the key. They've suggested a tapering down with regard to credit cost in FY26. again, some bit of reiteration with regard to that number of what we can expect in FY26 will hold the key. Overall, you're expecting decent growth. Net interest income expected up 25%. Provisioning continue to remain elevated around the 2100 crore odd. Profit after tax expected to rise by 16%. So that's how you're expecting the numbers to play out.
Right. Sharmila, coming to you on Bajaj Finance, how are you looking at the numbers, and what is that one key factor that you will be watching out for that could lead to a re-rating when it comes to Bajaj Finance?
Well, honestly, I'm not really looking at any re-rating or anything of the sort. If you get numbers in line, as the discussion was just happening, I think they've been pretty much very accurate as far as living up to what sort of prediction they've made about themselves have come. So let's wait and see what they say. I think, to my mind, really speaking, the focus is more going to be on, market always anticipates these news in advance. So there must have been some build-up, given the fact that there could be a stock split, bonus, dividend, etc. So what kind of announcement do we see on that front? So let's see. There could be a sell-off because I'm sure some pre-buying has happened. So if numbers are in line and you get some announcements, you could see a bit of a sell-off that could give an opportunity for new entrants to get in. And I think both the Bajaj will always give you that opportunity a couple of times in the year to get in. To my mind, this is not the level. Let's wait for that level. But overall, this is the stock that I like, and not, as I said, I'm not really looking at it as a re-rating candidate or anything.
Right. Thank you for that view. Well, the next stock which is in focus is IRFC. The lender has posted its Q4 numbers and it was a muted set. The total income went up 4% while the net profit dropped by 2%, and we spoke to Manoj Kumar Dubey, who is the CMD of the company, about the quarter gone by and outlook for FY26. Listen in.
We've already seen interest rate cuts of 50 basis points. We're likely to see another one. At least that's what the street is anticipating in June, the way things are going, and the accommodative stance by the Reserve Bank of India's Monetary Policy Committee. Now, in that context, I'm just curious about your cost of funds. What is the kind of trajectory that you anticipate, and the spreads? Particularly when you're talking about the railway business, which, as you pointed out right now, is the bulk of the business. Do you see that improving?
You see, we are equally excited with the fact that the repo rate has been cut. In fact, if you are following the bond markets, we raised the fund even the last week at a very attractive rate of nearly 6.85%. So that gap between the bank rate and our rate is bond rate are still there in our favor. Apart from that, there's something called 54 EC market, which is nearly 15,000 crore market. There, the cost of fund is only about 5.25%. Then there is something called zero coupon bond, where we are eligible to raise funds through that also, where the cost of capital is in terms of 6.25%. Mixing all these together along with ECB, we believe that, I can't give you numbers, but we are very comfortably placed to be very, very competitive with any banks leave aside the NBFCs. And what I mentioned, Alex, which is very important to note, that our overhead cost is less than 0.1%. Now, in the industry, nobody can match us. The nearest competitor is around 0.8%. So that gives a lot of legroom to be very, very competitive, and we want to leverage this kind of driver that we have in our hand to be a leader in financing anything in the railway ecosystem, not only limiting to the Indian Railways.
Well, this is the growth outlook that the company IRFC has. Well, Sharmila, company is diversifying its lending business beyond railways. Any views that you have, and what's the outlook that you're expecting in terms of FY26?
Just listening to the management, their cost of funds and their situation looks very comfortable. The AUMs are also at a very good level. And again, I think that if they are, as you mentioned, diversifying, that again makes a lot of sense. Only the valuations don't give me a lot of comfort. Yes, the stock has corrected a lot from its highs, but let's watch it for a bit. So overall, my stance is neutral. But whatever I've heard so far from the management, as well as looking at their numbers, all that really seems to be giving a lot of confidence at this moment. It's just as I'm saying, I think that from a valuation perspective, the stock looks a tad expensive to me even after this correction.
Right. Well, another stock that remains in focus is TVS Motor. Now, the Q4 numbers were strong on the back of increasing market share as well. The management is also sounding quite optimistic, but what a brokerage is saying when it comes to TVS Motor, let's get in Puneet.
It was a really strong set of numbers for TVS Motors. We saw a 0.5% benefit of PLIs out of the EBITDA margin. So 0.5% of the EBITDA margin was actually a straight benefit of PLI. And that's largely because of the company's electric vehicle ventures in iQ, which is its electric vehicle two-wheeler maker, as well as the TVS King, which is its electric three-wheeler. That's also been gaining a lot of traction. Apart from that, we had brokerages such as Macquarie, Nuvama, as well as Citi come out with views. Macquarie has maintained its outperform rating. They've said that it's one of the top picks with a target price of roughly about 3,045 rupees per share. And they've said that the company is well positioned for growth and margins going into FY26, and exports will likely recover in the African markets in this year. Last year there was impact of currency devaluation in major markets like Nigeria, while the other aspect is that they remain buoyant on the new entry of TVS into markets like LATAM in this particular year, something that the other peers like Bajaj have also done very considerably on the back of slow growth in Africa. Nuvama also maintained its buy rating. They have actually increased the target price to 3,200 versus 3,100 earlier, and the key aspect they're mentioning that they expect TVS has been gaining continuous share in domestic as well as export market, and the share has actually risen from 14.8% in FY19 to almost 17.6% in FY25. They're also expecting these market share gains to persist going forward as well, and they expect TVS is better positioned in EV market specifically compared to its other peers across the broad portfolio and different battery ranges. And finally, in terms of Citi actually has a sell call on something like a TVS, but they've increased their target price to 2,050 rupees per share versus 1,800 earlier. Now, because they have also mentioned that the results were largely in line, but it's only because of valuation concerns that 35 times price to earnings, the highest and the most expensive two-wheeler stock, hence the sell rating. But all three brokerages positive on Q4 as well as FY26 outlook for TVS.
Well, in fact, JP Morgan also downgraded its rating on TVS Motor to neutral from a buy rating. They were citing concerns of growth slowdown going forward. Sharmila, how are you looking at TVS Motor? Do you see or do you concur with JP Morgan's view that there could be a slowdown in growth for FY26?
So as a disclosure, I own the stock, and so I'm not really, yes, overall the growth for two-wheelers has softened, and you could see an effect of that on TVS Motors as well. Valuations look expensive. Obviously, I continue to hold what I have, and very honestly, if you ask me, we have three two-wheeler players, major players in the country: Bajaj Auto, Hero Motor, TVS Motors, and we've seen historically each of them sort of take the lead, and something performs for them at some point in time, or something goes wrong. For the longest time, it was TVS Motors really, and now it has caught up and overtaken the other two stocks. Now, perhaps to my mind, from a valuation perspective, Hero Motors looks more tempting. It could take a couple of quarters, maybe even a year, 18 months for to come through in their numbers. But I think now after a couple of bad quarters, and now with this Ather listing, etc., you could see some movement in Hero Motors. So that's really where my focus would be at this point in time. Overall, I'm very positive on the two-wheeler electric vehicle space, and I'm positive on two-wheelers in the Indian context. But yes, for TVS Motors, maybe you will not see too great a price, the stock price going up too fast, because the valuations do look expensive.
Okay, so valuation too expensive when it comes to TVS Motor. Thank you for that view, Sharmila. Well, moving on, KPIT Technologies reported that Q4 earnings with a net profit growth of 47%. Now we caught up with Kishore Patil, who is the co-founder and CEO at KPIT Tech, to talk about their quarter gone by and the road ahead. Listen in.
I understand it's a good set of numbers. The environment is tough. However, the street is concerned about the deferment in terms of the FY26 guidance. I understand you're awaiting better visibility. The demand and pipeline conversion is what you're watching out for. But where is it that you're seeing concerns?
I think I may just say that we should celebrate what we have done in the last year first. I think it has been a pretty good performance by the team, and done well, especially on profitability, where the whole of the industry has struggled. It just gives us a very good runway into the next year as we go, and as we have the different challenges face the overall situation globally. The point we have talked about is if you look at consistently the kind of closures we have made every quarter, and especially the last quarter, it's amazing. It's one of the best of recent times. And also we have announced also a specific partnership with MBRDI. And that shows that there are new clients, there are new things which are happening. See, last year, quarter 2, we were a little unsure. Quarter 3, we talked about seeing some good interactions with the client and demand picking up. Q4, we are building on that. I think the current situations in US is a bit of, I would say, interruption. And I guess the dust should settle down in a quarter or so. And otherwise, I see no reason. There are reasons why OEMs have to spend, and there is a reasons why KPIT is going to win a larger part of it. So I have no concerns on that, but which is we are watching closely.
Okay. So, Kishore, when you talk about the dust should settle, would it be right to say that the deal ramp-ups could probably only start in the second half of FY26? The first half could remain muted. And secondly, the sporadic instances of cancellations of smaller projects that is coming in, not only for KPIT, but for the industry as a whole. What is the kind of quantum you're looking at currently?
You know, the first thing I want to answer is it's not that everything is going to start after quarter 2. That is not what we are saying, actually. Actually, many of these clients are in a hurry to actually engage because it is for them to really have some of these technologies adopted. It is for them to have their production program well in place earlier. They have already started engaging. Some of these we are transitioning when we are, taking over some of these this work from OEMs, or in other works also we have started work. I think the scale up is a bit slow, and which I believe will start growing after that. From your question on the things which are falling down a little bit here and there, not too many. There are few discretionary deals. Again, we are not seeing something completely falling down. I think some cases it doesn't get renewed, but it's not a big portion for the large OEMs. Where we see some issue, if at all, is the tier 1, which is not a big part of our business, but that's one where there is some kind of volatility. But rest, I think there are many areas of growth, right? India, Asia are still growing reasonably well. So I think overall, I think that should be the balance. And I believe once, whatever, I think a quarter, 3 to 4 months, 5 months, I think things should be on the right course.
Well, that was KPIT Tech on growth outlook ahead. But Sharmila, industry headwinds too extreme. And though company has not given FY26 guidance, but the brokerages are expecting a moderate growth for FY26. What's your view?
Yes, I think really speaking, the management said it all. While the numbers were very good, the fact that they've not given a guidance for FY26 and the fact that they've sort of lacked the concerns for their sort of the deal pipeline in the US, and we need to wait and see how long this sort of uncertainty lasts. Because if your pipeline from the US is strong and okay, yes, now you want to shift, there are obviously, I think as rightly said, markets, whether it is domestic, China, Asia, they're big. But what do they, how does it all translate to deals? How do your deal wins look going ahead? All that will actually really bear on what your year will look like. And at this point in time, that all seems a little uncertain. And that's the one thing that markets don't like. So while it's a good stock, it's done well. The fact that this whole auto, the sort of sector that they are focused on, the OEMs, etc., the kind of concerns that we have for that at this point in time would sort of give you a sort of a neutral stance on the stock as of now, given its valuations and the headwinds that they could face going ahead.
Thank you for that view. Well, viewers, it's a time for a short break. Don't go anywhere. Stay tuned to NDTV Profit.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations of European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's
Jammu and Kashmir government shuts 48 resorts and several tourist sites over security concerns after the Pahalgam terror attack, as tourists flee the union territory and travelers cancel their upcoming tours.
Benchmarks trade near days low. Broader markets at slightly higher. Nifty defense gains close to 4% as the top sectoral gainer.
TVS Motor declines 2.5% on profit booking despite the company recording a strong set of Q4 earnings and brokerages giving a thumbs up.
Tata Tech tanks over 5% after 1.6 crore shares were sold in a block deal. TPG Rice is likely to have sold the stake for 676 rupees per share.
Telecom companies ask TRAI to ensure platforms like WhatsApp, Telegram and Signal fix security loopholes. Welcome back. You're watching Profit Buzzers on NDTV Profit. Well, moving on to our first story, sources told NDTV Profit that telecom companies have asked TRAI to ensure platforms like WhatsApp, Telegram and Signal to fix their security loopholes. Let's go across to Aishwarya for more details on this.
Well, we're learning from our sources that telcos will be reaching out to the TRAI, Telecom Regulatory Authority of India, to discuss security concerns as far as OTT messenger apps such as WhatsApp, Signal, Telegram are concerned. Now, the security loopholes have been a concern for a while and have been discussed in the past as well as far as these messenger apps are concerned. That will be, of course, re-looked at and brought to TRAI's notice. WhatsApp, Telegram, Signal, these kind of apps and more of these messenger apps will may be asked to look at or take a re-look at security loopholes. Now, what are the potential threats that they are talking about? Once you insert a SIM card and your messenger app is activated, it is still activated even after you remove the SIM card, and that particular user or that particular device may not be traceable after you remove the app, because the location can only be traced once the SIM card is in the mobile phone. That is one of the ways to look at this kind of security concern, because the fraud or a scam done through one particular location may not be traceable, because by then the user or the fraud committed by this particular user may have moved spaces. This is one of the concerns that they're looking at. They may also look at encryption of chats Currently, it is not possible to trace or look at chats, but that might be opened up to enforcement agencies, law enforcement agencies, try as well as police personnel, so that they can take a look at these kind of events or situations when some fraud is committed. Apart from that, now this move, of course, telcos believe will curb the loopholes as far as rising menace of cybersecurity is concerned. Now, COAI, which is the body of which represents the telcos, has also given a statement out saying that the spam activity has been shifting from telecom networks to OTT communication apps. And this is why this move and this discussion may be crucial as far as TRAI is concerned. Now, the telecom providers have already put in strong measures against these unsolicited calls or spam messages, but they will be looking at speaking with TRAI further from here. They have also said they will be tracing scams via OTT apps, which is currently harder as these apps move across devices as well. COAI has urged cybersecurity as well as regulatory rules for TSPs and OTT to be on the same par as far as TSPs are concerned and OTT apps are concerned. So far that's the update, and we could be looking at some regulations as far as these messenger apps are concerned coming in through in the next couple of days or so.
Well, thank you for that. But two stocks. Let me focus on two stocks. One is HG Infra. Let's see what that counter is doing in trade today. Is up almost 1.5%. Now they've got a provisional certificate for two orders. One has just recently come of rupees 1,492 crore, and the other one is a provisional certificate that they receive for order worth rupees 1,123 crore. Now this involves a development of 6-lane section in Odisha, and the project was awarded by National Highway Authority of India. On the next list is Prestige Estates. Let's see what that counter is doing in trade today. Prestige is, I think it was up almost, there you go, 4%, 3.6%. Well, now what the announcement is that company has approved participation in offer for sale of their subsidiary company Prestige Hospitality Ventures Limited. Now this is a follow-up to an earlier announcement that they made on June 21st, 2024. Now the OFS, that is offer for sale, will be a part of company's initial, that is subsidiary company's initial public offer, and Prestige Estates plans to offer up to 10,000 million, that is 1,000 worth of shares of subsidiary company, and the offer price and price band will be determined by the company and the book running lead managers. Sharmila, HG Infra, two provisional certificate that the company has got, the stock is up on the back of that. Your view when it comes to order book, and how are you seeing this counter?
It's poised very well. I was just checking out the order book while you were talking of it, and the way it is emerging as a strong EPC player, and the awards that it has, as well as the valuation the stock is at. Earnings seem a little lumpy to me, but overall, I think if you look at the way their order book is as well as the valuations are, I think the stock is very nicely poised.
Thank you for that view. Before me going to next two stocks, let me invite Gaurav Sharma, who is the Associate VP and Head of Research of Equity Commodity Currency at Global Capital. Welcome, Gaurav. The next two stocks that I have on my radar is IOL Chemicals and Pharmaceuticals, wherein the company's product ibuprofen, so ibuprofen forms almost 36% to the revenue. So the contribution from ibuprofen is at 36% in FY24. Now that product or that drug has received approval in China. That means company is authorized to export ibuprofen to Chinese market, and with this product is widely used for anti-inflammatory drug, and it's also used in in relieving pain, reducing inflammation, and lowering fever. So that's one update. So IOL Chemicals is actually up on the back of this news. Next on the list is Aurobindo Pharma. Now there was a fire incident occurred in one of their Kakinada facility. Now, no manufacturing infrastructure was being impacted and there were no injuries reported. But a thorough damage assessment is underway and the operations will be temporarily paused for 22-25 days. Well, Gaurav, let me come to you. When it comes to IOL Chemicals and Aurobindo Pharma, how are the charts looking for both the counters? Gaurav, I think you're on mute. Okay, let me just go to Sharmila for that. Sharmila, IOL Chemicals and Aurobindo Pharma.
Ibuprofen is a very important chemical, and this is a great development for IOL because I think that anti-inflammatory forms a big part of medicines worldwide, and if they get an approval from an important market like China, it's good news for them. Valuation-wise, also the stock looks okay. Aurobindo is a little more expensive, and yes, I think that this bad news sort of needs to get digested, but otherwise, I think both stocks are very strong.
Right. When it comes to the entire pharma space, what would be your top pick, Sharmila?
I think that this is a sector that I like, and I think it's going to stay unscathed relatively where this whole tariff situation is concerned. So, I would still like to play with the large caps. So, I would prefer a stock like a Sun Pharma or stocks like that, Dr. Reddy's, stocks like that.
Right. On to NDTV Profit's special segment Deep Dive, where our research team gets you a detailed analysis on a stock idea. Today, that's on alkylamines. Now, the chemical maker has lost over 4% in value this week and is trading flat on a YTD basis. What's not working for the company? Let's get in more details from Varsha.
Thank you for that. So, in the last 1 year, the stock is down almost 13%. But the question here is, and why we are doing this analysis, is the valuation. The stock is trading at 52x, a chemical company trading at a valuation of 52x, while we are trying to analyze what are the challenges that the company is facing and why this 52x valuation might be a questionable. Let's see what is actually not working for the company. The company has seen declining sales and profitability since FY23, and over the years the sales and profits have been declined, but the most interesting part is the volume, declining volumes that the company has seen over the past few years. So volumes have been declined from 17% to 10% in the recent years. So in FY20 the volume growth was 17%, while in FY24 the volume growth has been 10%. So declining sales, declining profits and declining volume are the major challenges that the company is facing. But let's see why a company is seeing this, what is impacting the business. We have competition, pricing pressure from Chinese players. We all know that China has been dumping all the chemicals into the in global world, and that's the reason you're seeing the prices, the product prices are deteriorating and hence affecting the financials of the Indian chemical companies. There have been uncertainty around Chinese capacity additions. China has been adding a lot of capacity additions, which is actually affecting the realizations of the end products. And if you see going forward, the raw material prices, so the lower raw material prices and because of the lower raw material prices, the end realization prices also goes down. And this is the reason we are seeing the declining sales, which alkylamines and many other companies has seen. Now, the margin picture, the most highlighting factor of this analysis is margin picture. In Q3 FY25, the margin for the companies was 19%. Margin expectation by FY27 is 20-22%. Now, let's see how has the margin trajectory been in a past few years. In FY20, the margins were 26%. In FY21, it were 35%. And over the years, the margins have gone down. Now, management itself has said that these margins, 30 to 35% margins are not sustainable. 20 to 22% of margins are sustainable going forward. Now, if you see why the FY21-22 margins were higher at 35%, because there was a price surge in one of the chemicals called acetonitrile. If I were to talk about, if I were to give you a number, acetonitrile price surged from 160 to 180 per kg to 279 to 280 per kg. And this was the reason why the margins were so high, because the end product prices were so high that was giving a positive impact on the margins. Now, the other factor that is not working in favor of the company is the competitive landscape. Balaji Amines is coming up with a methylamines, other chemical which is used in your pharma and rubber. So Balaji Amines is coming up with is doing a huge capacity expansion, and also Aarti Drugs, which is one of the customer of alkyl amines, is getting into methylamine. So your customer is actually becoming a competitor. So this is the other challenge. So margin challenge, then competition challenge are the basic challenges that a company is facing. But everything is actually not bad. There are some positive points which will actually help alkyl amines. One is anti-dumping duty on acetonitrile, which will actually help company to regain the market share loss. Company is also venturing into higher specialty chemical products, which will help to take that margin to 20 to 22%. And company is also evaluating inorganic growth opportunities, including JVs and mergers. But overall, if you see on the valuation part, the key question arises: the challenges outweigh the positives, and the valuation given to an alkyl amines is at 52x. Even if I take FY26 basis valuation, is the alkyl amines is trading at 36x. So this is on the back of company doing 15% growth. If company doesn't do 15% growth, the valuation will even be higher. So whether a chemical company which is facing a lot of challenges garners a 52x valuation is actually a question that one needs to ask.
Thank you, Varsha, for that detailed explanation on alkyl amines. Shamila, coming to you first on the amines space overall, how are you looking at alkyl amine and Balaji amine? Yes, valuations are expensive, and because of that, would you prefer Balaji amines over alkyl?
So I think Varsha has given us a lot of color. I will just add a little bit to that. One is a slightly more historical perspective, historical in the sense of stretching it back 2 more years. Because the COVID years were actually good years for a lot of chemical companies, because you had the whole world looking for China +1. So you saw a lot of new clients coming to these Indian companies, and you did see the improvement in numbers there. Their margins went up, volumes went up, etc. And then we've had this, these 23, 24 were actually more 22, 23 were bad years, and 24, I was once again beginning to hear from a lot of players that things are turning around for them and things will sort of improve going ahead. And now we are in this current situation where again there could be anti-dumping from China, etc. So it's a very fluid state as of now, and as all the points that that were highlighted and correctly, I think there is competition. The ground beneath them is shifting in terms of whether it is raw material, whether it is demand. How the future will look going ahead. So I think to just answer your question in one line, perhaps Balaji looks better from a valuation perspective, but that's not really saying much. So I think you need to watch this sector a little more before you really take any call.
Right. And Gaurav, coming to you, how are the charts looking like for alkyl amines?
Charts are not really looking attractive at current levels. And the stock has not been able to perform, hitting lower lows from quite some time now. No recovery seen off late, so not at all attractive.
Right. Now let's take a look at some of the earnings that are expected to come off today, starting off with the fashion retail giant Trent. Mahima is giving us more detail on from what the street is expecting from Trent in the Q4.
So in terms of what you can expect from Trent Q4 earnings is that the revenue growth could be at around 30%, EBITDA could grow at 27%. Margins may take a slight hit of around 30 basis points, but net profit may fall, and this is on the back of a higher base. Last quarter 4 of FY24 saw an additional exceptional gain of around 574 odd crores. So because of that, we might see a downtick in terms of net profit, but removing that exceptional gain, profit may rise around 2 times. In terms of what to expect, well, PNL might see some impact of the store upgradation, the current store upgradation as well as store additions in Zudio. In terms of Q4, yet another quarter of sub 50% growth. Westside to continue to deliver a steady growth. Star Bazaar to face brunt of competition coming in from quick commerce, and there might be some rise in share for Zudio. in terms of key things to watch out for, store additions in terms of West Side as well as Star Bazaar, competition from online players, competition from small tier 2 and 3 players in the retail space, as well as store addition in Zudio versus the kind of growth that is taking place in terms of per revenue square feet area. So all of these things will be the key things to watch out for where Trent earnings are set to. So in all, it could be a mixed quarter, but we'll have to see as to how Street reacts to a sub 50% growth once again.
Shamila, coming to you on Trent, the stock was at one point of time trading around 8,000 rupees. Currently, it's around 5,200. Obviously, there are growth concerns that have crept in because of which the share prices have fallen. But how are you looking at Trent at this valuation currently?
So I think it's going to be a bit of a soft year, and you are seeing a sort of the entire their store spaces going through a transition period, and I think things will look better going ahead. Just looking at the changes that they're making in their West Side model as well as their Zudio model leads me to believe that going a couple of quarters down the line, their numbers could be better there. Zudio was and is to my mind the big sort of game changer for them, because you are seeing great entry level points at the kind of the clothes and goods that that target audience needs, and the way they've expanded their stores there. So I think they're doing great sort of innovative things and to sort of take them ahead. But there has been undoubtedly the kind of concern and slowdown that we've seen, and that has taken its we've seen that effect on the stock price. And to my mind, it will be at least another couple of quarters before you really see any significant change in that.
And Gaurav, how's Trent looking like on the charts?
Trent is reasonably placed here, trading around 5,300 levels here. Now, what I see is still the point the stock is trading above 4,500 mark on a closing basis. It is good to hold. If we look at its past performance, what happened in the previous year, the stock saw a steep rise from 1,500 to levels close to 8,000 and beyond. So now when the stock is available at 5,200 levels, this kind of a profit taking was much needed here. So I would say that if someone is having a medium to longer term view, this is the time to just hold on. But from a trading perspective, be a little cautious, and if the stock falls below 4,500 odd levels, try exiting. Otherwise, it is better to hold.
Right, so hold view coming when it comes to a trend. Well, moving on, Hexaware Technologies reported their Q1 FY25 earnings. The company's net profit is up 2%. We spoke to CEO and Executive Director of Hexaware Tech about the quarter gone by and the outlook going forward. Listen in.
I just want to start off first with the quarter in general, because while it was expected that on a constant currency basis in terms of revenue, compared to last quarter, there would be roughly flattish to a slight negative trend. I just want to understand in terms of deal wins, how has this quarter been for you specifically? Because we've seen a lot of IT companies come out and mention that while the start of the quarter was very strong, some of them saw some headwinds in March, while the others actually had deal wins continue. How was that for you specifically in this current environment?
I'll say at a broadest level, it was a surprisingly normal quarter for us, right? Notwithstanding all the uncertainty that is happening, it was a normal quarter for us. Like you said, the revenue profile was as expected. We actually improved our margins. But the best thing that happened was we won a number of deals that positions us really strongly for the remaining quarters in the year. We also added quite a bit to our large deal pipeline. So between the two, there's just a lot of confidence about the future for us.
And is there any kind of essentially any cancellation or project delays that you see in March, or as you rightly mentioned, it was just a normal quarter, so you didn't see any of that post, the President Trump swearing in February? Nothing as of that sort in March. Would that be a safe assumption to make?
Well, I'll say actually we had two that, one happened at the end of quarter one actually happened through in early part of two, but since it's material, we already spoke about it. In spite of that, we will have a good quarter two. Now, without that, we would have had a great quarter two, but in spite of that, we will have a decent quarter two. And actually, those quarter-on-quarter headwinds will go away in quarter three. So actually, quarter three will accelerate growth.
Now, just wanted to get into the segmental performance of the company. You have separately financial services, you have insurance, which is with healthcare, as well as banking as a separate segment. Just wanted to start off, essentially with first with how are you viewing these segments, because we are expecting most IT companies to do well in BFSI. In terms of banking, was there any kind of one-off in this particular quarter, and how are you viewing the current conversation with the client on the ground? Because a lot of subcontracting costs have slightly inched up, while a lot of companies also insourcing it now. We saw one of the biggest US banks come out with that in this particular quarter. So if you could start us off with banking first, and how are you viewing that segment currently for Hexaware Technologies?
So we operate on a calendar year basis. By end of this calendar year, banking will be at a point where we are banking is outgrowing company average on growth. Now, this is in spite of having, like you said, a negative start. Now, the negative start is a consequence of a number of projects and programs that ended, but we have a fairly large number of deal wins here, and we have a large pipeline. So even as early as quarter two, you will see a very sharp turnaround. We may actually end up having double-digit quarter-on-quarter growth for the banking sector. By end of the year, we will certainly be at a point where we are growing better than company average.
Well, this is Hexaware Tech outlook when it comes to when it comes to 2026, and mostly Q2 and Q3. Sharmila, Q2 is expected to deliver reasonable but not sharp growth, but Q3 is expected to have accelerated growth. What's your view when it comes to Hexaware? And how are you, of course, reading the numbers?
Numbers are good, but overall view is neutral. We've just, while the company has been around for a long time, we've just seen them get relisted. So let's wait and see how another quarter plays out before you take a call. And I think in this current environment, very honestly, again, my confidence is more with the larger companies, which have been listed for a longer time, like TCS or HCL Tech at this point in time.
Right. Gaurav, how are charts looking for Hexaware?
Charts are pretty much okay. I would not say the best of the charts in the sector, but pretty much okay. Good to hold it at the moment.
Right. Thank you, Gaurav. Thank you, Sharmila, for joining us and giving us your perspective about the markets and the stocks that we discussed. Moving on, Jammu and Kashmir government shuts 48 resorts and several tourist sites over security concerns after the Pahalgam terror attack. Now, tourists are fleeing the Union Territory and travelers cancel their upcoming tours. NDTV's Profit's Nazir Masoodi joins in with more details on the same.
Well, while the major tourist destinations will continue to remain open, which includes Pahalgam, but several important destinations have been closed. Last week, like 4 days back, there was a meeting of Chief Minister with the stakeholders, hoteliers, tourist operators. He was informed that some of the destinations were shut. He was taken by surprise. Then he inquired from the police and the Director Tourism. He was told this, it is a temporary measure. But now what we are hearing that 48 out of 87 destinations and the resorts have been closed as a preventive measure because of the security concerns after Pahalgam massacre. So this is a huge decision, and it means also huge impact on the livelihood of people who had invested, who were hoping to earn their livelihood. So this massacre of innocent terrorists has not only killed 26 people, it has also killed the livelihood of thousands of people. I'm here at Pahalgam, where I can show you a week after the massacre what it has done to the otherwise a bustling township. So this used to be a bustling township. Police had tough time a week ago to regulate the traffic, but today very few vehicles moving here in this town. Not every shop is even still open. The town is trying to come to terms with the loss and the tragedy here in Pahalgam. So this is the cost people have to pay while though innocent 26 people were killed. Yesterday in assembly, we saw there was every party and leader was on the same page, and then the chief minister made that very emotional speech talking about how innocents were killed because of their religion, because they were profiled. Children and women were separated. It was exactly the same way. We know there have been so many, theories which we have done, but clearly it was an attack to target the tourism here, because tourism was seen as a symbol of peace and normalcy in Jammu and Kashmir. Now a major setback also because of this attack. Around 48 destinations and resorts have been closed for the tourists in Kashmir Valley.
Well, with that, it's a wrap on this edition of Profit Buzzer. Stay tuned and keep watching NDTV Profit. Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Hello and welcome to India Market Close. A very good afternoon to all the viewers. Thank you for watching NDTV Profit, and I'm Heeral Dhatia. A very interesting day of trade. Let's just pull up the chart in terms of Nifty 50. The kind of volatility that you're seeing, that cooling off has started to come in. We've hit a high of 24,457, a low of 24,290. So you can see the kind of gyrations that are coming in. We're just up around 0.2%, so pretty much flat right now. But what's interesting is that we're holding up above that 24,350 mark as well. With this, let's just first pull up Bank Nifty, and after that we'll see the sectoral heat map overall. There you go, Bank Nifty as well. Clearly, again, a flattish move there. We're nearly at the day's lowest levels, not very far from there. Some recovery from 288, so 100 points up move from there has come in, but again, a flattish 55,400 is what you're tracking in terms of Bank Nifty as well. So the support that the HDFCs, the ICICI banks and the Yes banks and the Kotaks that were giving you, probably that's weaning off. If we can just have all those, stocks as well, one by one in terms of Bank Nifty, because that's what is interesting. There you go. That is what is pulling us lower. All the four stocks that I mentioned are the ones who are contributing, and the heavyweights are losing out. What's interesting is you have the smaller names which are doing pretty well. AU Small, Federal Bank, IndusInd, IDFC, again, small gains, but trading in the positive. Let's look at the sectoral heat map as well to understand what's happening, because the defense pack is an outlier. Last 5 trading sessions have been spectacular with regards to defense. That continues to be the top gaining sector. 4.5% to 5% is the kind of moves that you're seeing. IT is also coming back in some way in today's day of trade. Oil and gas continues the up move as well. What's losing is Nifty Pharma, and that was the trend that we picked up this morning as well, and that has continued to trade under pressure. 0.8 to 0.9% are the kind of cuts coming in there. Metal, media and real estate, all of them trading under pressure. Let's also pull up your Nifty, the mid cap and the small cap index, because small cap 250 is seeing marginal gains of 0.3%. Mid cap 150 again 0.3% higher. So it's pretty much in line with what the benchmarks are doing in trade. Let's quickly pull up the defense pack right now. If we can have the India defense, the components, because that will give you an idea in terms of the way the stocks are performing, from a BEL to a Garden Reach to a Cochin Shipyard, you name the company. HAL 4%, Bharat Electronics, BA, Concor, all seeing some smart moves in terms of, this is the PSE index, but if you see Garden Reach, there you go, 12 to 13% is the kind of gains that you're seeing. IT pack, again, you have the likes of a Hexaware, KPIT. These are two of the other stocks which are seeing some moves in today's session. There you go. From a Tech Mahindra, Persistent, Coforge will be reporting numbers next week. But again, strong moves coming in terms of Nifty IT as well. So that's what the overall picture is looking like. You are seeing, a very volatile move. Let's just pull up VIX for a second. 17 to 18 was what we were tracking. There you go, 17.3. We've hit a high of 17.59 in terms of the India VIX, which is up 2%. So that is what is concerning, which is telling you that there is that cautiousness which is still prevailing in terms of markets. But let's also now welcome in Kush Bora to tell us more in terms of what's happening in terms of the markets. Kush, good afternoon and welcome. the kind of volatile moves that we are picking up in terms of today's session, in terms of closing, what are you tracking in, on Nifty 50? What should the strategy be?
Hi, Hiral. First, have a very good afternoon. Love the big screen, presentation. While as far as the index goes, I think this is par for the course. We've had a couple of sessions which have been very volatile. I think now we're looking at some sort of consolidation, that too with some positive bias. So there is a possibility that we could spend a couple of days within this 24,200 to about 24,400 kind of a band. Even if you see the options space for the expiry, for the weekly expiry, that's tomorrow. You've got 24,400 call, that's got a very significant base. At the same time, you've got 24,300 which has got a very significant base. So there's a good possibility that we might spend some time in this channel. On the downside, 24,000 is a good support zone. On the way up, the first hurdle will be about 24,600, but I think 24,800 is also very much in play. So I remain positive. Any kind of a dip towards the 24,000 mark or closer to that level should be taken as a buying opportunity. Right now, what we are seeing is after a couple of days of volatility, there's just some consolidation. So yeah, any dip should be taken as a buying opportunity. Bank Nifty also, very similar structure here. We've seen a very good run up in a lot of financial names. You're seeing a lot of them consolidate, for the last couple of sessions. So I think this is a base formation. This is a launch pad from where 56,200, 57,000 on Bank Nifty, could be seen in the coming week's time. So yes, remain constructive on Nifty and Bank Nifty both. Buy on dips is the strategy. There could be some consolidation coming in over the next couple of days' time.
Kush, hi, good afternoon. Harsh joining in. Kush, what are the levels that one should look for? So consolidation seems to be the way in which you are looking at how markets are playing out. Well, what are the levels on the higher side as well as on the lower side that you'll be looking out for?
So let me begin with the most immediate one, which is 24,350. Hi, Harsh. 24,350 is the level that the index needs to sustain and close above. If you see the last 3 to 4 sessions, I think Cyril also mentioned the same level. Spot on that one actually. 24,350 is where the index has resisted for some time. I won't be surprised that if it's a marginal close above it, you still remain in this 24,300, 24,400 point range for today, perhaps even tomorrow. So that's the first hurdle to cross. Once that is taken out, I think 24,600 and then 24,800 on the upside. So I remain bullish with an upside target of 24,800 very much in place. Now, if you'll recall, Harsh, we've been speaking about 23,800 to 24,000 being the buying range. And if you check the low that the index made on Friday, when we saw that big fall, that was actually 23,847. So that still remains the buying area. It's just that, we've seen the support levels move higher. So for Nifty, that support zone has now inched up to 24,000. As I said, on the way up, 24,600 and 24,800. I'm actually gunning for, the second target, which is 24,800 in the coming week's time.
Right, so that's with regards to the strategy in terms of Nifty. 24,800 is the target that Kush is looking at. Kush, what would your top picks be at this current point in time? Because you're seeing a lot of stock-specific action right now.
Absolutely, and also, has to be from a sector that you quite rightly pointed out, which is the defense space. So if you look at the solar industries, what a stupendous run it's had, from late Feb, early March moves. It's probably a blip of a correction, along with the markets here or there. But other than that, it's going great guns. It had hit overheated territories and seen some cool off. Even now, if you see, the volumes are actually pretty staggering on this one. So I think this move will continue in some of these names. We've picked solar industries for the day. So 1375, 14,150 are your targets. 12,950 is where you place that stop loss. Now, one other sector which is starting to show some green shoots after about nearly a year and a half of sluggishness is the QSR space. Devyani International and some of the other names are also doing well, but we've picked RBA today. The reason being that if you see the last month and a half, the delivery marking volumes on this one have been staggering. It's actually now seen a golden crossover of the 20 and the 50-day moving average, and the resistance near the 81 mark is also taken out over the last 2 sessions. So RBA with a target of 87 and 91 and a stop loss around the 78 mark is a buy.
So, Kush, any change in view or stance with regard to an IndusInd Bank, or you still hold your previous stand?
I would perhaps revise it just a bit. Now, the reason for that is, if I just take the incidents out of out of the memory, if I look at pure price action, then the stocks actually had a good run up over the last few sessions. It's still not a very comfortable shift or a very confident shift in stance, Harsh, because the volumes on the way up haven't really come about. So even if I were to play a trend trade, I would play it in a very, in a smaller ticket size manner, just to perhaps capture in on the trend and the massive risk reward ratio that it has to offer. Now, all those caveats, the levels on this one are 780 on the downside, and on the way up, I'd be looking at about 900 as the first target, and once that is taken out, 980. So a mild shift, not I wouldn't call it an all-out trade just yet. But yeah, given the risk reward ratio, if someone does want to play, you could perhaps take a bet, but with a very small ticket size. I want to reiterate that bit a little more.
So that's an interesting one in terms of IndusInd Bank. I mean, a positive move is what you're seeing so far as well right now. But moving on, let's also get in Sumit Jain, Deputy CIO at ASK Investment Managers, to talk about what's happening in terms of markets, his view and his preferences in terms of the sectors. Sumit, good afternoon and welcome to the show. And this is Hiral on the side. The kind of volatility that you're seeing in terms of markets right now is something that I'm sure everyone is tracking. There is uncertainty. Initially, we started off with trade tariffs. I think that's something which is behind us to an extent. And now we are talking about the geopolitical crisis between Indo-Pak. What would your view be from here on? Because overall, not the kind of pressure that we've seen in the previous geopolitical situations. That's not what is happening in the markets right now. And the valuations have not come off to that extent that where we were 3 to 4 months ago. Putting all of this together, your summation of the markets right now.
Hiral, first of all, let me thank you for having me here. See, the way we look at markets is, in general, volatility in markets have actually increased. And the events that we are seeing in the world, markets are also moving from one goalpost to another. So to that extent, really trying to predict each and every short-term news flows in the market possibly may not yield right results over a long period of time. We really believe that we are at a point or juncture in the world where we may see resetting of multiple things. And that effectively means that if one were to look at markets, it has to be from a really long-term perspective. We will see a lot more businesses or a lot different businesses actually will do well over a long period of time. So eye has to be on how businesses would play out over a long period of time rather than trying to predict the reaction of market from a very short-term perspective. No doubt, markets will keep surprising in terms of their behavior from a very, very near-term perspective. And we do not want to really get into how and what markets react there. We'll keep a razor sharp eye on how earnings are playing out, how businesses would play out, what are the trends or changes or shifts that we are seeing in the global supply chains, global economy. And to our mind, that's a better way to approach markets rather than from a very shorter term perspective from one goalpost to another.
Sure, Sumit. This is Harsh also joining in. So therefore, what's relevant and what's irrelevant at this point, if one were to be looking at India specific, how everything in the global geopolitical environment is playing out, what in your opinion, therefore, would be relevant and what would you currently ignore? So just tell us what's relevant at this point.
So what we are trying to do is we are trying to not too much focus on the short-term tariffs, short-term events in the world. So how would necessary or what rate of tariff would one country charge over another? I don't think that's too much of a focus at the current juncture because only time will tell as to where does all those things settle. So we would be closely watching as to how things are playing out there. But one thing that we really believe that will play out over bit of a medium term is globally supply chains will see bit of a changes or rather large changes there over next few years. What are the areas where India stands to gain? What are the areas where demand curve actually is relatively more inelastic and India has a right to win? So that's the area of focus rather than focusing on the short-term news flows. So that's what we would
Those
avoid
areas
in
be.
terms of our focus, and long-term trends is what would matter.
So Sumit, what would those areas be? What would the areas where India stands to gain be?
We really believe with this changing supply chains, possibly areas like bit higher manufacturing in the country, and what all those areas could be. India stands to gain possibly in electronic manufacturing over period. India stands to gain on the pharmaceutical supply chains, whether it is generic, whether it is CDMO, even for example. Medical consumables, India can stand to gain in terms of exports there. So those are the areas where we believe when we kind of focus on right business, right management, those would be beneficiaries. So that's the way we are looking at it.
Sumit, how would you put a defense as a sector from the manufacturing perspective, taking into consideration not only the domestic requirement, but also the kind of spends that the European region is extending as a percentage of their GDP, right? What would your view be? Because today as well, or the last 5 trading sessions, defense as a sector has been firing on all engines.
That's right. And globally, we are in an era where possibly defense spend should inch up. Clearly, the opportunity for India's defense manufacturers actually increased dramatically. Not only would the opportunity increase for domestic manufacturing, but it can increase for exports as well. But we have to be mindful of what are the areas where we would see relatively higher defense or relatively better opportunity for Indian defense manufacturers. Right? So to that extent, it has to be relatively more nuanced in terms of where we are focusing on. And we would really believe opportunity exists for domestic and exports both. Just that we need to be very mindful of friendly, non-friendly countries in terms of the opportunity.
Okay. And Sumit, when you're talking of export-oriented sector, when you're talking about manufacturing, but when you talk about IT, a lot of reliance that happens in terms of global markets, right? The commentary that you're hearing from the large cap peers as well as the mid cap peers is the spends which are on the back burner, or there are delays in terms of deal wins as well. What would you advise taking the valuations into consideration? Do you think, in spite of the pain that they are seeing in the near term, the valuations are ripe to look at IT from a long-term perspective?
See, PE may be capturing possibly the short-term earnings. Inherently, what's happening in many of these large software services businesses is growth rates have actually become relatively more sedate. Even over a long period of time, their ability to kind of even show double-digit constant currency growth rates would be very difficult. Not only is or growth rates within these space is relatively more sedate, it comes with global volatility as well. Along with that, what's also happening is there are some challenges with respect to how artificial intelligence can have bearing on these businesses. So to that extent, not only is short term a problem with respect to global economic outlook, medium term as well, we believe there are going to be some challenges in terms of how businesses would be delivered because of the changing technological order. And consequently, we don't believe that these businesses can report pretty solid growth over a long period of time. And at best, they are trades rather than compounding opportunities.
Right, Sumit. Sumit, you know, some of the pockets that you highlighted, EMS, pharma, especially CDMO within that, defense, maybe not as constructive there, but some of the pockets that you've highlighted and you've said you should go for quality in some of these pockets are also expensive. They are in no way cheap. How do you rationalize that? Is it only the high growth rate that one needs to look at? and ignore maybe some of the risks that are underlying, or you believe that there are very low to no risks?
No, clearly one need to be mindful of what is the valuation that one is paying for these businesses. So it can't be that you are buying these businesses at any prices. But one thing that we really believe in is in a growth-starved world, in a world where volatility has increased, those businesses which actually can report a sustainable superior compounding with a reasonable ROC or reasonable capital efficiency, those businesses should command valuation premium. The only question is, what is that premium that one is ready to pay for these businesses? That's the only question. But we really believe high growth, which is more sustained, more predictable, should command some valuation premium.
Okay, and believe want your view also with regard to insurance and lending, because these are two pockets where there's more or less a consensus buy on the street. Would you at all be constructive with regard to these, and what would you say it would stack in terms of your list, in terms of priority? Where would it somewhere fit?
So when you look at lending space in general, we really believe over a long period, we should see almost 11 to 12% or 10 to 12% kind of credit growth. We need to look for businesses where the ability to understand their customer is really high, which allows them to have a very tight control over their asset quality. Not only is asset quality decent in those businesses, their ability to grow relatively faster than the credit growth of the system. These are two very important metrics: growth, capital growth, NPA, control over NPA. That backed with what is the ROE that these businesses are delivering should be the focus. So this is a large area. We need to pick and choose what are the kind of businesses that we are buying. We would like to avoid businesses which are just close to about about industry credit growth with a very normalized ROE. So focus is clearly on high ROE, high growth.
Overall, Sumit, I mean, I know you're looking at equity, but currently if you're seeing equity versus gold, any view in terms of what's happening with gold? Because usually when you're talking about growth, you're looking at equity markets. When you're talking about opportunity in a crisis situation, you're talking about gold. What would you do in the current situation?
I'll not say this versus that. It is equities and gold.
Then let me change it to how much in gold, how much in equity.
I don't think there is going to be a definite single answer to this because it will be a function of one's own risk appetite, one's own approach to investing. So there isn't one size fit all in terms of their asset allocation. They need to look at what is their perspective, what is their approach. That will determine not only about equities and gold, but about equity, debt, and gold as well.
Sumit, very lastly, how are you pegging India's valuations as compared to the other emerging markets? And do you think there is further opportunity for valuations in India to get reasonable, where investors could get a better entry point? Or is this the best time to start nibbling?
So, see, if you look at valuations in terms of PE, no doubt India's PE stacks up at a premium versus other markets. But what is also relevant is if you look at India's PE, or rather India's index, that has also altered over the last many years. In the past, the India's index had a significantly higher component of low ROC, low growth businesses. That has altered. Today, India's ROC is decent as compared to what it was in the past. So should valuation be higher? Certainly, yes. I really believe in a world, and we just discussed some time back, that in a world where growth rates are average, those businesses which shows promise should command that valuation premium. So if one were to apply the same philosophy to India versus other emerging markets, India is among few markets where growth rates are relatively more certain at the size at which we are, the kind of growth that we are delivering is pretty decent. I would believe 6.5% kind of growth rate should be sustainable over a long period of time. And if we are able to deliver that with double-digit profit compounding in India, for India in corporate over a length of time with ROCs which are where what they are, we should continue to command the valuations that we are at.
Okay. Thanks so much, Sumit, for coming in, speaking with us. It's good chatting and great getting perspective. So thank you.
Thank you.
And we'll let you go on that note. Time to also slip into a very short break. But before we go, we leave you with a small chat that we've had with Girish Kausgi, who's the Managing Director and CEO of PNB Housing Finance. Stock obviously doing very well in trade today. Talked about the factors that make the company confident about their growth guidance. Listen in and stay tuned. We'll be back and get more views on this one as well.
Even if you look at a credit cost now, it's in that range, 0.2 to 0.22. If you look at FY25, so the way we are building book, we are very, very sure because we now affordable book is sizable. It's more than 5,000 crores. Emerging book is sizable. So we've seen our credit cost panning out, which is in the range of about 20 to 22 bips now. So it will inch up and it will be around 25 bips standalone. Even today, if you take credit cost, it's hardly anything. Because of write back, it is negative. Otherwise, it is sub 25 bips. Come FY27, given the mix change more skewed towards affordable, emerging, new vertical lab, so our credit cost is going to be 25 bips.
Yeah, that's exactly what my worry is. You're moving into these segments. My worry is not the 2.6% ROA if you do 25 bips of credit cost. I don't think that is worrying the street at all. Is there a downside risk to that credit cost number is the only worry. What gives you that confidence? Again, because you're doing all of these new businesses and hence, some bit of apprehension on this count.
All these are new businesses, to us in some way. For example, loan against property. It is not new business. We are doing loan against property for last over 30 years. It is only a focus by having a dedicated vertical. So it is not a new business. The only new business is going to be corporate, and there the plan is to take at a portfolio level to about 5 to 6% by FY27. That will be hardly anything. It will be about 5,000-6,000 crores. And there we are very pick and choosy on developers, on the project selection, on the geography and stuff like that. So it's hardly any amount to be really worried about, because rest, whether it is prime, whether it is emerging, whether it is affordable, all the three book, if you see, it is quite substantial, and we have enough experience on that. And the new vertical, it's only new vertical, not a new business. Business is old, 30-year-old. It's a new vertical, just to bring in that extra focus so that the profitability betters.
Got it.
So because of that, we are very, very sure our credit cost is going to be around 25 bips, because this is something what we have seen for last 3 years.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. last 1 month, if you see the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March.
Welcome back to India Market Close, and this is the most awaited segment I'm sure that the street is watching out for. Heard on Street, my colleague Somit Sarkar joins in with all the chatter from the dealing room. Somit, what's on the radar today?
Well, first stock on the radar is Sami Hotels. Now, if you look at the trading today, it was around 3.94% of the equity changed hands in trade. What I'm picking up from dealers is the fact that it was largely a cleanup trade done by one of the pre-IPO holders, and buyers are likely to be a global asset management company and a domestic mutual fund who are already holding shares in Sami Hotels. So we'll need to watch out for the bulk data when it comes out post-market today. A couple of stocks, BHL and Paradip Phosphate in focus. Dealers indicate that there has been delivery-based buying seen on foreign institutional investor desks, so keep an eye out for both these counters. BHL is up in trade, but Paradip Phosphate has declined. It's down around 1.5%. Coal India is another stock. Now, if you look at the share price movement of Coal India, it's down nearly 3% from the day's highest point. Now, dealers are indicating that there are strong sell flows on large HNI desk, and this is on anticipation of weak volume offtake despite a strong power demand that we have seen in the month of April. So keep an eye out for Coal India as well. And lastly, L&T Tech, KPIT Tech and Tata Tech are in focus. Now, dealers are suggesting a trade here. They are asking their clients to buy L&T Tech and sell KPIT Tech and Tata Tech. Now, the rationale behind this is the fact that L&T Tech is a diversified engineering research and development play, while KPIT Tech and Tata Tech have their growths might be challenged due to 100% exposure to the auto sector, and hence this trade has been suggested by multiple dealing rooms to their clients. And even in fact, if you look at L&T Tech's share price from day's lowest point, it has increased by nearly 0.5%.
You know what's interesting on this one is a KPIT Tech, because when I spoke to the management as well and post the conference call yesterday, they are looking at a China strategy now.
Okay.
So Europe, yes, there are concerns right now because of your tariffs, but they are saying that they are going to look at how they can expand into Chinese markets, and probably that could be a fillip point that could come in there.
Right.
But no one knows because the waters are not yet tested, right? But currently, yes, concerns, no guidance given, and that's what the street is worried about. So I think these are going to be interesting names we should be watching out for.
In fact, want to mark out that Somit was one of the few who called out the Tata Tech
block deal, correct,
which is happening or which has happened today. So that was one block deal. But Somit, in terms of sentiment, and this is where it's starting to get a little bit tricky. You're seeing strong FI flows come in,
right?
But you're seeing markets largely being range bound. There's a period where we've seen, at least this week, last couple of days, where we've seen consolidation of sorts. Any idea as to where this will go from here? Is there a sense that you're getting?
So technical sense is that there is upside. There's this consolidation that we are seeing some kind of profit booking. We have seen a massive rally from 22,000 to 24,000. So for some time there could be some profit booking, but yes, on technical front, dealers are suggesting that there is potential upside from here as well.
Interesting.
So I think a range bound trade is what everyone is watching out for currently, because one, your trade war is behind, but where does your Indo-Pak geopolitical tension lead you to?
Correct.
Is what is the concerning area right now.
A bit of wait and watch.
Absolutely a wait and watch, because right now also you do keep hearing of what the kind of shelling that's happening. Plus you have J&K government who's gone ahead and shut down more than 50% of your tourist locations.
Yes.
So concerns around, but what happens next? And the impact that markets can take is anyone's guess, because we are not yet reacting in terms of the stock markets as compared to when there were previous war-like situations as well. So probably there is some bit of room on that one, but yes, a range-bound trade is what should be on the cards. But thank you, Somit, for getting us these details as well. We will be watching out for all of these counters. In fact, let's also welcome in Dharmesh Kant, Head Equity Research at Chola Securities, and Kush is already with us. Dharmesh, good afternoon and welcome to the show. Before I come to you on your view with regards to markets, I would want to take your opinion on what Soumit was indicating with regards to L&T Tech, KPIT Tech, as well as Tata Technologies. I mean, buy all these stocks suggested in multiple dealing rooms. How are you looking at it?
Yeah, good afternoon. See, I have a different view. I mean, as far as long-term investment is concerned, KPIT Tech stands tall in the pecking order. The numbers were excellent. If you look at the numbers so far, even for last 2-3 years, they have been outperforming their peers. At the same time, they have been delivering on what they have been guided for. Only thing the management did was candidly they abstained for giving a guidance for say 2-3 months. That is what they are thinking, that this tariff clarity will be there. But look at the business segmentation of KPIT Technologies. I mean, they have gained a very large traction in the Asian market, which has almost doubled from last 3 years where it was. At the same time, the deal pipeline flow from Europe is great, and US is piling up slowly. The management also said very clearly that the OEM manufacturers in Europe and US has woken up to the challenges being posted by Chinese OEM manufacturers in the car segment. And China is domestic. Whatever cars are being produced by China is largely being sold into China. They don't have a world market. So there's a sharp distinction between the two. I do think it's a prudent move from the management not to guide immediately. So there may be some slowdown in next 1 quarter or 1.5 quarter or so. But thereafter, it looks a decent play. The stock prices have corrected significantly, 30-35% from their highs. And valuations are comfortable. Given the order pipeline, I think both the stocks, be it Tata Technologies or KPIT Technology, looks better. But given a choice, KPIT would be a preferred buy from here on. And see, Tata Elxsi is also the same business, and it's trading at 45 times P multiple with a lower ROE multiple compared to KPIT Technology, where KPIT is at 41 times P multiple on a trailing basis. So it merits a buy, but one thing is very clear: whichever technology company you choose from the IT space, be invested into ER&D kind of a segment rather than a software play. SaaS and SAP is not preferred at current juncture. It's more of engineering, research and development.
So that's an interesting point coming in, Dharmesh, from the tech space. But before we head across to anything else, you have Ambuja Cement. The numbers have just come in. You have the net profit number, which is coming at 956 crores, wherein the street was estimating around 735 odd crores. So the profit number is above what the street was estimating. That's the number that we have so far, a 956 crores versus a 735 crores. In fact, I'll try getting in Mika as well to weigh in on this one. If you talk about the revenue number, 9,802 crores is where the revenue number has come in at. If you can just get that one back on the screens. But clearly in terms of the profit number, it's above what the street was estimating. Revenue, 9,800 crores, that's a mistake. It's an NDTV revenue estimate. Just if we can change that on the revenue screen, but the revenue number is also seeming to be above. So the profit has beat the street estimate. And if you talk about the revenue number as well, that's a beat. If you look at the stock price performance in terms of where Ambuja Cement goes, what is interesting on this one, Harsh, is the price hikes is something that the street was watching out for over the last couple of quarters. In the last 6 months, it's been meager, but in the last 1 month, Ambuja has seen gains of nearly around 2% that has come in there. So profit number is a beat. Your revenue number in terms of Ambuja Cement has been in line with what the street was estimating. Kush, let me come to you. What are charts indicating with regards to Ambuja?
Well, after a good run up, a lot of these names, the cement pack names are starting to see some sort of profit booking, closing in on their support levels. Now, if I talk about Ambuja very specifically, that support level comes at the 525 mark. You've had 4 or 5 sessions of profit booking on this one. So you might want to wait up, see if the support zone of 525 indeed is held. Also, I think seasonality factor will kick in, and that's why perhaps you're seeing after a good run up, a lot of these cement companies are now starting to cool off. So if you have 6 to 12 month kind of a horizon, then you might want to take this dip as an opportunity to buy. If not, you should actually take this opportunity to exit, because from the lower levels, most of these stocks, including Ambuja, have had a good run.
So that's with regards to where Ambuja Cement's technical view is concerned. In fact, Harsh and I were just debating as to who's going to take the next question and who's going to be the next speaker right now. But let's move on. The sector of the day today has been the defense pack. Let's just pull up the defense index, and that will tell you the kind of gains. There you go, 4.5 to 5% is the kind of up move. If you pull up a 5-day chart also of Nifty Defense, that will tell you the kind of gains that are coming in over here. And and this is taking cues from the way the individual stocks have moved in the last 5 trading sessions. There you go, 7% is the kind of up move, and the last spike is coming in the last 2 trading sessions. So we are going to take this as the sector of the day, where Mika has done all the crunching to tell us as to what is working. Mika, so in terms of the way the stock prices have moved, and if you have to compare it to the volumes, what is that telling you, and what are the key things that you're picking up?
Yeah. So, we've seen the stocks buzzing in trade today, and we've also seen a strong uptick in the last 5 days, as well as the volumes that we're seeing just today. So now the 5-day gains of something like a Paras Defense is 21%. Today itself, its volumes versus its 30-day average stands at 24 times. Data Patterns up 17%, Garden Reach up 12%, Cochin Shipyard up 10% in the last 5 days. Volumes as of today have ranged from the range of 3 to 8 times its 30-day average. You also have something like a Bharat Dynamics, a Mazagon Docks, Hindustan Aeronautics, a BEL. All of them have seen gains of 2 to 5% in the last 5 days. They all are buzzing in trade today, and they're also seeing higher volumes than what they usually do. Now, the India-Pakistan tensions and geopolitical stability, can drive defense policy formulation, increase military spending, as well as sector investments, and the overall investor sentiment around the defense-focused industries has historically been increased during times of geopolitical instability in India. Now, if you look at the order book position of some of the key counters that are buzzing in trade today, Paras Defense 900 crores as of March 25. You have a Data Patterns 1,184 crores as of Q3 of FY25. Garden Reach over 23,800 crores. You have Mazagon Docks sitting with an order book of 34,700 crores as of Q3. HAL at 94,000, the top of the list at Q3 FY25, and you also have something like a BEL at 71,100 crores. And you also had a note come out a few days ago about how the pipeline of these companies also provide opportunity over the next 3 to 5 years. HAL has opportunity at cost at 4.39 lakh crores, BEL at 1.13 lakh crores, and this is in over a period of time. HAL a 10-year period, but BEL a shorter term period of 2025 to 2027. Mazagon Docks has an opportunity of 2.46 lakh crores, a 2-year timeline for the same. You also have BDL 28,800 crores of opportunity lying in the potential pipeline of the company, and Cochin Shipyards at 37,800 crores. And lastly, something that was spoken about all month, and it actually came through yesterday, was an India-France deal. The deal was a 63,000 crore deal with France, where India will be procuring 26 naval variants of the Rafale fighter jets. Now, this will be procured from the French defense major, Dassault Aviation, and it includes a clause which is very important that pushes domestic production. The agreement includes setting up a production facility for Rafale parts in India, which could also bring further investments into the space.
Thank you so much, Mika, for covering that quite comprehensively. Surely sector of the day. Dharmesh, let me come straight to you. 4% yesterday, 4% today on top of that. How are you viewing the defense pack at this point? How are you viewing both valuations as well as the large opportunity which is available?
Yeah. Fortunately, Harsh, we were into defense segment for the last 9 months. So we did see 3-4 months of pain, but now the things have started moving on. Valuation wise, still, there's a gap. There's definitely a headroom out there for these companies to get to a +1 kind of a standard deviation. They have definitely crossed their mean levels. I think in the given environment with a lot of global and geopolitical uncertainties, and in that context, if you look at defense companies, there's a perfect ploy for them to be invested into, because their order books have been swelling hard and fast, and God forbid if this geopolitical tension escalates, then it will mean further business for these companies. And that is why we are seeing a traction. And I think this traction is likely to continue for some time, even if this traction for geopolitical point of view stops. Then also in the normal course of things, how defense spending has been happening and how the order book is being given by the government of India, because they are the ones who are basically revenue getter for these companies, is likely to continue in next couple of years. So we are having a long-term target on all these companies. And for example, HAL, we have a strong target. It's way above from the current levels, 5,500. But that based on FY27 earnings estimate. All these companies enjoy very healthy margin and a very good ROEs.
Point taken. Thanks for that view coming in with regard to the defense pack up 4% plus on for a second straight day. But let's bring on board Vivek Mathur, CFO of KFin Tech. Talk to us about how the numbers have panned out. It's been a soft quarter, Mr. Mathur, when I'm looking at the numbers sequentially. But that's understandable given the way in which markets have behaved. What's your anticipation with regard to growth within the new client base that you're looking to tap into and push? How is that coming through, and what are the plans with regard to new business?
Thank you for hosting me. New businesses are largely related to the international business that we are getting into with the acquisition of Ascent Fund Services Singapore, which is present across 18 countries, and they have offices in 23 offices in 13 countries, client base in 18 countries. And that is the one that we are looking at in terms of growth potential beyond the domestic mutual fund growth that we believe will be in the mid-teens. The international business based out of Southeast Asia is already growing at 25 to 30%, and so will the Ascent Fund Services Global Fund Administration business will grow at. And we believe that, we'll be the first Indian company who will be into the global fund administration space. There are many companies from outside India, who have global captive centers in India, but we, being a company which has been doing fund accounting, haven't gained any sustainable market share outside India. So this is what we are looking at in terms of growth trajectory. The 5% international business contribution today should grow to about 15% with the acquisition of Ascent. And we want to make it big in terms of the global fund administration space in offering state-of-the-art services with unique platform offering, LPGP reporting, which will give something new for the industry to look forward to at an affordable cost.
So that's with regards to where, the proposed acquisition of Ascent and integration goes. The momentum that you're seeing in terms of the new deal wins, how much of it will start contributing in terms of your top line, and what is the size on an average looking like?
So Hiral, on the RTA side, when we talk about platform deals or when we talk about fund accounting platform deals, we are already started winning deals, which are, 5-year TCO of about 18 to 25 crores. And these deals take a lot of time to win. It takes about 18 to 24 months of efforts to win these deals because, most of these companies have local partners or local vendors who provide these platforms. Somebody going from India and showing them state-of-the-art solutions with capability to do data analytics, compliance reporting, the entire transaction processing, fund accounting is very unique. Now, what we have been doing in India with almost 600 AIF funds in terms of services, we want to do something big like that in years to come. And as I mentioned, the current revenue contribution from the international business is just about 5-6%. We want to grow that to 25% in at least 5 years' time, starting with 15% immediately, and that 25% can be fast tracked in 3 years if things go well. So, and these are clients which range across different countries where the yield is much better than what you get in India. In India, we get about 3 bips on alternates, but outside India, it ranges anywhere between 6 bips to 25 bips. So the margin expansion with new client acquisition in times to come will definitely increase the margin profile as well as the EBITDA profile of the company. But yes, please. Yes.
Yeah, Mr. Mathur, sorry I'm interrupting, but you mentioned about margin expansion. This quarter, we've seen a contraction that's come in terms of margins. Yes, there is revenue diversification that the street is watching out for, which reduces your client concentration. However, the kind of diversification that you're looking at will mean sustained investments going ahead. And if that is going to be the scenario, will you be baking in compression in terms of margins for some time from here on and then see a gradual recovery once again? What is that trend expected to look like if you have to look at the next 3 to 4 quarters?
So let me first clarify that last quarter margin compression is largely because of one-off expense of M&A, which is 12 crore. If it was not there, the margin would have been 46% for the last quarter. And as far as our guidance is concerned, we continue to maintain that the EBITDA margins will be in the range of 40 to 45%. When the markets are good, you have seen 45, 46% EBITDA margins. When the markets are not so good, we will maintain 40%. Despite investments in terms of acquisition, which will be self-funded, we are a debt-free company, so there is no interest on the P&L, and therefore, funded through internal accruals will not have any significant impact in terms of EBITDA margins. So we expect FY26 to be neutral, and FY27 onwards, it should be accretive for the EPS. So we believe that the acquisition is something where they have just achieved break-even in the last quarter, and with scale and ability to grow and acquire clients on a global basis, it can only improve from here on.
Mr. Mathur, what is the strategy with regards to where acquiring large clients is concerned? Because, that is what is going to be crucial when you talk about your international business. So where are you on that in terms of trajectory?
So on the RTA side, we have already started winning large clients. As I mentioned, Areem, Amaraya, we have been winning large clients, the large TCOs that I talked about. As far as fund administration is concerned, this is just the start of global fund administration, where we have acquired licenses, people, and a set of clients through the Ascent acquisition. This actually lays the foundation stone for getting large clients in the global fund administration space, where Ascent can now, with the combined balance sheet and net worth of KFintech, can participate in larger RFPs, and they can start winning larger clients. Up till now, they were looking at, sub $500 million or sub $100 million kind of AUM clients. But now with the increased balance sheet strength and net worth and listed currency behind them, and funding being done by KFintech, I think the word is open to them. And as a combined entity, we are drawing up the synergy plan in terms of how do we leverage the global pool of $30 trillion of AUM. Coupled with the tie-up that we had done as an integration partner with BlackRock Aladdin, where they already have large clients. Our ability as a company which has got almost 1,100 IT people and a company which we acquired called Mobile App, coupled with the Hexagram platform, it's a very unique offering from KFintech, where we can design solutions, we can customize LPGP reports. There are hardly any fund administrators who will be able to do the customization that we aim to do. And that's the reason at an affordable cost, we will be able to disrupt the market. What you see in the global space, the yield in global fund administration is anywhere between 6 bips to 25 bips, unlike in India, where you just get 3 bips on alternates. So there is an opportunity, and I don't want to set high hopes, but we'll give you the proof of concept in the coming year in terms of how the acquisition will pave the way for a global business coming out of India.
Mr. Mathur, what will be those factors to look out for in terms of how you're progressing with regard to international? What are the geographies what geographies are you immediately planning to target, and what are those factors that you look for to understand that things are well on course?
So Harsh, it is largely, Singapore, Hong Kong, Dubai, Abu Dhabi, US. These are key markets, where the immediate focus is in terms of growth. We will look at Europe in terms of, UK and Europe in terms of, winning clients. So the immediate growth will be in these markets, and the number of client wins and the AUM that we gain will decide the way forward. So, we'll share with you as we go across quarter after quarter in terms of new client wins in the global fund administration space and the kind of AUM that we have been witnessing the growth in Ascent. They are currently at 24 billion, AUM and a 1.5 million revenue per month kind of a rate, which is $18 million annual growth rate. They have been growing tremendously in terms of almost 50% year on year. So we believe with more power in terms of ability to come up with innovative products, their licenses, their management team already present across geographies, and the infusion of capital, both primary and secondary in terms of acquisition. We believe that, it will be a debt-free book for Ascent in the, immediate coming 2 quarters, and they will start contributing healthy in terms of both revenue and profitability.
Thanks so much, Mr. Mathur, for coming in, speaking with us. Of course, a softish Q4, but otherwise very strong guidance with regard to what lies ahead. Wishing you all the very best for FY26 and beyond. And of course, we'll keep chatting.
Thank you.
Dharmesh, let me come to you. K-Fintech, it's a play with regard to capital markets and not just Indian now. They're looking at international business. You've heard the commentary, likely at least a part of that chat. What's the sense? Dharmesh, believe you're on mute.
Apologies for that. See, essentially, it's a BPO kind of a business, and that kind of a business we don't like, because as of now they may be gaining traction, but the copiers of the same business, and with AI coming into a huge way, technology can take over this business very fast. As of now, they may be gaining traction, and the valuation wise they are very expensive. So essentially, not a comment on the K-Fintech space, but a comment on the entire BPO kind of a business is what we don't like.
Point taken. The other one that's in focus today is Whirlpool India, and stock has hit a 3-month high. PE firms like Advent, Bain showing interest in the counter, 8% up. It's been a counter which has been beaten, especially after we've seen some amount of divestment by the promoter. Mahima here with all of the details. Mahima.
Right, so the stock did touch an intraday high of 11%, and the volumes are trading at 14 times as compared to its 30-day average. In terms of RSI, it is at 74. That is still indicating volatility in stock. In terms of what's happening, well, Whirlpool, the stake sale by parent is on cards. Equity firms are showing interest in acquiring the stake of the company. PE firms like Advent International, Bain Capital, TPG, EQT, Carlyle as well as KKR have shown interest as per media reports. In terms of how much Whirlpool Corporation is looking to raise, anywhere between $550 million to $600 million. Whirlpool Corporation plans to cut its overall stake in Whirlpool from 51% to 20%. However, Whirlpool Corporation will still be the largest shareholder in Whirlpool India. They've announced to cut their overall stake back in January, and this will happen in mid to late 2025 is what the company had said. They also plan to raise overall funds to pay off the debt that the Whirlpool Corporation currently stand at. In terms of what brokerages are penciling in as per how Q1 has panned out for Whirlpool Corporation, Investec has said that Q1 is strong for Whirlpool Corporation. This indicates strength overall for earnings of Whirlpool India as well in Q4 FY25. And Whirlpool India could clock mid-teens YOY revenue growth and could post 10% EBITDA margins as well. And this could be better than what street analysts are already expecting. So this is the overall view as to what's happening with Whirlpool India and why it is up in trade today.
Yes, so that's an interesting one in terms of Whirlpool India. But what's the irony over here is that the summers have been delayed, Harsh.
Yes.
And whether the business performance is going to be firing on all engines or not in the coming quarters is the key question for the Whirlpool India as well. But let's take
also, I want to quickly flag off a couple of things. So it's 17,000 crore in terms of market cap. The growth has not been very, very good with regard to this one. From 2018 to today, the top line growth is just about 50%.
Correct.
And therefore, it's a business which has not seen growth. despite that trades at a price to earnings which is just shy of 50 times. And this price to earnings, Hiral, fascinatingly, is well below the 5-year average P that the company posted has posted.
But see, that's the thing, right?
Times.
With all your consumption related companies, whether you talk about durables or you talk about FMCG, valuations have come off, but they are not cheap. You can just call it, as you mentioned, just shy from the below the average. But still, is this the time to buy? Or will these stocks again bounce back to these kind of valuations? Because how much pressure is coming in, we don't know. But can I just take a quick question?
We saw it in defense, and therefore maybe Dharmesh.
Yeah, Dharmesh, your quick view in terms of a Whirlpool as well as the other consumption names from this space.
See, as far as Whirlpool is concerned, stay away. The business has done nothing, and you need actually very strong promoters to pull the business up. So if you don't need investor promoters, you need promoter who has their skin in the game. So that's the point number one. Second is point number two is the consumption space. Much has been talked about it, but it's not picking up. That's a fact on the street, in spite of tax cuts benefit coming into play, and your interest rate cut is also down. But I think 2-3 years of good consumption has already seen the cycle. So it's a year of a consolidation. You need a year gap, then again you replenish or again replace your consumption durables. So this year it will be difficult for all these Whirlpool, Voltas, Blue Star, everybody will see more of a consolidation.
Coach, let me quickly have your view, because Mahima quoted a few indicators even from a technical perspective which are relevant at this point. 8% high on a Whirlpool.
Harsh, it's a momentum play now, and if you ask me, this is the only play in the sector. Most of the other competitors or most of the other peers of this company have actually seen a bit of a short run up over the last few weeks. This is the only one which is sort of breaking out. The volumes have actually been staggering. If you see last 2 out of the 4 sessions, so a very high delivery markup. The resistance level was around the 1235 mark. That's been taken out. So I think this rally could still extend for some more time. So if you have a position, keep your stop loss around the 1235 mark, and ride the wave. If you don't, then play. Then you could still play. As I said, this is a momentum play. Still some distance from overheating. So it could head to the 1325, 1375 zones on the way up. And if you hit those targets, it's a good idea to take the money off the table, because by then the stock would have overheated.
Okay, so that's the view coming in on Whirlpool. What we're going to have to do is we're going to slip into a very short break. We'll also thank Dharmesh and Kush, both of you, for joining us this afternoon, giving us all of those views. As always, good having you all gentlemen. On the other side, we'll again go a little bit more stock specific now. We'll talk about a few counters quickly and get you top buy today, sell tomorrow picks as well. Stay tuned.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% of the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. last 1 month, if you see the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking.
Now, one of the stocks standing out in trade today is UCO Bank, and that's why what we've tried to do is, after speaking with management, we've tried to highlight both the bull case as well as the bear case with regard to UCO Bank. Let's start off with the first bull case. There's strong growth both in loans and deposits. In fact, it's beaten the guidance that they've given for FY25, and FY26 guidance also looks decent, 12 to 14%. They're saying that we'll give a conservative guidance, we'll try to beat it this time around as well. But what's not looking good is the margin picture. The margins currently at 3.17%, expected to be between 3 and 3.1%. So you'll see some bit of margin compression. Now, when it comes to the way in which that might impact profitability, of course, there will be a bit of a squeeze, and that might impact profits as well. So something to keep in mind. Let's talk about asset quality. There has been improvement in asset quality. Recoveries have been better than anticipated, and some of that is playing out on the numbers as well. However, credit costs may inch up a little bit. Now, credit cost is the net of the quantum which has been recognized versus the quantum which has been recovered. So the recoveries that have come through is around 4,500 crore versus the 3,000 crore number which was anticipated. So you are likely to see credit costs inch up, given that there's already been a solid recovery this year. Likely next year the recoveries are going to be lower. That's already what has been built in, and therefore you might well see that inch up happen next year due to lower recoveries. Now, my third piece is with regard to ROA. Therefore, the ROA is up sharply on a year-on-year basis. They've guided for a 1% ROA by FY27. Could there be a downside risk to it? For sure, if there is equity dilution, and that is needed at this point, given that the government still owns nearly 90%. So therefore, the equity risk dilution could well dilute ROA as well. So something to keep in mind with regard to profitability. Last piece is with regard to how the valuations are stacking up. At 1.34 times price to book value, this is trailing 12 months, it's still at a discount compared to the 1 year average of 2 times. So the stock's fallen 45% in the last 1 year, and the price is below the QIP price. So currently, that may continue to keep investors pressured and the stock too under pressure. Now, I want to quickly take a view from Kush first off. Kush, give us a technical view. Okay, sorry, I apologize. Aditya Agarwala joining us and Mr. Chokalingam also joining us. Apologies, guys, I was still on the other side of the break, so so hence. But Aditya, give us a technical view with regard to a UCO Bank.
Hi, Harsh. Afternoon. Thanks for
Hi,
the
good
show.
afternoon.
I think it's a good bet given the fact that the stock has already corrected significantly from 60 to about 30, sub 30 odd levels. And I'll be in the bull camp, honestly. I think offers an excellent risk to reward. As I mentioned on the downside, I think 28 to 29 is a very good support zone. And from here on, if actually the rally starts and builds onto it, the first the target that I get to see is 40 bucks, and from there, if actually it builds on furthermore, it can actually test levels of 46 as well. So 40, 46, these are two targets for me on the stock. On the downside, stock, as I mentioned, has very good supports around 28, 29 odd levels. So give or take another 1 or 2 rupees, I think so. Stock is very good from current levels. The volumes are excellent in the build up that we're seeing in the stock. So overall, just going purely by the technical setup, I think one should add the stock in the portfolio, ride it for at least few quarters, and look for a target of 46 on the upside.
with a UCO bank, if you have to look at the immediate peers like a Central Bank of India and I think, if I'm not mistaken, a Bank of India? Central Bank
and UCO, both of those declared numbers.
Correct. No, I'm saying in terms of its peers, do I look at a Central Bank of India and a Bank of India?
Yes, Union
in terms
Bank,
of the closest
yes,
ones, right?
Yes.
So, Mr. Chokalingam, if you have to consider the PSU banking space and the same category in terms of size as well, how would you look at it, taking the numbers into consideration and the outlook going ahead?
Yeah. First of all, an outlook for PSU Bank, I think it will be very, very robust. Because the banking sector itself is expected to grow in double digit. It is one of the few sectors among all the sectors to continue to post double digit growth in a core business parameter, namely credit. Now, within the banking sector, I am extremely bullish on the PSU banks for simple reason that today, access to low cost deposits is very, very critical. And there, the PSU banks score a lot. Many of these banks are able to maintain the CASA deposit, low cost deposit ratio, thanks to vast branch network. Now, that is proven to be an advantage in retaining the CASA deposit and also growing the deposits. Now, coming to individual PSU banks, or rather public sector banks, I strongly recommend Bank of Maharashtra. I personally do not own the stock. We have a buy recommendation on this. This I consider as the best bank, not only among PSBs, on the entire banking pack. With a net NPA of 0.18% and business advance growth of around 21%, double-digit strong profit growth, I think this is a fabulous stock. Now, coming back to UCO Bank, on standalone, UCO Bank also looks very impressive. Net NPA has come down dramatically. And even the advance growth has been around 18% year on year. It was able to grow the deposit also. But in relative terms, I would favor Bank of Maharashtra for the simple reason that its net NPA is only 0.18%, the best in the industry. And that, in terms of valuation also, it is comparable to UCO Bank. But in terms of growth, quality of assets, and other business parameter, Bank of Maharashtra is far superior.
Mr. Chokalingam, Bank of Maharashtra has been your favorite, I think, since the time I have been into media. I think it's been the last 10-12 years you've been liking this stock pretty closely, right?
Very interesting. What I learned is that we should not be emotionally attached to stock forever. The same Bank of Maharashtra, 2-3 times I gave sell call also. Luckily, last time also we had a coverage, but when it played out, we gave a sell call. After it has crashed from 72 to around 50 level, once again we have reinitiated. So I would say that investors should have a long-term investment horizon in mind. But if something what you are expecting in 3 years down the line, if you are getting in a year's time, you should not hesitate to book the profit based on the valuation parameter. So at 72, it was a great sell, but around the 51-52 range, I believe it's a great buy based on the fundamental parameters as I discussed.
Perfect, and that's an interesting one to watch out for in terms of Bank of Maharashtra. But very quickly, I would want to address, what Maharashtra CM has said in terms of the EV policy. In fact, the Maharashtra cabinet has gone ahead and approved the new EV policy. And what they are saying is that the passenger electric vehicles are expected to get subsidized from here on. Certain electric vehicles will be getting toll exemption as well under the new EV policy. And the major reason why they're looking at the new EV policy is to boost consumption and develop the charging infrastructure. That is what has come in so far in terms of the new EV policy. You're not seeing a major reaction that's coming in terms of stocks that could be seeing momentum, because the quantum is not something which is known, but you still have a Hyundai Motors which has recovered from the day's lows. Right now it's seeing gains of around 0.8%. M&M still continues to rule under pressure. Tata Motors is another one. Maruti Suzuki is slightly in the positive, but almost on the borderline. Ola has inched up slightly right now with gains of around 0.8 to 0.9%. And I think with Ola, what's interesting over here is the Ather part of it. I think we will try getting Puneet to get us more in terms of, where the auto pack goes. But Aditya, very quickly, your view in terms of auto OEMs, what are charts indicating? Are you seeing any value by taking into consideration how TVS Motors has reported numbers? What are charts indicating?
Hey, good afternoon. Now, I think more than the four-wheeler space, I'll be more interested in looking at the two-wheeler space because I think a lot of rally in the four-wheeler space has already played out. If we talk about Mahindra and Mahindra, almost trading at life highs, close to about life highs. Maruti too has been inching up gradually. So I think a lot of correction which had played out in the two-wheeler space offers an excellent risk to reward and a comfortable position as well to go fresh long either on a Bajaj Auto or a Hero Moto or a TVS Motors. All three stocks for me stands out. And I think if you stay put here for at least couple of quarters, you're going to see a decent run up in these stocks. Talking of Bajaj Auto, I think 9,500 to about 10,000 can be seen in about a quarter's time or maybe a couple of quarters' time. If I talk about Hero Moto, that too I think offers an excellent risk to reward even at current levels and can be bought for a target of 4,600 to about 4,800. TVS Motors, like you mentioned, reported numbers yesterday, and after that it's come slightly under profit taking, and this is one stock which has actually outperformed its peers. But I still feel that this has more room on the upside and can easily test levels of 3,000 as well. Apart from this, I think Ashok Leyland from the CV space is something that is looking very interesting to me, and one should look at the stock from a longer to medium term time horizon. And here you can look at a target of 260 to about 280 as well. So the top three two-wheeler space bets for me are Bajaj Auto, Hero Moto, and TVS Motor. And from the CV space, I think Ashok Leyland is something which is looking very attractive to me. At the moment, I would avoid getting long on either a Mahindra or a Maruti kind of a stock.
And Aditya, a very quick view with regard to a Sona BLW. The stock is buzzing today. So your quick take?
Oh, definitely, Harsh. So it has popped up, but again, and it has popped up on very good volumes. But here I'll be a little more cautious because this is this could be a dead cat bounce as well after what we had seen, a massive correction in the stock. So on the upside, I think 530 is something which will act as a major resistance for the stock. Yes, there's a trading bet in the stock. One can look at going long purely for a trading perspective for a target of 530 on the upside with a stop loss at 470 on the downside, because volumes are suggesting that this up move which we are seeing in trade today is likely to continue for a few more trading sessions, and 530 will be the area where I'll take a call whether I want to stay put in the stock or whether I want to exit and book out of profits.
Okay, so that's with the Sona BLW, but staying with the auto pack, you have a Tata Motors. In fact, UBS has come out with their bearish view on a Tata Motors, and I think that's what is keeping Tata Motors on the tender hook. Puneet, what is UBS alluding to with that bearish note?
Well, thanks for that. So the key news item is that there could be some concessions in terms of auto tariffs for auto parts specifically going into the USA, which are locally manufactured or assembled, and that's the reason we are seeing some positive momentum on stocks like Sona BLW. But on the other hand, UBS has mentioned that there could be no potential benefit of this to someone like a Tata Motors. They maintained the sell rating target price of 760 rupees per share, and the key aspect they're mentioning is that the concession could only be for imported parts for cars made in the USA, and currently Tata Motors exports all of its cars from UK as well as its facilities in Europe, possibly for JLR only. So that's one of the key reasons that there could be no benefit if these tariffs are eluded, at least for the auto parts specifically. They've also said that recently we've some downgrades from Porsche in their earnings call yesterday, and that is another key negative for JLR overall in Europe as well as the growth outlook. So that's the key reason that they are maintaining that even if there's some concessions that come in from the Trump administration for auto, it could only be for auto parts and not for cars imported completely into the USA.
Interesting take. Puneet, while we have you, there's plenty of excitement around the Ather Energy IPO as well, and they're aiming to raise roughly 3,000 odd crore. IPO closing tomorrow, of course, so open between today, rest of the day, as well as tomorrow through the day. What can you share about this one and give us some context, compare that with the current listed peer?
Well, yeah, definitely. It's a very interesting time that the company has chosen for an IPO. They were expected to come in with a higher size effectively as well as a little earlier as well. So they've reduced the IPO size now to roughly 2,900 odd crores. The fresh issue component of it is roughly 2,696 crores. And out of that, the offer for sale will be for 353 crores. And there'll be the biggest shareholder, which is Hero MotoCorp, won't be selling out any kind of stake in this IPO. Now, there are three key things we are looking at. What is the use of the proceeds, and that's very interesting because they are looking to invest roughly 927 crores in a new facility in Maharashtra. And that's largely because most of their parts are actually outsourced. Most of the manufacturing is outsourced. It's only the battery pack that they currently manufacture as well as design in their own facilities, and then later on assemble the whole product in their factory. But they are looking to invest in their third plant. They've also earmarked a huge sum of 750 crores for R&D specifically, and that's something that the company prides itself on. Apart from that, some expenditure towards marketing is of course 300 crores and some other expenses of 40 crores. The second key aspect I want to look at is the financials. Now the losses, while they moderated compared to FY24, the company's gross margins have increased from 9% to 19% from FY24 to 9 months of FY25. But the loss is still there in terms of EBITDA. They reported an EBITDA loss of 23% on the downside. So negative.
Sorry, I'm going to interrupt you over here. We have the trend numbers that have come in. The profit number has come in at 349 crores versus an estimate of around 300 and odd crores that NDTV Profit had. So the profit number is above what the street was estimating. In fact, you're seeing that spike in terms of the stock price as well as we speak. 2.5% up move coming in on that counter. So far, I have the profit number with me, 349 crores. So a beat in terms of where the net profit goes to an extent. That's the number that you're looking at in terms of the profitability. Let's see what are the other numbers that are coming in so far. But overall, if we can just have the release, because the expectation was also pretty interesting from Mahima, or what she got for us as well. Let me just pull up the preview. Yeah, there you go. The revenue number we were looking at is around 4,131 odd crores. So that is what you were watching out for. Profit 302 crores, what the street was estimating. 349 is where it's coming at. 4,100 crores is where the revenue is at. So that's also pretty much inline number, Harsh, because 4,131 was what the street was estimating. 4,106 is where the revenue has come in at. Yes. Interesting is going to be margins, because there was an expectation that there could be a dip of around 30 basis points at around 14.7% versus a 15%. So we'll just await the EBITDA and the margin number. But at least in terms of the revenue, it's pretty much in line. In terms of the profit also, it's somewhere higher. I think, and 1 second, I think that number has just got revised. No, but the number has just got revised to an extent. Yeah, it's higher than the estimate, but it's down because a 54% cut is what we were expecting. But still, I think the street is taking it with a positive stride. A 46% downtick coming in terms of where the profit number goes. So
but the expectation was 300.
Correct,
so
302 was the expectation.
Beat.
Correct, so a 15% beat in terms of the profit number. Yes. Revenue has been in line. In fact, Mr. Chokalingam, very quickly, only we have the two numbers for you right now in terms of the top line, which is pretty much in line with what the street was estimating. The profit number has been 15% above what the street was estimating, but still it's a downtake. Your view?
Yeah, I would sell the stock. I looked at the number just now. Not comfortable with the P ratio considering the year-on-year revenue growth and profit growth.
So you would say a sell on rise should be a strategy with regards to trend, taking into consideration the valuations versus the performance. Aditya, very quickly, your view in terms of what are charts indicating for the trend right now, because it's been an absolute volatile ride for the counter. It has moved up quite sharply as well. Today as well, it's seeing a good spike. Opportunity to sell?
Not really, Hiral. I think I have a slightly divergent view. The chart suggests that there can be a pop in the stock, and stock will make an attempt to test its 200 DMA, which is closer to about 6,500. So I see probably a 1,000-point up move in the stock from here on. And mind you, the stock has already witnessed a decent bit of a correction, and after that, instead of correcting, stock entered into a consolidation phase. So if anything, I think with a stop loss at somewhere around 5,000, one should look at entering fresh long and look for a target of 6,500. If everything remains the same, I think stock is poised for an up move from here on.
That's with regards to trend, but a good spike coming in on that one. But we'll quickly slip into a short break. Please stay tuned.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% of the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments?
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bhogna. Now let's get straight to the show. US benchmark indices that began the day on a stronger note ended Tuesday's session marginally higher in the green. The Nifty 50 concluded trading above 24,300 levels and the 30-pack Sensex ended flat. Broader markets outperformed the frontline indices with the Nifty Midcap 150 and the Nifty Small Cap 250 ending above 0.2% higher. Most sectors lost weight with pharma, metal and media bearing most losses. The sectoral pack was led by three gainers: defense, information technology and oil and gas. Market breadth ended skewed in favor of the bears. TVS Motor shines in Q4, posting strong numbers and increasing market share. The management is also optimistic about the overall growth. Ahead of the conference call, the company mentioned a PLI benefit of 0.5% of the total Q4 of FY25 revenue. Now, TVS Motor's new brand, Norton, will be launched by the end of FY26. The company is also expecting growth momentum to continue in this financial year. Brokerage firms also released their notes on TVS Motor after the company announced their Q4 results. Macquarie rated and outperformed, setting a target for the stock price to reach 3,045. Nuvama maintained a buy call with a target of 3,020. One of the key reasons behind optimism was the rise of domestic two-wheeler share, which has gone up to more than 17%. TVS is also working towards transitioning to EV. Adani Green reported stronger than expected Q4 earnings. Revenue, EBITDA and net profit all saw a rise in this quarter. One of the biggest reasons that helped the earnings was the 37% annual increase in the power supply revenues. In fact, the revenue and EBITDA rose by 22% from the power supply alone. So the biggest capacity growth was driven by commissioning solar and wind plant. Castrol India saw double-digit growth in this quarter. This comes despite external pressures weighing on the sentiment. They also had new launches and expanded their distribution network, which helped improve their business. Now, Castrol's volumes largely actually grew from the relaunch of Castrol Active and continued traction in the rural markets. Nifty 50 heavyweight Trent announced its Q4 results. The net profit of the company is down 46% and stands at 350 crore rupees. Revenue is up 29% at 4,106 crore rupees, while EBITDA has increased by a fat 87.5%. Now, the company recorded an exceptional gain of 576 crore in this quarter. Onto an NDTV Profit exclusive where sources have confirmed that a block deal is expected to take place in Tata Technologies, where TPG Rise may sell off their 15.86 million shares in the company. Now, sources say that price range of the sale will be in between 670 to 699 per share, which is at 5% discount to the current price. The remaining shares will be locked in for 60 days. Now, BofA Securities will be the sole banker in this deal. While tensions escalate, cross-border terrorism intensifies and retaliatory rhetoric bitters. Defense stocks have been rallying as much as 12%. A combination of geopolitical developments, market dynamics, and the strategic role of defense companies is adding fuel to the fire. The Nifty Defense Index jumped 4.5% on April 28th, marking its strongest intraday gain since mid-April. Nifty Defense was in fact one of the top sectoral gainers today as well. Gensol Engineering's woes don't seem to see an end. Now the ED has also stepped in and reportedly conducted search and seizure operations at the company's Ahmedabad and Gurgaon premises. Now some documents including electronic devices and other financial records were seized. Order has also been issued to Axis Bank, HDFC Bank and ICICI Bank under EMS and the IT Act, as these banks were lending out money to Gensol. Share price of Adani Total Gas rose as much as 1.3% in early trade on Tuesday after the company posted a 9% rise in net profit for the quarter ended March. Now, consolidated net profit increased by 8.5%. Compared to 142 crore in the previous quarter. Revenue from operations rose 3.6% sequentially. The combined compressed natural gas and piped natural gas volume grew to 263 million metric standard cubic meters in the fourth quarter, marking a 13% increase year-on-year. PCBL Chemical reported a 10% drop in quarter 4 of FY25. Consolidated net profit 100 crore rupees. The drop was largely driven by higher finance and depreciation cost. Revenue rose 8.2% to 2,087 crore rupees, reflecting strong sales volume growth. EBITDA fell 3.8% with margins contracting to 14.3% due to rising material cost and employee expenses. Infosys terminated 195 trainees at its Mysuru campus after they failed internal assessments, marking the fourth layoff round in 2025. The trainees, part of the October 2024 batch, failed the generic foundation training program despite multiple attempts and support. Infosys is offering 1 month's salary, travel allowances and free upskilling programs through the NIIT and Upgrad, with 250 trainees opting for 12 or 24-week courses in BPM or IT fundamentals. Additionally, 150 have chosen outplacement services to explore external job opportunities amid a challenging demand environment with 0 to 3% projected revenue growth for FY26. And giving you some exclusive news about Sami Hotels, nearly 3.9%, nearly actually 4% equity changed hands of the hotel chain operator in trade today. Dealers indicate that it was largely a cleanup trade by one of the pre-IPO holders, and buyers are likely a global asset management company and a domestic mutual fund that already own a stake in the company. Share prices of India's largest coal producer, Coal India, fell over 2% from the day's high on the back of high selling seen from large high net worth individuals. Now, this came in anticipation of weak volume offtake despite improvement in power demand. Multiple dealing rooms suggest buying L&T Tech and selling KPIT Tech and Tata Technologies as a trade. L&T Tech is a diversified ER&D player, while KPIT Tech and Tata Tech's growth rates are challenged due to their 100% auto exposure. As per our sources, as much as 7 municipalities are in talks to finalize their fundraising plans by way of bond issuances, Varanasi, Prayagraj, Chennai and Pimpri Chinchwad are planning to launch their issuances in the next 10 days. While Varanasi Nagar Nigam has already uploaded its 7-year bond for bidding on May 6, Pimpri Chinchwad Municipal Corporation, Prayagraj Nagar Nigam and Greater Chennai Corporation are also likely to tap the bond market in the coming days. Canara HSBC Life Insurance filed draft papers for its initial public offering on Tuesday. Now, this takes place just days after Canara Robeco submitted its own draft papers. Like Canara Robeco, Canara HSBC's IPO will be a pure offer for sale, where Canara Bank, HSBC Insurance and Punjab National Bank will be selling up to 23.75 crore shares. Now, since this offer, is just a stake sale, no funds from the proceeds will go to the company. Global Health will acquire 3 acres of land in Guwahati from Assam Electricity Grid Corporation for 30 crore rupees to build a 400-plus bed super specialty hospital. Approved on April 28th, the 500 crore rupees project will offer over 20 specialties, including transplants and robotic procedures, aiming to serve 50 million people across Assam and neighboring states. Indian Railway Finance Corporation reported a 3.8% year-on-year revenue increase to 6,723 crore rupees in Q4 of FY25. Now, the revenue was mostly driven by higher interest income from railway loans. However, net profit dipped 2% to 1,681 crore rupees due to elevated expenses of 5,041 crore rupees. The board approved raising 60,000 crore rupees for FY26 through bonds and loans. As per our sources, Jammu and Kashmir government has shut down dozens of resorts and more than half of the tourist destinations across the Union territory. The preventive measures follow security concerns raised days after a terror attack at Pahalgam left 26 civilians dead. At least 48 resorts have been closed in the region. Several popular tourist spots, including Dudhpatri in Budgam and Verinag in Anantnag, have also been declared out of bounds for the visitors. India has flagged the Pakistani minister's open confession to training and funding terrorists at the United Nations. Yojna Patel, Deputy Permanent Representative at the UN, said that the Pahalgam terrorist attack represents the largest number of civilian casualties since the horrific 26/11 Mumbai attacks in 2008. Air India is set to expand its Delhi-Tokyo Haneda service to daily flights starting June 15. Flights shifting from Narita to Haneda effective March 31st will cut travel time to central Tokyo to 30 minutes. An expanded codeshare with ANA offers seamless connections to 6 Japanese cities, boosting tourism and trade with 2.3 lakh Indian visitors to Japan in 2024. The Supreme Court of India has allowed Delhi Metro to cut down trees for the Indralok corridor and Lajpat Nagar corridor under strict conditions. The approval was given to DMRC for Phase 4 of the Delhi Metro. The permission was granted based on the CEC report. Solicitor Tushar Mehta, appearing on behalf of the DMRC, assured that the court will strictly follow all the conditions imposed by the Central Empowerment Committee. The Cellular Operations Associations of India told in a statement that spam activity is seen to be shifting from telecom networks to OTT communication apps. The telecom service providers had already taken strong measures against the unsolicited calls. Now, their statement also said that responsibilities of OTTs should be taken by the respective ministries and not telecom service providers. The association has also asked for regulatory rules for both telecom service provider as well as OTT platforms. Maharashtra CM Devendra Fadnavis announced financial assistance of 50 lakh rupees for the families of the deceased from Maharashtra who lost their lives in the Pahalgam attack. The state government will also focus on the education and employment needs of these families. The girl from the Jagdale family will be given a government job. In his April 29 victory speech in Ottawa, Canadian Prime Minister Mark Carney declared the end of Canada's traditional economic and security relationship with the United States. He cited US President Donald Trump's 25% tariffs on Canadian vehicles and parts as a betrayal and an illegal trade war. He emphasized Canada's need to pivot to new trade partners like the EU and reduce reliance on the US, which receives 75% of the Canadian exports. Now, Carney vowed to negotiate with Trump post-election as equals, leveraging Canada's energy exports and exploring global trade options to ensure prosperity. US President Donald Trump has signed an executive order requiring truck drivers in the United States to be proficient in English, a move that has sparked concern among Sikh advocacy groups. Now, they argue the measure could disproportionately affect members of their community and create unnecessary barriers to employment. Russia says that Ukraine has not responded to many offers by Russian President Vladimir Putin to start direct peace negotiations and that it was unclear whether it would join a 3-day ceasefire. Now, Kremlin spokesperson said that it was President Putin who repeatedly said that Russia is ready without any preconditions to start the negotiations process. Putin on April 28 declared a 3-day ceasefire in the war in Ukraine from May 8 to 10 when Russia plans lavish celebrations to mark the 80th anniversary of the victory over Nazi Germany in World War II. Well, with that, viewers, it's a wrap on Market Express, but please stay tuned to NDTV Profit as there's more lined up ahead on the other side.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company?
The Nifty Sensex end flat for the day with marginal gains. Nifty IT emerges as the top sector for the day, led by LTIM Mindtree and Tech Mahindra. Nifty Defence was the star sector on the NSE today, jumping over 3% after last week's sharp sell-off that had the sector reeling. Defence stocks are now rebounding, with all 16 stocks in the Nifty Defence Index trading higher. Sources tell NDTV Profit telecom companies plan to approach TRAI to address security concerns surrounding OTT messenger apps. Security gaps in apps like WhatsApp, Telegram, Signal and others are expected to be highlighted for review. The government using spyware for national security is not wrong unless it targets civil society, says the Supreme Court while hearing petitions linked to the Pegasus case. The court also said details of an investigation report into the snooping allegations cannot be made public because it concerns the security and sovereignty of the country. The Central Consumer Protection Authority issues notices to 5 Delhi-based restaurants for continuing to levy mandatory service charges on customers despite a Delhi High Court order upholding guidelines that prohibit the practice. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. The Nifty and Sensex ended flat for the day with Bharat Electronics and Tech Mahindra emerging as top gainers in Nifty. Sector-wise, Nifty IT stood out as the top performer while Nifty Oil and Gas extended its upward trajectory for the second consecutive day. My colleague Harsh is here with a wrap of all the market action.
Well, an absolute flat day with regard to where markets were at. So, essentially nothing to complain about, frankly. In terms of certain movers on the Nifty, well, Trent saw a last, 15-minute kind of surge within the Nifty 50 pack. Trent was one of those, 5% higher on the back of earnings. It was a margin beat, a PAT beat, which led to that last ditch surge in the stock price. We'll have to wait and watch as to how analysts look at views and how the stock opens tomorrow. On the contrary, you saw some stocks, some heavyweights doing very well pretty much through the day. IT stocks were one pack. The other was Reliance Industries, which did fairly well and kind of did their job to hold the index up to close flat in trade. What didn't do well were largely pharma and financials. Those were the two baskets which didn't do as well, especially some of the private sector banks were a tad bit lower in trade today. In terms of the advanced decline, the breadth was absolutely flat, 1:1, right towards the end, and there was plenty of choppiness in that breadth, at least in the initial phase of trade at the start. When you're looking at sectors, the defense sector was one sector which was in focus, 4% up yesterday. On the back of that, it rose another 5% in trade today as well. So good day with regard to where defense is concerned. Some stocks really buzzing and were some of the top gainers even within the BSE 500, a Mazagon Dock, a Cochin Ship, a Data Patterns, which is some of those names which were absolutely abuzz. In terms of earnings as well, you saw some PSU banks do well on the back of earnings. Something like a UCO Bank stood out in trade today. Within earnings, Hudson Agro was one which didn't do as well on the back of numbers. So it was a bit of a day on which the numbers too dominated the way in which stocks moved. So you saw some movements there as well. Lastly, you saw a muted move both on the mid cap and small cap index, a 1/5% higher on both of those. So that's how the day broadly played out.
Thanks, Harsh, for that. But meanwhile, we also saw the defense sector emerging as the highlight of today's market session, recording impressive gains of nearly 5%. And this remarkable performance underlines growing investor confidence and positive sentiment surrounding the sector, growing after the government hardened its stance on security.
We've seen the stocks buzzing in trade today, and we've also seen a strong uptick in the last 5 days, as well as the volumes that we're seeing just today. So now the 5-day gains of something like a Paras Defense is 21%. Today itself, its volumes versus its 30-day average stands at 24 times. Data Patterns up 17%, Garden Reach up 12%, Cochin Shipyard up 10% in the last 5 days. Volumes as of today have ranged from the range of 3 to 8 times its 30-day average. You also have something like a Bharat Dynamics, a Mazagon Docks, Hindustan Aeronautics, a BEL, all of them have seen gains of 2 to 5% in the last 5 days. They all are buzzing in trade today, and they're also seeing higher volumes than what they usually do. Now, the India-Pakistan tensions and geopolitical stability, can drive defense policy formulation, increase military spending, as well as sector investments, and the overall investor sentiment around the defense-focused industries has historically been increased during times of geopolitical instability in India. Now, if you look at the order book position of some of the key counters that are buzzing in trade today, Paras Defense 900 crores as of March 25. You have a Data Patterns 1,184 crores as of Q3 of FY25. Garden Reach over 23,800 crores. You have Mazagon Dock sitting with an order book of 34,700 crores as of Q3. HAL at 94,000, the top of the list at Q3 FY25, and you also have something like a BEL at 71,100 crores. And you also had a note come out a few days ago about how the pipeline of these companies also provide opportunity over the next 3 to 5 years. HAL has opportunity at cost at 4.39 lakh crores, BEL at 1.13 lakh crores, and this is in over a period of time. HAL a 10-year period, but BEL a shorter term period of 2025 to 2027. Mazagon Docks has an opportunity of 2.46 lakh crores, a 2-year timeline for the same. You also have BDL 28,800 crores of opportunity lying in the potential pipeline of the company, and Cochin Shipyards at 37,800 crores. And lastly, something that was spoken about all month and it actually came through yesterday was an India-France deal. The deal was a 63,000 crore deal with France, where India will be procuring 26 naval variants of the Rafale fighter jets. Now, this will be procured from the French defense major, Dassault Aviation, and it includes a clause which is very important that pushes domestic production. The agreement includes setting up of production facility for Rafale parts in India, which could also bring further investments into the space.
Right, Mihika, thank you so much for that update. And moving on, the IPO of electric vehicle pure play company Ather Energy Limited has been subscribed 27% so far on day 2 of bidding. It is higher from its subscription of 16% on the first day on Monday, but we're seeing non-institutional investor subscription was at 26% as of 3:30 p.m. And moving on, major telecom players are preparing to raise concerns with TRAI over the security risks posed by OTT messaging apps like WhatsApp and Telegram. Sources reveal that telcos are advocating for stricter regulations on encryption, user traceability, and SIM card linked access, highlighting increasing instances of cyber fraud. For more details and expert insights, let me turn to Aishwarya, bringing us all the details from the ground.
Well, that's correct. We're picking up from our sources that telcos will be reaching out to the Telecom Regulatory Authority of India as they have seen some security concerns, specifically the 2-3 instances that you mentioned with respect to OTT messenger apps. As far as telcos are concerned, they have been handling frauds as well as spams through their own telco system. But what they're saying is now the spam as well as fraud instances have grown through the OTT messenger applications such as WhatsApp as well as a couple of other messenger apps that you find on most of these Play Store, including Telegram as well as Signal. So what they will be doing going ahead is talking to TRAI about loopholes in these OTT messenger apps. One of the instances, of course, being that when you remove your SIM card from your mobile phone, your WhatsApp continues to function even on Wi-Fi, but that does bring up the concern of traceability of the user in case a fraud is committed through that particular WhatsApp number as well. So that is one. The other part is about a different kind of fraud that is committed through hidden messages, and encryption is actually embedded into a photograph, which is again flagged off by COAI as steganography. This is one of the ways that cyber frauds do happen, and they also do pose a new cybersecurity concern or threat. These are two of the main issues that will be spoken of, but there are larger issues that TRAI has been flagging off as far as these OTT messenger apps are concerned, and encryption also, that should be opened up for some of these law enforcement agencies is what they will be mulling. So that's the update as far as this particular news is concerned. Back to you.
Right, Aishwarya, thank you so much for bringing us those updates. It remains to be seen what action the TRAI actually takes with regards to these apps. And now the implications for users and OTT platforms could be significant. Striking a balance between privacy and security regulations will be a challenge for policymakers. So for an in-depth analysis, let me quickly go across to my colleague Himakshi for more insights on this. Himakshi, over to you.
Absolutely, Sanjana. So as you know that the telecom operators are actually planning to approach TRAI to flag serious security lapses around the OTT messenger apps like WhatsApp, Signal or Telegram. So, what are these security gaps that are being flagged first? Let me just take you through that. So apps that work without a SIM card, makes it very hard to track the scamsters. Also, the encrypted messages often block the investigations. And now these hidden messaging features, so these are rising very sharply. So what this means for users, now this could mean tighter security checks for the users. Login verifications may actually become stricter across, could be tied to an active SIM card, and users might see increased data oversight by the authorities. Also, there's also a concern which is the end-to-end encryption that may be diluted. And why this matters for OTT platforms? So for apps like WhatsApp, Signal or Messenger, it spells higher regulatory pressure, a need to rework the security systems, and also a tough task of balancing user privacy with national security demands. Back to you, Sanjana.
Thanks, Himakshi, for bringing us those updates. We'll continue tracking the story and bring you the latest on how this develops and what action the TRAI actually takes with regards to the security concerns with these apps. Moving on, Infosys has dismissed 195 trainees from its Mysuru campus on April the 29th after failing internal assessments. They were part of a batch of 680 evaluated. In 2025, the company has let go of nearly 750 freshers, including 240 on April the 18th, over 300 in February, and close to 35 in March. My colleague Haripriya now joining us with more details on the same.
Infosys, in a fresh round of terminations, has let go of 195 more trainees after they failed to clear an internal assessment test. This marks the third round of terminations at the company. Earlier this month, it had removed 240 trainees, and in March, it had let go of 300 more trainees. These are the trainees that were onboarded after a long delay of 2.5 years after being given offer letters in 2022. They have necessarily failed the generic foundation training program that the company has to assess these trainees. Infosys is offering upskilling courses for these trainees as they have partnered with Upgrad and NIIT, and they are also providing outplacement services with training of 12 to 24 months in the BPM services space. Now, out of all the trainees that have been let go of, 250 of them have opted for these upskilling programs, and 150 have been registered for the outplacement program. Some of the trainees that we spoke to say that these courses are merely just certifications and are of no much help, and so far there has not been any further communication on the outplacement services that were being ensured at the time of letting them go.
That's right. Sweeping layoffs hitting Infosys training campus as we see more terminations coming in from the Mysuru campus. Thanks so much for that, Haripriya. And moving on, another story coming in, this time from Washington, D.C., where we just got an update with regards to the BTA talks, latest developments coming in, where the team of Indian negotiators, if you remember, held talks, and they met in Washington from April 23rd to 24th. Talks made positive progress, covered tariff and non-tariff matters, and the teams also discussed pathway for concluding the first tranche of the BTA by fall 2025. So we're looking at September, October, sometime around that time, including opportunities for early mutual wins. Let me quickly go over to my colleague Rishabh for more on this. Rishabh, what are the next steps now?
Some fresh updates coming in on the BTA talks that are underway between India as well as the US. PIB has come out with an official statement stating that an Indian team of negotiators visited Washington for talks between April 23rd as well as 25th. The talks made positive progress. They covered tariff as well as non-tariff measures and barriers that both the countries face with respect to trade. What was also interesting is that both the countries are very much committed to at least complete the first tranche of this deal by fall of this year, which is between September and October this year, or rather before that is when we can positively expect the first contours or the first tranche or the early harvest of this deal coming in between September and October this year. Interestingly, what the statement also said is that though the sectoral level engagements took place virtually, in-person negotiations are set to begin from May end. That is also something we will continue to track closely as India and the US head for a multilateral and a mutually beneficial bilateral trade agreement.
Now, the Maharashtra cabinet has approved a comprehensive electric vehicle policy aimed at accelerating manufacturing and adoption of EVs across the state. A key focus is on expanding the charging infrastructure, ensuring accessibility for consumers, and supporting the growth of the EV ecosystem. For further updates and in-depth details, let's turn to my colleague Tushar, who's joining us live. Tushar, what are the key highlights of Maharashtra's new electric vehicle policy? And how does it aim to boost EV adoption and charging infrastructure in the state?
Good evening, Sanjana. So the Chief Minister has announced that EV policy has now been approved. This is the first EV policy for Maharashtra in the last 5 years. Remember, the last one came out in 2021. That also included no road tax and no RTO tax for electric vehicles, and those factors or those promises are likely to continue in the new EV policy as well. We haven't yet seen the full document. When we have that, we'll let you know. But we so far know that the old, that in the Maharashtra budget, when the government recommended about 6% road tax on luxury electric cars, that is priced 30 lakh and above, has been done away with. It's back to 0%. Now, this gives actually, the policy gives a fillip towards electric vehicle adoption in India, in Maharashtra, especially at a time when Maharashtra is growing very rapidly. It's already the second largest EV market in the country. It has the highest market share in two-wheelers as well as electric cars in India. It has seen maximum adoption of electric buses as well. So this particular policy, more details will come through as far as manufacturing is concerned and charging infra is concerned. When we have it, we'll just let you know.
Tushar, thank you so much for bringing us those updates. Maharashtra now green lighting this EV policy. Let's take a look at what else is making news around the country, especially our top focus in the wake of the devastating terror attack in Pahalgam that claimed the lives of 26 civilians. Security measures have been significantly tightened in Jammu and Kashmir. The administration has now shut down 48 resorts, leaving over half the region's tourist destinations inaccessible as part of heightened safety protocols. Meanwhile, the Indian government has strongly reaffirmed its stance against terrorism on the global stage. Speaking at the United Nations India representative, Yojana Patel condemned attempts by Pakistan to politicize the forum and highlighted the recent admission by Pakistan's defense minister, where he openly confessed to the country's history of supporting and funding terrorist groups. Amid rising tensions, Pakistan's defense minister's X account has been blocked in India following his claims of an imminent Indian military action. Adding to the fragile situation, Pakistan once again violated the ceasefire agreement by opening fire along the LOC in Jammu's Akhnur sector earlier today.
While the major tourist destinations will continue to remain open, which includes Pahalgam, but several important destinations have been closed. Last week, like 4 days back, there was a meeting of Chief Minister with the stakeholders, hoteliers, tourist operators. He was informed that some of the destinations were shut. He was taken by surprise. Then he inquired from the police and the director of tourism. He was told this, it is a temporary measure. But now what we are hearing that 48 out of 87 destinations and the resorts have been closed as a preventive measure because of the security concerns after Pahalgam massacre. So this is a huge decision, and it means also huge impact on the livelihood of people who had invested, who were hoping to earn their livelihood. So this massacre of innocent terrorists has not only killed 26 people, it has also killed the livelihood of thousands of people. I'm here at Pahalgam, where I can show you a week after the massacre what it has done to the otherwise a bustling township. So this used to be a bustling township. Police had tough time a week ago to regulate the traffic, but today very few vehicles moving here in this town. Not every shop is even still open. The town is trying to come to terms with the loss and the tragedy here in Pahalgam. So this is the cost people have to pay, while the innocent 26 people were killed. Yesterday in Assembly, we saw there was every party and leader was on the same page, and then the Chief Minister made that very emotional speech talking about how innocents were killed because of their religion, because they were profiled. Children and women were separated. It was exactly the same way. We know there have been so many theories which we have done, but clearly it was an attack to target the tourism here, because tourism was seen as a symbol of peace and normalcy in Jammu and Kashmir. Now a major setback also because of this attack. Around 48 destinations and resorts have been closed for the tourists in Kashmir Valley.
Thanks, Nazir, for bringing us that ground report. Pakistan is rattled by strict action by the Indian Army against sponsored terrorism, resulting in unprovoked firing at the line of control. As per the Indian Army, the Pakistan Army resorted to unprovoked small arms firing across the LOC, and the Indian Army responded to the firing in areas opposite to Kupwara and Baramulla district, including Akhnur. My colleague Shiv now joins in with the ground report.
Well, for the fifth day running, Pakistan Army ceasefire violations have only increased at the line of control. The added element on the fifth day is that they've expanded the reach of their ceasefire violations to the Akhnur sector. This is the Chicken's Neck sector at the very southern tip of the line of control where it really starts. And this clearly suggests that the Pakistan Army is looking to light up the entire line of control, activate it, escalate tensions, and completely heat up that frontier in a way as to try and trigger some kind of a localized military offensive from India. The Indian Army obviously has faced this kind of attempt in the past. It is responding effectively. Only machine guns being used, no artillery or heavy weapons being used. That may happen if things escalate further. There have been some stray reports of damage on the Pakistan side, but there is no confirmation of that just yet. No casualties on the Indian side, even though posts are being directly targeted with machine gun fire. What it clearly shows also is that the Pakistan Army's ceasefire violations are not sporadic, they are not random, they are not localized. It is a much higher decision that's been taken. Orders have been given to Pakistan Army posts across the board. At least 40 Pakistan Army posts are said to have violated the ceasefire on the fifth day. So from a couple of posts to a handful of posts to a dozen posts to 30, 40 posts to more than 50 posts means, nearly 50 posts means that this is clearly an escalation ladder that Pakistan has decided to climb on as far as the line of control is concerned. Expect that to continue.
Thanks, Shiv, for that. And let's shift focus to what happened in the top court today. The Supreme Court today said the central government using spyware for national security is not wrong unless it targets civil society. Now, these comments were made while hearing petitions linked to the Pegasus case. The court also said details of an investigation report by its committee into the snooping allegations cannot be made public because it concerns the security and sovereignty of the country. My colleague Nupur now joining us on the phone line with more. Nupur, what are the key takeaways from the Supreme Court's remark on the Pegasus case, and give us a sense of what happens next?
The Supreme Court today, while hearing the petitions that were seeking disclosure of report of a panel, technical panel that was earlier constituted on top court's order only to probe this Pegasus allegations that were being made, the Supreme Court said that it will not order any report to be made public where country's sovereignty or security may get compromised. It, however, said if certain individuals from the civil society think that they might have been affected by Pegasus, they can in fact approach the top court and file their written submissions, and the top court will then decide and tell them if they were if they were actually named in that report. But today the top court has categorically denied making public even the redacted version of that report, which had details about the alleged spyware use. Now the Supreme Court, while saying the same, has in fact reiterated that there is nothing wrong in using a spyware as a country, and certain also given the circumstances we are facing currently, it would be not in national interest or national security's interest that such data is made public.
Right, Nupur, thank you so much for bringing us those updates. We'll continue tracking the story and bring you the latest as it develops. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Apollo ties. Now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global.
Hello and welcome. You're watching KYC. Now, a lot of the companies that we've been speaking to and speaking about are inward looking, and therefore, to some extent, if at all, that's still part of the equation in terms of investment. It's also tariff insulated in that sense. So let's look at PNB Housing today actually. So interesting because we've seen a turnaround in the business of sorts, very strong numbers that we've seen, 2.5% plus on the ROA number. Can that sustain is the first big question that we'll ask. The second one is what's the expected credit cost as it normalizes. This is the provisioning number which hits your profit and loss account. So what that number is going to be as it normalizes. They're going into slightly new businesses as well, newer geographies as well. Does that at all impact your credit cost in terms of expectations? The third piece is with regard to risk within the affordable housing finance segment, and this is something of an additional point to what we just covered with regard to credit cost. As it normalizes, what's that kind of number that we look for? What's the possible risk to growth? Because growth has been tough in terms of visibility, at least over the last 3, 4, 5 years. Can that change going forward? That seems to be the guidance. What will be the levers and what gives the comfort that growth is back for good? Now, in terms of the fifth point, asset quality has improved substantially. Can this kind of number start to sustain? Is this the realistic number that we look for? And last off, most importantly, from an investor perspective, are valuations at this point looking fair? That's really the question we'll try to delve upon. And in order to start and try and break this down, as always we do, let's look at the metrics that we'll look at when you're looking at a PNB Housing. Before we look at metrics, let's look at the company itself. First, what do you look at? It's the third largest housing financier in the country. It has around a 98.5% within its entire loan book base. It's got around 98.5% of retail loans. So predominantly is doing retail at this point. It's in that process of going into retail and rather has now almost completed that process. Within retail, individuals is roughly 72% and non-housing loans are around 28%. Okay. When we're looking at a further split within the individual mix, look at self-employed, which is 39%, 61% is salaried. So that's a fairly healthy mix on both sides. You may want to have a little bit of more salaried in that segment. In terms of the lending split, around 75,000 odd crore in terms of the loan book value. Prime loans, prime markets are around 55,500 crore. Emerging markets are around 14,125 crore in terms of book size. So around 20% is emerging markets and roughly 8 odd % is affordable housing, and this book is growing extremely fast. It's grown from 1,000 crore to 5,000 crore in a matter of a year. So watch out for that one. How will that impact margins will be one of the questions that I'd be curious to understand. 356 branches. They had 300 branches at the end of FY24, currently at 356. This is how the branches stack up and the AUM stacks up. Maharashtra is the predominant force in terms of loan share, 22%. Tamil Nadu at around 11.5%, Delhi at around 11.1%, Telangana at around 9.1%, and then so predominantly the top 5 states, and I'll read them out. Tamil Nadu, Maharashtra, Delhi, Telangana, Karnataka account for 60% of the loan share for a PNB housing. Something again to keep in mind. How do they sell? How do they go distribute? In-house distribution is around 53% and direct selling agents is around 47%. That's how the distribution mix is playing out. Let's look at the borrowing mix, and this is where it becomes important because it will start to impact your cost of funds. So something to look out for. National Housing Bank roughly 13%, term loans is 38%, ECB is around 6%, deposits is around 28%, also the largest deposit taking housing financier in the country. NCDs is around 10 odd percent, and then you have certificates which account for roughly 5% odd. So that's how it kind of stacks up in terms of borrowing mix. Let's look at the metrics we'll track today. You have income statement, you have balance sheet, you have operational metrics as we do with all lenders, and we look at asset quality as well on this one. We'll also look at shareholding pattern, valuations, street cred and street coverage. We look at all of those and try and break it down, and thereafter speak with the management and try and get a perspective as to what can be expected on some of the apprehensions that are there with regard to a PNB housing as well. What are the risks like? But let's start off with an income statement. You know, the net interest income growth has been roughly 16 odd percent on a year-on-year basis, CAGR 3-year. That's how the NII growth has been. It's not been very impressive for that top line number. You'd want a better number, but the last 3-year CAGR looks okay. The last 2 years is just 20% absolute. So just about maybe just about single digit in terms of compounded annual return. So something to look out for. But what's really driving the numbers with regard to PNB housing and the profitability number is the provisions number. Provisions have come off sharply. The book has improved quite sharply. Now we're starting to see recovery start to play through. So they are playing an active role with regard to ensuring that recoveries which they have provided for earlier, all the recoveries have started translating on the PNL and are impacting the PNL also. Let's pull up the profit after tax number, and there's a negative 158 crore of provisions. So that's a write back of around 158 crore. The profit after tax is sitting at around 1,936 crore. So not only is it inflated with regard to the 158 crore, which is the net of the provisions made this year versus the recoveries. The recoveries are roughly 360 odd crore for the current financial year. So not only is it that, but the profits have seen a bit of a boost in FY25 on the back of those couple of factors. So profit after tax has gone up 32% over the last 3-year CAGR, but that's also because of this recovery number, something to be kept in mind. So thumbs up with regard to this, because you have decent growth on the top line, provisions which are credit costs which are not translating to the PNL, which is a positive, and then you have profitability which is seeing a surge. May not be fair to look at this profitability standalone, but nonetheless you are expecting FY26 also to continue to see recoveries, and therefore you might see this profit as something which is more normalized in any case. FY27 will be where the real test starts to play out, where the income statement profitability is concerned. So we'll give this a thumbs up for now. On the back of that, let's look at the quarterly numbers as well. Q1, Q2, Q3. The NII number has gone up in a phased manner, fairly decent between Q2 and Q4. Provisions have largely seen write backs in Q1, in Q2, Q3 and Q4, and profit after tax has been quite steady in that sense, with Q4 being the real outperformer which is why the stock also buzzing in trade. Now let's look at the balance sheet, and this is where it starts to look slightly difficult. Let's look at FY23, FY24, FY25. No significantly sharp growth that we are seeing on a book size which is decent. You know, we have a Bajaj Housing as a comparable which is growing at a far faster clip. We have some of the smaller ones which are maybe a third of the size of a PNB Housing, which are also growing at a faster clip, but PNB Housing in terms of growth has dragged. Can that change? That's what the management seems to be suggesting, but we'll have to wait and watch whether that does. So the AUM growth currently, 3-year CAGR, is just 7% at this point over the last 3 years. So what's happened to capital adequacy as a result? It's gotten better because profitability metrics have gotten better while growth hasn't happened. So you're seeing a decent amount of capital build up within the company, but growth is where the concern seems to be. Let's look at operational metrics now. Let's look at the margin number. It's largely been steady over the last 3 years, which is a key positive, but it's maybe a minor negative from a perspective that your rates have gone up. You would want at some point, as the rates come down, for your margins to likely get better. Can they do that? Is there scope for that? Will be the question. Your ROA number has consistently gone up from 1.6 to 2.6%, led to a certain extent by recoveries that are playing out, but also by better operational performance. For sure, that is evident. Look at cost of borrowing. From 7.5% in FY23, your cost of borrowing is currently at 7.9%. So your cost of borrowing has gone up, but has come off from the FY24 levels. Can it continue to come off, and by how much will be the question. Spreads largely have come off, also likely because there's a lower risk build up there. OPEX to assets has gone up as they push retail and push towards branch expansion. Some of these metrics versus some of their competitors look okay, all below what one would expect in terms of at least OPEX to assets, well in range, and therefore we've given these operational metrics a bit of a thumbs up. We've seen an upward bias to margins in FY25. We've seen an upward bias to ROA as well. Cost of borrowing has been largely steady, and spreads too have been largely steady. So positive when you're looking at FY25, which is the short term. Positive when we're looking at the long term. A clear thumbs up with regard to this. Let's look at asset quality. Now this is where it starts to get fascinating. Your gross NPA ratios have come off from 3.8% to 1.08% in FY25. That's truly impressive. When I'm looking at the sequential numbers as well, Q2 1.5%, Q3 1.19%, Q4 1.1%. That's the gross NPA number. The net NPA number also looking equally good. 0.8% in Q3, 0.69% in Q4. So an improving trend on some of those metrics. Something to look out for always when asset quality is concerned. As it improves, you would start to see more confidence come in for the bank to grow as well, or a financial institution to grow as well. Whether this is the normalized level that one should expect in terms of a number is something that we really need to keep our eye out on, or whether, given that they are going into new spaces, whether we're looking at some amount of adversity which could start to creep through as well, and therefore where would the NPA numbers be, is something that we'll have to look out for as well. Now in terms of, let's look at the shareholding, and this is where it also gets a bit interesting. You have the promoter holding at around 28 odd %. You have General Atlantic, which owns a stake in the company, mind you. You have promoters which currently own 28%, and within that promoter holding, I'm just going to try and spell it out. You have Punjab National Bank, which is the promoter entity which holds PNB Housing. But outside of that, within the FI holding, you have General Atlantic, which holds roughly 7.5%. That's Government of Singapore, my apologies. General Atlantic holds roughly 5 odd % of the company. So again, there's a decent amount of FI interest in this one. Something to look out for again. There's a decent amount of DII interest as well. You have lots of mutual funds which own a stake here. There's an Aditya Birla Sun Life, HSBC small cap. You have Nippon, you have HDFC, you have Axis. All of these hold decent chunks within the company, and therefore it's got a decentish participation. But the promoter holding is 28%. They borrow largely on the back of PNB being the key promoter here, and that's why their borrowing cost is low in comparison to some of the other housing financiers. Again, that's something to look out for, because this promoter ownership of 28% likely to stay steady, but any change there could well impact the numbers for PNB Housing. That's how it's playing out. Currently, the public holds around 20.5% stake in PNB Housing. So that's shareholding done. We'll give that a neutral given the risk. Let's look at valuations now. Let's keep three things in mind. One, your asset quality has improved sharply. That's a positive when you're looking at valuations versus some of the others. Point number two, you're looking at growth which has not been coming through, at least over the last 3 years. So on that count, the slower growth merits a lower valuation, and that's what it is, the 1 year forward PE. And three, you want to see a smaller book grow at a faster clip, but with new businesses coming in, there could be increased risk. So those three factors to be looked out for when you're looking at valuation. 1.5 times price to earnings, certainly 1 year forward, looks cheaper than some of the other counterparts within the housing finance space, but those are smaller than a PNB Housing. PNB Housing has a larger base as well. And you also want to look out for how the last 5 year average price to book multiple is, which is at 1.2 times. So in that sense, it's a slight bit of a premium. Again, we'll give this a neutral because there is a turnaround coming, and we have seen leadership talk widely about that turnaround, and we've also seen analysts cover that turnaround a bit. So maybe a few of those aspects need to get balanced. Let's look at street cred. Well, it's performed very well over the course of the last 3 months or so. 30% returns. Last 1 month has been 24%. Last 6 months has been 18%, and last 1 year has been 35%. Truly impressive given the fact that markets haven't done as well in the meantime, especially broader markets. Let's look at street coverage. They have 12 buy ratings, no hold, no sell, and a 14.5% upside on the stock. So a positive with regard to that as well. Let's try and stack it all up and try and give this one our KYC rating, and that's how it stacks up. A balance sheet is a neutral because you want better growth there. Let's look at the next graphic, and within that we'll look at how shareholding, street cred, street coverage and valuations look, and that's how it stacks up. On our KYC ratings, it gets a 6.5 on 8. Very impressive, at least in that sense, but lots of monitorables, and therefore we bring in Girish Kausgi, who's the Managing Director and CEO at PNB Housing Finance, to speak to us about, of course, Q4 numbers, sir, but more importantly, what the journey of PNB Housing is going to look like in the next 2 to 3 years. Good morning, Girish. It's always good chatting with you. I want to first start off by asking you exactly that. Growth has been muted over the last 3 years. You have guided for a late teens kind of growth for PNB Housing over the next 1, 2, 3 years. Two questions, therefore. How confident are you, and how does the mix change as a result? Because affordable housing is taking a larger share of the pie when it comes to incremental disbursements.
Good morning, Harsh. I think thanks for the detailed and comprehensive analysis of PNB Housing. I think very impressive. I think let me first address growth.
Yeah.
If you look at PNB Housing, growth on book or disbursements 3 years back, it was flat. It was negative. Now, 2 years back, the growth started off with 10% on book. I'm talking about retail book because corporate we had stopped business because of stress. So it was 10%. FY24, the retail growth was 14.1%, and FY25, the retail growth is 18.2%. We had guided a retail growth of 17%. Against 17, we are at 18.2. So from 10 to 14.1 to 18.2. very clearly there is growth. And if you look at the entire mortgage industry is growing at about 13 to 13.5%. We were below industry average. Now we are far higher than industry average. And this is number one. So very clearly there is growth because we are at 18.2 and not many companies given the mix of prime, emerging and affordable. Even if you have to look at growth within affordable, FY25, our affordable growth is 180%. We took the book from 1790 crores to over 5,000 crores in 1 year. The entire affordable story in 27 months, we have built a book of 5,000 crores. Now the book is 5,070. Look at emerging. We started emerging in FY25 because of better profitability, better margin. That has done well. Now the book of emerging is about 14,000 and odd. So overall book now retail is about 74,800 crores. The plan is to take it to 1 lakh. So very clearly you will see that the growth is there, which is in higher teen, which is 18%. And come a year or two, the growth could be in excess of 20%.
Okay. So how would the mix evolve therefore over the next maybe 2 to 3 years? How balanced would it be in terms of prime, affordable, as well as your mid-tier?
So because of profitability reasons, we started affordable. Today, affordable and emerging, the disbursement mix together is 40%. And we had guided 40% by March. We started off beginning of the year FY25 with 32% mix. We ended up with 40% mix. Today on the portfolio, emerging and affordable, which means higher yield business, is 23%. Come FY27, so March 27, the overall book is going to be 1 lakh crore retail book. Out of 1 lakh crore, affordable is going to be 15,000 crores. March 25 is 5,070. March 26 affordable book is going to be 9,500 crores. And March 27 it's going to be 15,000 crores. March 27 emerging is going to be 25,000 crores. So 40% of the book in FY27 is going to be from emerging and affordable, and the balance 60,000 will be prime. Prime, we are by design, the growth rate, we have tapered it down because of margin reasons. Now, FY26, we have started one more new vertical called as loan against property, LAP vertical. Now, this also would help us on the margin. Corporate, this year we plan to disburse about 1,500 crores. So the segment shift, we are focusing more on affordable, more on emerging, prime. We're trying to taper it down. The growth will be obviously lower by design, restart of corporate, and a new vertical called LAP. All of these things will ensure that growth definitely would be there. I'm sure in next 2 years, the growth will be in excess of 20% given the mix. If you take only affordable, our growth is the highest. If you take emerging, our growth is the highest. FY25 emerging growth is 21% on book, and affordable is 183%, and prime is 12%, and this is by design.
Therefore, where should margins lie and where should yields go?
So margin would be stable. Whole of FY25, NIM was 3.7%.
Correct.
We will be able to maintain that for next 2-3 quarters, and then the margin will start inching up because of the mix change, because of restart of corporate, because of new vertical called LAP, which we started this year.
And any tailwind you will that the margin will get from the repo rate cut?
See, we are very clear on profitability. We are very clear on margins. So whenever there is a rate cut, we pass on the benefit to the customer. Once we saw that benefit coming into our cost of borrowing, so that we are going to pass it on. Apart from that, consciously on 5 things we are trying to increase margin. In prime, we are trying to increase our margin. In emerging, we are trying to increase our margin. In affordable, we are trying to increase our margin. Corporate will be a restart. It will come at a better yield and therefore better margins. And loan against property will come at a better margin. So these things would ensure that we would have enough levers to increase our yield and therefore better margins.
Got your point. And how much therefore would the normalized margin be at?
So FY27, our NIM should be in the range of 4.1 to 4.2 standalone. So today, for example, we are talking about ROA of 2.6, 2.7. So once this write-off pool is exhausted, our credit cost is going to be 25 bips. So FY24, FY27, FY25, FY26, the credit cost would be quite subdued. It will be neutral. It will be negative. So FY26 also credit cost will be negative, therefore aiding for better profitability. Come FY27 stand alone, our NIM is going to be 4.1 to 4.2. Our ROA is going to be 2.5 to 2.6.
Got it. And your credit cost will be sub 0.3 is what you mentioned.
Our credit cost will be 25 bips.
25 bips, yeah.
In FY27, standalone.
Correct. What gives you that confidence? Because you're lending now to corporate, loan against property, affordable housing, where you could see a bit of an inch up. You've not done that in the past, and therefore what gives you the confidence that you'll be able to maintain that kind of credit cost number?
So even if you look at a credit cost now, it's in that range, 0.2 to 0.22. If you look at FY25, so the way we are building book, we are very, very sure because now affordable book is sizable. It's more than 5,000 crores. Emerging book is sizable. So we've seen our credit cost panning out, which is in the range of about 20 to 22 bips now. So it will inch up and it will be around 25 bips standalone. Even today, if you take credit cost, it's hardly anything. Because of write back, it is negative. Otherwise, it is sub 25 bips. Come FY27, given the mix change more skewed towards affordable, emerging, new vertical lab. So our credit cost is going to be 25 bips.
Yeah, that's exactly what my worry is. You're moving into these segments. My worry is not the 2.6% ROA if you do 25 bips of credit cost. I don't think that is worrying the street at all. Is there a downside risk to that credit cost number is the only worry. What gives you that confidence? Again, because you're doing all of these new businesses and hence, some bit of apprehension on this count.
All these are new businesses, to us in some way. For example, loan against property. It is not new business. We are doing loan against property for last over 30 years. It is only a focus by having a dedicated vertical. So it is not a new business. The only new business is going to be corporate, and there the plan is to take at a portfolio level to about 5 to 6% by FY27. That will be hardly anything. It will be about 5,000-6,000 crores. There we are very pick and choosy on developers, on the project selection, on the geography and stuff like that. So it's hardly any amount to be really worried about, because rest, whether it is prime, whether it is emerging, whether it is affordable, all the three book, if you see, it is quite substantial and we have enough experience on that. And the new vertical, it's only new vertical, not a new business. Business is old, 30-year-old. It's a new vertical just to bring in that extra focus so that the profitability betters.
Got it.
So because of that, we are very, very sure our credit cost is going to be around 25 bips, because this is something what we have seen for last 3 years.
Understood. Point taken, Girish. Thank you so much for this conversation, for being so candid and speaking with us today on KYC, but completely out of time on this edition of KYC. That's all, in fact, the time we have from myself. Everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show is geared towards getting you insight on everything money related. And today I'd like to talk about mutual funds, but I'd like to introduce something that I want to bring to you on an ongoing basis, and that is Know Your Fund Manager. It is an attempt that we have to bring you a little closer to the people that manage your money, and I want to get the story behind the fund manager as well. And to that end, the first fund manager that I want to introduce to you on this set program is Chandra Prakash Padiyar, who's a senior fund manager at Tata Mutual Fund. Chandra Prakash, thanks so much for taking the time. Now, ordinarily, I'm sure on interviews such as this, we start directly with your philosophy and various other things, but I do want to talk about your journey to this point, because it's been 24 plus years and you've done quite a bit in that time. I want to understand how your current philosophy when it comes to portfolio building has been distilled over that period of time.
So hi Alex, and thank you so much for having me on your show. Well, it's been an interesting 24 years for me, obviously. Learned a lot, still learning though. And I would say, so to answer your question on current philosophy, our current philosophy is, or let's say I would actually rephrase, I've been managing with this philosophy even in the previous organizations where I've worked. So philosophy has been, so in a sense, Tata Mutual Fund, the stars aligned in the sense that the philosophy remained the same and the way of managing money remained the same. So it's just that you are more, let's say, from experience, you are more disciplined in your approach. You've learned a lot, and applying that on your investment thought process.
You said 24 years, so therefore you've already witnessed several market cycles, and I guess what you're saying makes sense. That kind of reinforces the processes that you put into place. So let me get into that then. Growth at a reasonable price seemingly is the overarching framework that you have, but can you describe that to me? How does that result in the portfolio building approach that you have?
Sure. So on growth at reasonable price, basically you are looking for company on a theoretical basis. You are looking for companies which can grow at a fast pace consistently over a long period of time. Basically, you're looking at scale in businesses that you buy. The second aspect, or an indirect or direct and indirect aspect of this, is that you are looking at long-term investing. So you buy today and let's say hold for a longer period of time with the assumption that the management team on which you're betting on will deliver consistent growth over a period of time. My learnings of the past 24 years, one of my learnings is that the longer the scale up or longer the time with which the management can scale a business, the better it is for the market, or the faster you get your re-rating over a period of time in terms of valuations. So growth at a fast pace is very important. Consistently at a fast pace is very important. The second thing that we have learned along the way, and this is more around 2008 or post 2008, the way the world changed, is that along with growth, you need to focus on free cash flows. So businesses which can deliver cash on an annual basis, basically your balance sheet quality is very strong. You do not need, or companies that you invest in, barring financials, do not need to raise capital very often from the market. They can fund their growth on their own. That's the critical aspect that, and has been one of my key learnings over the last 24 years. So one is growth. Second is free cash. And lastly, this combination of growth and free cash needs to come with reasonable valuations. So, and over in your investment horizon, for a part of your portfolio, we aim for re-rating of valuation, and this is something that it comes through. So this is where art comes. So one is the growth part and the free cash flow part, that is science, which is mathematics in terms of numbers. The art is to identify businesses at a time when the market is probably ignoring the fundamentals of many of these companies or management teams. You buy it at a time when everybody is either negative on, or most people are negative on the business or not looking at those businesses favorably. You buy them, so you get it at a cheaper price. And as and when those come, and you buy them at an inflection point or closer to an inflection point, so you get it at a reasonable price or valuations. And as and when these businesses deliver earnings over a period of time, the market realizes that the quality of the business is good, management quality is good. It is just that short-term period the company didn't do so well. You get re-rating of valuation. So this is the combination that we look for in growth at reasonable prices in investment philosophy. Now, this is something that we apply to funds in a shades of gray, in the sense that a different fund will have a different variation of growth at reasonable price that you apply to.
Okay, and we'll get into the details of a couple of schemes that you manage, which is one, the Tata Small Cap Fund, and also the Large and Mid Cap Fund. But before we do that, I do want to get your opinion on where things stand right now. There's so much noise on the global stage. I'm asking what you would be focusing on right now, because between September and March, Chandra Prakash, you would have gotten opportunities based on your philosophy, I'm sure, to buy companies that would have been relatively resilient and valuations had corrected from those heady levels that we saw in the run-up to those all-time highs. So talk to me about some of the opportunities that you saw and that you took advantage of.
I will give you an answer in two manners. One, when an interesting example that I want to start with, and it's quite interesting actually, is that in the past 24 years, for example, on an average, we used to always assume that rupee will depreciate against the dollar, depending on the inflation differences, with the normal theoretical that we've been looking at correlations and all. So rupee has depreciated, let's say, around 3% CAGR for many decades. But interestingly, for example, this week, what we were doing internally, at least in my portfolio that I was doing, is I was trying to check that what if rupee were to appreciate for a short period of time. And let's say, and this is just a what if, it may not happen. It is just that given the world environment the way it is, we are reflecting on the fact that we are re-looking at our portfolios in both the funds and saying that what kind of portfolio or what kind of businesses do I own? And if rupee were to appreciate by a large manner in a short period of time, what happens? Am I taking too much of a risk? So So your question was very valid. Is that these are uncertain times. Many past hypotheses or many correlations of the past are changing, and we have to almost every day think of the risks that we are taking in incremental. So coming to this your question specifically. Let's say, for example, today, and you would notice this as a clear trend in both the funds that I manage, which is Tata Small Cap Fund and Tata Large and Mid Cap Fund, is that a large part of the portfolio, or a very large part actually, is more domestic-oriented businesses. We do realize that there are incrementally a lot of uncertainties coming up almost every day. And last 6 months have been unusual actually. Though the market price, the stock market doesn't show you that as of now that there are any uncertainties in the business environment, but on ground, we do see lots of uncertainties developing almost every week, every day. And it is quite logical for us to have more domestic companies, because India as an economy, or specifically for India-specific businesses, domestic market, we are seeing interesting, healthy signs actually, or things picking up from where we are today incrementally. We are more optimistic on domestic businesses, and that is what you see in our portfolios.
Okay, now let's get into this one by one. I want to talk about the small cap fund first. I've always been, I've always looked at your decision to restrict inflows when you did into the small cap fund as a brave move and a valid move in the context of your assets under management versus some of your peers, which are significantly larger. So first, talk about that. That is still in place. You have lump sum investments that are not allowed, and SIPs continue to go through. Why is it that it's still in place?
So the rationale of stopping or to stop taking lump sum money was that in very short periods of time, in let's say in June 2023, when we did stop this, early between Jan and June of 2023, in a very short period of time, we were getting very large amounts of incremental money in the fund, given that performance was good and small cap generally were in favor. We thought that taking large sums of money in short period of time creates issues for the fund manager to deploy that much capital at a time when market was in a bull cycle. And it is negative for existing investors. So in the interest of existing investors, we chose to not take or stop taking lump sum money and continued with the SIP money so that existing investors continue to put long-term capital to use. Why is it still there? I have one is that generally speaking, and this is a fact for our market, valuations across the market, whether it is large cap, mid cap, or small cap, valuations are either fair or slightly higher than normal, which means that your incremental risk reward is not as good as what it used to be in the past. So one is a fundamental view that incrementally return expectations for investors needs to come down because the risk is increasing. And two, on the second aspect is that small cap specifically as a segment inherently is illiquid relative to large cap and mid cap. And if let's say, for example, we manage the early part of the question, we manage our money with growth at reasonable prices and investment philosophy, where we are choosing specific businesses, buying in with conviction for long term, which means that we are in many ways buying 3% or more of equity capital of companies in many. So let's say 25% of my portfolio in Tata Small Cap Fund approximately is in companies where I own either 3% or higher of equity capital of that company. Now, if the fund size keeps growing, we as an investment team will keep increasing our weightage in businesses because the money is coming in a large manner. So illiquidity of the portfolio goes up quite significantly. And to continue to manage from our investment thought process perspective, we thought that it is best to take gradual capital rather than lump sum capital in one go, and hence it is continuing in this manner even today.
Okay, great. And that makes complete sense. I've also noticed that your churn, and just so that everybody understands the degree of change of portfolio and the kind of selling and buying of stocks is not very high. So that fits in with the philosophy that you have, which is you invest in a set of companies where you see growth in cash flows and you expect that is going to play out over a period of time. So that point is well made. Can you tell me about, and you referred in your last answer, Chandraprakash, to your anticipation of earnings, and you said that moderation of returns is appropriate at this juncture from the investor's perspective. So where do you peg the earnings heading into the new financial year? Because you have estimates that have been brought down from mid-teens to closer to around 10% or 10-11%. Is that what you think as well?
So one is, so what you're referring to is the benchmark indices earning growth.
200 plus.
Yeah.
200 plus, yeah.
Which is generally the benchmark indices, yes, less than 50 or BSE 100 or BSE 200. But what I see is that we are likely to see, starting this year, we are likely to see very high divergences in earnings delivery by businesses across sectors. What I mean by that is that, see, for example, in the last 4 years, for example, let's look at FY 2021. At that time, if I remember numbers correctly, corporate profit to GDP, more from listed angle, was somewhere close to 2%. We are today somewhere close to 5.3%, which means that, and in the previous peak, let's say in 2008, that same number was 6.8. So we were very low in 2020-21 at around 2% of GDP. We have now crossed that number and we are at 5.3. We are still lower than our previous peaks from a profit perspective, but we are closer to the higher levels, which means that your one, aggregate profits cannot grow at the same pace at which it grew in the past, and two, not all businesses will be able to grow at the same pace. Obviously, at a time when global growth is likely to slow down, we just saw World Bank reducing global growth estimates, including the US. It is very logical to assume that you should expect large divergences in earnings across sectors, across businesses, across market caps, which means that on an index level, given that indices are very diversified, BSE, you mentioned BSE 200, for example, there are 200 companies in there. Not all 200 companies will be growing at the same pace. So it is a stock selection market. So it is good for people like us, actually, for fund managers like us who are more business specific, who buy limited number of companies focused on delivery of earnings. So to answer your question, there are businesses today available in our economy, more domestic focused, where we do believe that incremental one, maybe to some extent base effect also for some companies, to some extent some companies have done something very good in their business, which is leading to higher growth. But let's say both Tata Small Cap Fund and Tata Large and Mid Cap Fund, we do think that there are a fairly large part of the portfolio where profit growth is likely to be very healthy, in excess of what the numbers that you mentioned.
In excess of, sorry, I just want to ensure that I have the right understanding. So what, better than expected would be around 15% or more than that?
More than that. That's so obviously we can't.
Of course, you can't quantify that. You can't quantify that. But yeah.
But we do sense that our view is that there are some limited number of companies available in the market today. If you choose them well, profit growth is likely to be very healthy. But having said this, I also have a view, and I started, for example, in our conversation when we started this, I did say that generally in our markets, valuations are either fair or slightly on the higher side, which means in a world where you see divergences, you see slowdown in earnings, it is logical to assume that valuations should derate to some extent. So even it is very important for you as a portfolio manager today to have high growth companies, because even if there is derating in valuations to some extent gradually over a period of time, your absolute returns is still delivered to some extent. So that's the way we are thinking today, is that we are in a world where return expectation needs to come down. But to answer your question, I think if you choose your stock well, I think earnings delivery is still there.
Okay, let's come to stock selection. I want to focus first on the small cap fund. 58 stocks, some would argue that it's a pretty small holding compared with certain other peers where you have 150 plus 200. But without comparing with your peers, help me understand what the allocation is like, because it seems like you've reduced your allocation over a period of time to IT. You've gone underweight. Financial services also, and I'm looking at your presentation here, it's not overweight at least. So help me understand how you're positioning as things stand right now.
So one is on the number of stocks perspective. I would say that in 2024, first to give you a background, in 2024 when the market were in the bull market situation, when everything was going up, we were busy changing our portfolios. So we were busy booking profits and replacing it with our philosophy of stocks where we thought market is ignoring. So we were actually doing many changes in the portfolio. But what did happen is that we thought this bull market may probably last longer. So we were taking our time in booking profit gradually. In the process, there are, for example, as we see today, out of the 58 stocks that you mentioned, there are more like 15 plus stocks where I have a weightage of either 1% or below 1%. Normally, we don't like to buy businesses, so we don't like long tail. So then the correction stepped in and we thought that it doesn't make sense to sell now. These businesses are still good. So we are retaining a long tail as we speak. So 58 looks lower, but in my mind, we are working with 40 stocks actually. So that's one part of it.
On the financial services, which you're significantly underweight, I'm curious why that is, because everybody that we're speaking to is looking at financial services and saying this is going to be the leg of growth.
So I would tend to agree. For most banks, I would not say financial services, I would more focus on banks.
Sure.
Mid-size and small-size banks, given the base of earnings that they are sitting on, let's say starting or FY25 and first half of FY26, it looks like that second half FY26 onwards, most of these small size and mid size banks will start growing earnings at a higher, faster pace if they deliver on credit cost as good as what they've been delivering till now. And valuations are on the reasonable or cheaper side. So I would say that yes, it does look there is a merit to consider some of these banks, which we are. But our view is that from a banking sector perspective, if I have to buy and hold for a longer period of time, small size doesn't help in banks. Ultimately, capital is the raw material, and a smaller size bank, or even to some extent some mid-sized banks, getting consistent capital from the market is not going to be easy until you start trading at very high levels. So which is why we've always taken a very low exposure or very small exposure in financials or banks in our portfolio. We would rather play the mutual fund space than the bank space. That's the way we've been playing.
In the small cap portfolio, but and so therefore, just to drive home that point, large and mid cap portfolio actually are overweight on banks. So that drives home that point. So you think that the large banks are the best play in the banking space right now?
More consistent, and you can rely on them.
Got it. Now, what is your opinion on chemicals? Because I see in both your small cap and in your large and mid cap fund, you are relatively taking a larger bet on chemicals. Why is that?
So to step back, I would say that it is not a sectoral view.
Okay.
And it is certainly not China plus one view.
Okay.
We have bought very selective chemical businesses where and all of them are either domestic oriented businesses, barring one, which is wherever they have more like 18 factories across the world. And wherever they have a factory, they supply to their own local market. So they are not at all working on global businesses and all. So in that sense, we are more focused on or have bought businesses where we think they have some or the mix of the business that they run, we think sustainability of growth is there and they can generate 18-20% plus return on capital employed and valuations are on the reasonable side. So a combination that we generally look for is what we have. So consistency in chemical businesses, there is, as you've noticed in the last 4-5 years, there has been very high volatility in earnings delivery.
Okay.
Whereas if you look at the businesses that we've bought, volatility in earnings is actually very, very low. So we are more happy with buying businesses which can keep growing at a consistent pace and where there is room for valuation re-rating rather than playing this high export story.
Yeah. And while we've been speaking, what we've been putting up on screen is your latest sector allocation, the top stocks that you have in both the schemes. So our viewers generally have a sense of where you are allocated. Just a last minute, and so therefore I do want to ask something that I tend to ask a lot of fund managers that come onto the program, which is, what is the messaging that you have to your investors and prospective investors as things stand, particularly to your investors?
So I would say that be cautious for FY26, but be very optimistic for 27, 28, 29 or beyond that. That's the way today I see things. I think the way the world is, things do look challenging incrementally. I hope things turn around quickly. Doesn't look like that way right now. So in that sense, very short-term view on the cautious side. But if you take a medium to long-term view, India genuinely has a large role to play in growth. So there are quite a few businesses which are likely to grow at a reasonable pace, and valuations hopefully over a period of time will normalize, which will make a case for reasonable returns for investors to make. So that's the current thought in my mind.
Fantastic. A pleasure having you on the program. Thanks so much for taking the time.
Thank you so much, Alex, for having me.
All right, so that was Chandra Prakash Padiyar, and that was also Know Your Fund Manager. You know him better than you did yesterday. Now, I also have an interesting data set, or rather 3 interesting data sets so that you can understand how the performance of large cap, mid cap and small cap funds have been. And if I look at the performers over the last 1 year, the outperformers actually have a story to tell. So first, let's look at the large cap outperformers. The top of the list is Motilal Oswal Large Cap Fund. It has returned 24.6%, and the outperformance to the benchmark is at as much as 16.1%. Now, traditionally, you've said that active large cap funds have not beaten the benchmark, but this one has managed to do so in a big way. And what has worked for this fund house has been the utilization of the 20% allocation to other stocks beyond large cap, and some of their stock picks have done incredibly well. DSP is an interesting story as well, because there's one significant absence in the top holdings, and that is Reliance Industries. Over the last 1 year, Reliance Industries, though it has caught up in the recent past, it has been a relative underperformer, and that has done well for DSP as well. 17.2% return and an outperformance of 7.7%. The others, good performance and outperformance as well, but this is par for the course. Good stock selection. Now, in the mid-cap space, there are a few interesting names that come through. Invesco has done well, 19.3% growth over the last 1 year, outperformance to the extent of 9.5%. You have Motilal Oswal again, but do note that over the last few months, this fund has not done very well. In fact, it has held an elevated cash position because a couple of the stock picks that it made didn't turn out as anticipated. But you have Nippon India, you have Franklin, you have Edelweiss, and also in the small cap category. And the reason I'm clubbing these two is because you have a few names that stand out. You have Bandhan Small, you have Invesco, once again, Motilal has done well, and you have UTI and Axis. So what seems to be the case is that over the last few months, when the market has seen a bit of a correction, particularly at the broader end of the spectrum, those schemes that have a quality bent have actually done relatively better because they've afforded you more downside protection. Do remember that these data points are meant to tell you what the scorecard is for the last 1 year. But that's not necessarily going to be the case going forward as well. So make sure you look at the longer term performance of these schemes. 3-year, 5-year rolling returns would be a good way to look at it. And we'll do that over the course of the coming days and weeks. That brings us to the end of this edition of Your Money Matters. Hopefully you found it useful. Let us know what you think in the comment section, and do stay tuned. This is NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Hello everyone, and Mr. N.K. Singh is a veteran Indian policymaker and the chairman of the 15th Finance Commission. He's seen as one of the most foremost voices when it comes to policy formulation in India, and hence for all the youngsters out there, you must listen to this conversation because it will give you insights that you would have never got before. Mr. Singh, Dr. Singh, thank you so much for your time here on NDTV. Sir, the nature of this conclave and the title is Emerging Businesses. And in the emerging businesses domain, MSMEs, that is the micro, small and medium enterprises, they form 90% of the businesses and employ nearly 3/4 of workers in emerging markets and developing economies. And hence creating jobs and better jobs depend on them. The recent World Bank report, as we were discussing over the weekend, sir, highlights the gap challenges. How do you think we as a nation and you as a policy maker who gives vision and options to the government of India can achieve the goals that have been set by the government, and also how can we harness the challenges being highlighted by that report?
Well, thank you very much, Maria. It's always a great pleasure to be at the functions of NDTV. And you have, of course, been one of the great anchors which followed your transit from one vantage point to another. Your question today has 3 dimensions. You have sought to focus on the MSME. Now, you know, it's true that I pointed out to you just 4 days ago that the annual spring meeting of the IMF and the World Bank, which has just concluded the day before yesterday, each spring meeting has an annual document. The last year's spring meeting had the document seeking a new roadmap for the World Bank and the IMF. Last year's document was shared poverty, shared prosperity in a livable planet. This year, the document is about jobs, and in the jobs, the World Bank group has assigned an important place to the role of the MSME. Now that in itself signifies the high priority. Not only that the jobs are necessary, because we realize that this is one of the very serious global problems. The issue of how to harness technology productively with creation of value-added jobs. This is a challenge which the society in general is facing all over, harnessing technology and gainful employment. In this context, the World Bank report has suggested a number of steps and the important role that the MSME can play. In India, which you correctly pointed out, 30% of India's GDP comes from the MSME. And out of the MSMEs category, particularly the micro sector constitutes 90% of this category of MSMEs. The problems that I can see, which that report has brought out in encapsulating in a sentence, is one, on the access to credit, assured credit. Right now it looks as though something like 25 lakh crores is still the remaining credit gap. The formalization of the sector itself is far from complete, and only 14% of the MSME sector has been formalized. The last report, which you know, was done by a colleague of mine, UK Sinha, who did that report to say that a very small percentage forms part of the formal sector. So access, assured access, and bridging the credit gap is one very big overarching issue. The second very big overarching issue is how to enhance its ability to upgrade its productivity and upgrade its skill. And skill and productivity upgradation remains a challenge. Third, of course, is access to marketing and growing technology changes. And the last, of course, is its important contribution to the GDP of the country as a whole and enhance its contribution to India's export effort. All these are quite symmetric to India's own vision of 2047, and in that vision, the integral role of the MSME remains a very, very important critical component.
Dr. Singh, since we are talking about the World Bank report, you have worked and led multiple financial institutions world over. In terms of best practices around the world, what can we learn from other countries?
It's a nice question, because I could turn the question, Maria, the other way around. That as I looked at the typology of progress and the overall architecture of the progress done by other countries, not only what we can learn, but there's an enormous amount that others can learn from us. We have indeed on every important parameter. Take the big parameter of what is talked about, the great Kenyan example, or the South African example, or the Brazilian example, or the Vietnamese example. What do they relate to? They relate to three important factors. They relate, if you sum it up, one is enhancing access to formal credit. I just mentioned to you that that's work in progress. We have done a great deal. The South African example is about vocational training. We have skill development programs. It can be, of course, significantly improved, enhanced, and be aligned to technology. There are these examples of Vietnam on developing labor-intensive export hubs. We are doing that in some measure. That, of course, needs to be greatly enhanced. I mean, we have begun the obvious ones where the labor-intensive components are critical, namely on textiles, on toys, and leather, and so on. And that's one example. We have the use of our digital stack is something which the world has been taken aback. In fact, we have as much to learn, and we must always recognize that we have a lot to learn, but the world recognizes that they have a lot to learn from our own experience, which has been a very positive one.
Dr. Singh, since you spoke about certain countries, my next question would be around these countries, and what about developed nations? What are they learning from India? Many would say that our digital payment infrastructure is everybody's envy now. They look towards us and they keep wondering, how did India achieve so much, particularly to do with UPI and the digital payment. And it is all a phenomena in the last 10 years. It is of the Modi era.
Well, certainly I think that the world is quite a bit in awe of our digital stack. They recognize that in terms of the matrix of government, that the way in which, for instance, and this is repeated, Maria, very frequently, India was able to deal with the pandemic is quoted as a global example in terms of the way in which food supplies, vaccines, healthcare, best examples. We made the fullest use of technology. That suggests to the world that India is more than ready to be in a position to be an important shaper of improved governance models, because the use of digital technology is an improvement on the governance variables which we have, and far from government coming in way, I think that we have had a lot to learn. Now, let me tell you, where I feel we still have to learn a great deal, as two factors, Maria, has
Please.
really troubled me. One is that the complexities of our compliance regulations, far too many compliances, far too many rules, far too many draconian rules. I think this is recognized when the Prime Minister has announced some time ago that he is seriously thinking of a deregulation commission. The Finance Minister recognized this in the light of the economic survey, that we need to get out of the way. Get out of the way is, if you look at it, the number of compliances at beginning from the third tier of government to working up to state level, to multiplicity of organizations and entities at the state level, and then of course the central government, the various departments of the central government. The burden of compliance is quite high. We need to certainly give that a priority. The fact that the Finance Minister mentioned this, and there is already a group working on how to improve and bring down the total number of compliances, led by the Cabinet Secretary, is a positive thing. But the Prime Minister has gone a step further in mentioning about not a compliance, but a deregulatory commission, suggests that India over the period has become mature enough, and many of these rules have become handicaps. Rules are necessary because the rules are necessary to ensure that appropriate conduct and compliance with the broad framework has been done. But when the rules do not serve the purpose, but serves a purpose which is entirely different, has become a handicap to creativity, to growth, to productivity, to employment, and indeed to the growth strategy. I end by saying that, these rules are hurting India's investment climate in general. Take, for instance, two areas on the rules. I've often felt that the entire legal rubric and the entire legal framework has remained substantially unreformed. The world recognizes that India has one of the most transparent legal systems, but they often joke with me that that's true, Mr. Singh, but when do we see the end of the interlocutory processes? Hopefully, they believe, in the lifetime of this project. So I think that India's legal complexities is one area which requires a fundamental change and a restructuring of the entire legal architecture to serve the broader objective of societal necessity in terms of conformity to law and order, to security, to the basic principles of the rule of law. That's not questioned. What is questioned is the cumbersome systems which have got accumulated, which have debted against speedy dispersal of a just and free system about which we are rightly proud of and which the world upholds.
And now I'm coming to a question which is very close to my heart, and this is with regards to women-led enterprises, women-led governance. There's the statistics which has, of course, been shared by the World Bank report that women-led enterprises represent 23% of all MSMEs, but they account for 32% of the financing gap. When informal enterprises are included, the finance gap actually rises to almost $8 trillion. And this is linked to women enterprises, women-led development. Besides, we have often seen women as the beneficiary of the government schemes and policies, and particularly coming from the state where both of us come from, in Bihar, women have always been seen as a captive vote bank because of them being beneficiaries of the state. How do you mainstream gender in MSMEs?
Of military action against Pakistan. This is the Prime Minister, one day before the CCS meeting with the three armed forces chiefs, General Upendra Dwivedi, the Chief of the Army Staff, Air Chief Marshal Amarpreet Singh of the Air Force, and Admiral D.K. Tripathi, the Chief of the Naval Staff. You've got the Chief of the Defence Staff, General Anil Chauhan, Defence Minister Rajnath Singh, and National Security Advisor Ajit Doval, all sitting on that table with the Prime Minister. This is a meeting that is currently on, and this is a meeting where no details obviously have come out. They are going to be of a highly sensitive nature. It doesn't get bigger than this when it comes to decision making from the political establishment and the armed forces. Remember, we're talking about this meeting now 1 week since the Pahalgam attack. There have been a series of meetings, like you rightly said, that have preceded this, and this very broadly speaking, will be a meeting where the Prime Minister is connecting directly with the chiefs of the three armed forces, weighing options, distilling information, getting more, inputs from them directly about what India's options may or may not be. The shape of things to come are definitely happening in that room right now.
That's right, Shiv, and there have been a series of actions taken, in a sense. Aishwarya also joining us from outside the Prime Minister's residence. They will come to you in just a moment, Aishwarya, but Shiv, if you can tell us about, you're talking how the search operations are continuing. The Indus Water Treaty has been suspended. Those on visas from Pakistan have been sent back. So a series of actions are really taken, even as you've been reporting, this was the 5th day of ceasefire violation from Pakistan side.
That is correct. I've just returned myself from the line of control in the Baramulla sector, which was one of 3 sectors that has seen the heaviest escalation in terms of ceasefire violations by Pakistan. And you're right, last night was the 5th night in a row. There is a concerted attempt by the Pakistan army to escalate things to an unmanageable degree on the line of control. And I saw some of that with my own eyes today. The Indian army is, of course, responding. The other aspect of all of this is, of course, the measures that India has already taken, whether it is the visas, whether it is, a selective border closure, whether it is the Indus Water Treaty impact on Pakistan, which will happen only over months and years, perhaps. All of this means that India is building up a body of action against Pakistan, and it may be tempting to see or expect or anticipate some kind of big military action. I personally feel there is going to be something that will happen. We don't want to conjecture on the shape of it, but the meeting between the Prime Minister and the 3 armed forces chiefs and the other leaders of the defense establishment clearly and perhaps for the first time very, very clearly suggest that there is something looming.
All right. Well, Shiv, do stay on. We can go across to Aishwarya, who joins us from outside the Prime Minister's residence, where that meeting is taking place. That picture on your screens. Aishwarya, take us through all these developments.
Well, certainly we are reporting from Prime Minister's residence at 7 Lok Kalyan Marg, and just behind me is that particular meeting, that crucial high-level meeting which is underway as far as Defence Minister Rajnath Singh, who first arrived, and later it was all the 3 chiefs of service staffs who arrived as well. We can see in those pictures it is CDS and NSA as well, who are briefing Prime Minister Narendra Modi. And as we are speaking, it's been almost 15 minutes that the meeting is underway at 7 Lok Kalyan Marg. This comes just ahead of all-important CCS, Cabinet Committee on Security meeting tomorrow at 11 a.m. That will be a second round of the meeting. The first instance when Prime Minister Narendra Modi had cut short its trip from Saudi Arabia and flew to India after the Pahalgam terror attack. On that particular evening, we saw the CCS being chaired by Prime Minister Narendra Modi. Several decisions were taken. And since then, if we recap what has happened in the last 1 week, high-level meetings with the chiefs of the security agencies involved in Jammu and Kashmir, with the Home Minister or Home Minister directing the state chief ministers to implement the decisions which had been taken during the CCS as far as the Pakistani nationals, visas being revoked, or either the CDS or the service chiefs briefing the defense minister, and now finally all of them together at Prime Minister's residence in that particular room where he is being briefed about the latest developments. This is very, very crucial because it is Government of India's clear view and a stern message by Prime Minister at different places that a befitting reply will be given to whosoever had been involved in this deadly terror attack. The perpetrators will not be left alone, and we will of course identify, find and punish them at wherever they are. So clearly an action is something that has already been told. At what place, what time is something that the top leaders of the country, the top administration, Prime Minister has to decide. And therefore the reason perhaps the situation which is there in Jammu and Kashmir, what sort of developments had taken place, how the security agencies are being engaged in the search operations, the counter-terrorism operation that is going on in the valley for the last 7 days to find those terrorists who are hiding out. All of those will be briefed to Prime Minister Narendra Modi, and we can expect tomorrow at the CCS some crucial action, some more decisions that the Government of India can take to isolate Pakistan.
That's right. Let's go back to Shiv now for more. And Shiv, when we talk about a reaction from India or a response or some action against Pakistan, in the past what we have seen after the Uri attack was the surgical strikes. That's a more limited reaction just along the border, along the LOC, and then of course the Balakot action that we saw going deeper into Pakistan. So so we're waiting to see what the reaction will be this time, and other considerations as well. Countries, there's China that is standing by Pakistan. So all these things have to be taken into consideration when it's finally decided whether it's going to be a more limited attack or something that could lead to larger repercussions.
All of the meetings leading up to the meeting that we're showing on our screen right now and the CCS meeting, the Cabinet Committee on Security meeting tomorrow, have all basically engaged in weighing India's options, looking at the many different layers of action that India can take. It doesn't, sometimes it's tempting to see, even military action perhaps as just, one very sharply defined action. It could be a series of actions. It could be a coordinated action. It could be an action stretched over a period of time, not some kind of lightning strike like Uri or an aerial bombing like what happened post the Pulwama attack. All of this remains in the realm of conjecture, and I think that's precisely what the Modi government really wants. Even his words, whether it was in Bihar, whether it was in his Man Ki Baat speech, he's kept things vague, indulged in a lot of hard talk, talked about destroying terrorism forever, pursuing it to the ends of the earth. That political alignment, the instruments for that political alignment are sitting in this room right now. These are the men, with terrible power in their hands to actually execute what the Prime Minister, may choose to order, if he chooses to order it. Now, we don't know what that order is going to be. Again, we can only guess, but that's the best. That is for the best, obviously, because military matters, operational details, are not meant for discussion of this kind. But we'll have to see where and when it happens.
That's right, and we've been talking, incessantly since the morning how it's been a week and we're still looking for those terrorists, still hunting them down, and these meetings and what the reaction will be. But in one sense, it's good that there's certain calibrated responses and nothing in a hurry, well thought out, whatever it may be, because a larger picture also has to be looked at into whether if it's not a military reaction, even the diplomatic reaction, alienating Pakistan, etc. All that is on the cards, isn't it?
Very true. Like I said, India has been very, very measured in the last 6 days. Small tactical actions, diplomatic actions have been taken. Pakistan's continuous attempt to trigger India, to goad it into some kind of a counter-aggression on the line of control. I've just been reporting from LOC Baramulla where this is happening in front of our eyes. But India has held its measure. There appears to be a very strong message to the Indian army as well. Don't get drawn into a confrontation, because that's what the Pakistan army wants. They want clarity. They want, energy and focus shifted to the line of control instead of a zoomed out kind of action that the Indian government wants to take, using the ambiguity, to perhaps surprise Pakistan or lull it into thinking something else entirely. So you're absolutely right. This is not just another country. This is a nuclear neighbor. This is a country that has been unpredictable in the past. There are repercussions and issues to deal with, like China and many other criteria that will come into play should there be some large military action. But in that room right now, I think it's safe to say that all of the people who can take a decision as to what needs to be done and execute it are right there in that one frame.
That's right. Let's go back to Aishwarya. Aishwarya, we're running out of time, but quickly wrap this up for us. A series of meetings, and right now this current meeting taking place, and tomorrow will be the CCS.
Well, certainly on a daily basis, what we are witnessing is a series of meetings taking place in the national capital. There are, important directions being given by the Rai Sena ministers to their respective departments as well. And today, this afternoon, we reported from the Ministry of Home Affairs, where all the, top officials from the security agencies, be it from the CISF or the CRPF or from the Assam Rifles, the DG of Border Security Force, all arrived under the chairmanship of the Home Secretary Govind Mohan, and that particular report was later submitted to the Home Minister as well. And now it is, of course, this particular meeting, which is a high-level meeting, Prime Minister being briefed by the Defence Minister and CDS, NSA as well, and all the three service chiefs. This meeting is still underway. It's been almost 20-25 minutes, and we'll keep a close eye on this very crucial meeting happening.
That's right. Thanks so much, Shiv and Aishwarya, for joining us, and we'll continue to track that meeting. Time for a very short break.
Apollo ties. Now there's a buzz of a positive corporate development related to one of the related to its European operations of European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias. When you're talking about game-changing infrastructure, it spans something which will take decades to become reality, but will have an impact for over a century. So with those timeframes in question, let's start talking about what our core topic today is with Mr. Cyril Shroft, which is the future of the India-Middle East-Europe economic corridor, why it's important, and what we expect to see.
Thanks, Tamanna. So we have to, a topic like this, you have to place it in the geopolitical context. And as we know, watching the news every day, the geopolitics is the biggest theme just now, whichever part of the world you are in. A corridor such as this has geopolitical roots conceptually. I think it's essentially a geopolitical idea of connecting markets and connecting civilizations. I think even in the Prime Minister's letter today, he talks of really opening up a ancient route binding civilization. So that's what it is. Now, where are we today? I think today we are in a period of great disruption. If you take the last several years, few years, 3-4 years, first of all, we had COVID, which was both a disruptive force which isolated people because people couldn't travel, and at the same time it created opportunities for global cooperation. Then what we saw is 2 wars in Europe and in the Middle East. Then what we are seeing now is also with the arrival of Gen AI, we are seeing a theme that spans various jurisdictions and borders and creating its own variety of disruption as well. So if we thought 15-20 years ago that with the fall of the Berlin Wall that geopolitics was dead, it's actually right back. It's right back center stage, and a lot of decisions are based around that. Now in that context, a corridor such as this, which revives an ancient route, is a bold geopolitical idea. I think it has several advantages. I think firstly it connects 3 very strategic regions in the world. India, which is so well positioned geopolitically on various trade routes. The Middle East, with whom we have such strong cultural affinities. I mean, you go to any city in the Middle East and you feel as if you're in India. The connection, and which is, okay, sorry to bring it up, but if you look at it in comparison, say with BRI, and that's a Chinese idea, but if you go to Africa, you'll see no cultural affinity. The Africans look completely different from the Chinese. But our idea of this as IMEC, connecting cultures which are so similar in terms of their outlook, is a very natural idea. And then we go up all the way to Europe and all the way till Greece, till Piraeus as well. So it's a logical connection between these regions, and I think geopolitics will continue to be the philosophical foundation of this idea. It has future potential. As you just said, that it's a decadal idea. You're not going to see results in the next 1 or 2 years. A lot of the infrastructure will take years to build. I think the CM also, I wasn't there, but I heard, spoke about some bold projects, Vadava and then several others. These projects will take years to develop, but once they're developed, we are good for a century at least with those kind of ideas.
So you've put it very well and you've mentioned geopolitics, but I just want to dive down a bit on this because I think this is important with what's happening around us right now. From an Indian perspective, why is this a crucial idea? And you mentioned BRI briefly, the Belt and Road Initiative, as an alternative for the world and for India as well. Why is this very, very important to go ahead on the timelines mentioned?
So let's talk of there are two sides to this. There's the India side and then there is the non-India side, if I can call it that. See, India's time has come. India is on a roll from a growth perspective. I mean, our demography, our political stability, the high levels of entrepreneurship as well. We are the fastest growing major economy in the world. And we believe that we are going to get to that 50 trillion target by 2047. So firstly, there's that demand for infrastructure. There's a demand for everything as well. And most of all, there's a demand for capital. Now you look at the other side on the Middle East as well. It is flushed with capital. It is flushed with capital that is looking for opportunities to invest. There are not that many opportunities in the world which are so promising and which are culturally so compatible with what the goals are is. So you have the opportunity to invest over here and you have the funds over there. So there's a logical connection between these two regions. A region that is looking to India, looking for opportunities and scalable opportunities as well. I mean, for example, some of the projects that were spoken about this morning, where on the planet do you get opportunities of that scale? And we provide that. So I think there is to answer your question, how critical is it? I think very critical and also very logical.
We spoke briefly, you touched upon briefly upon the infrastructural opportunities here, and it's a no-brainer. There will be huge infrastructure building, but let's go into it in a bit of detail. What is the scale of infrastructure that we're seeing? And not just roads, ports, rails. What was that infrastructure do for all the areas it moves through?
So, of course, these three, I think, and given that we are not going to be connected through the land route to the region, but more likely through the sea route, I think ports will continue to be big. Because a lot of, on the India side, whether it's Mundra, Vadhavan or other western ports in the Middle East, whether it's Jabal Ali or some of the other ports, I think are going to be at the receiving end for the other end of the bargain, and all going up all the way to Piraeus in Greece. So ports is important, but in addition, to add a kind of a modern touch to infrastructure, I would add digital infrastructure to this. And I think India has done so well in terms of creating digital public infrastructure, whether it's UPI or the India Stack and all of that. And when you go to the Middle East, you can actually use some of these apps over there as well. So I think India is going to export this technology. I think that we're going to bind the two nations together as well. But as far as infrastructure, looking at the whole corridor, I think is going to be ports, then obviously the road and rail infrastructure as well, and then this intangible stuff. And to take it to another level of abstractness, I think also the legal infrastructure. A lot of these systems are going to work if there is a savvy modern infrastructure, legal infrastructure to support this. The legal system is infrastructure. It's people think it's soft infrastructure, but I think it's hard infrastructure. But without that, you can't really attract capital as well. So that's another export. I can see India playing a big role in development of the frameworks in the Middle East.
You would also need a regulatory mechanism because you are going through so many geographies. You talked about the legal infrastructure and the regulatory infrastructure, but these need to flow seamlessly across geographies, keeping in mind local considerations as well? What are the kind of mechanisms that need to be put into place?
I think the answer is part local and part, global as well, because each country will finally lay down its own standards. I think what the corridor like this or the conversations around it will do will allow us to create common standards as well. For example, say data protection. Each country which started just making its own standards, you have a problem. So I think harmonization of standards, I think, is a critical example. Or if, as we come to trade, or if you're going to come to dispute resolution. And unfortunately, what's happened in today's world is that multilateralism is kind of almost dead. But what we are seeing is the rise of bilateralism, which we will see through bilateral trade agreements, FTAs as well. India and the UAE have the CEPA, which has been very powerful as well. I think we will soon see more in the region. There is this Maha one which is being talked about with the US. I think it will trickle down into many other sub-contexts as well to lay down a global standard. And I truly believe, maybe I'm an optimist, that the Indo-US one is going to be one of the first, if not the first, major FTA that will take place, and it's going to have a profound impact on the world. What the bilateral agreements will also have is a sophisticated dispute resolution system. We are talking of multi-billion-dollar investments. When you talk of this level of investment, there will be disputes for sure. There will be big disputes. You need a framework on how they will be resolved, whether it's going to be arbitration, whether it's going to be different other types of courts-based systems which will resolve this. You need a framework for that. I think the rudimentary aspects of it are there today, but that will have to be evolved. And each of the countries involved will need local regulation for whether it's their security law framework, their foreign law, investment laws, what is going to be allowed to be repatriated, what the terms and conditions are, what are the levels of foreign ownership that will be allowed. All of those standards will have to be harmonized. And I think the trade agreements between the respective countries will provide the philosophy for it.
How can India take the lead, or perhaps also give lead the way or show the path to these kind of regulatory mechanisms that need to be put in place? Because you need to adopt the local, but you need also an overview which is amenable to all. Are we well poised to take that framework, that legal framework?
Yeah, we're not only well poised, but actually we are doing it. So I was in the UAE 2 weeks ago, and has been in a lot of the conversations involved looking towards India. So the big thing that has changed, I would say, in the last 10-15 years is that India is now a rule maker, not a rule taker. We don't just look to the West and do copy paste. Yeah, we look at the West to see and get inspiration, but we've come up with our own versions of it. Now, what's happening between us and the Middle East, and I won't go so far as to say Europe as well, but they definitely do look at what India is doing on a number of, whether it's public markets regulation, whether it's foreign investment rules. We are a source of inspiration, and because we are not bullies, I think we are able to soft sell a lot of our ideas to countries whom we deal with, including the Middle East, and I think we do a pretty good job.
A couple of important things you've said. India is no longer the rule taker. We're now the rule maker. And it helps that we're not bullies. I think you should take a moment of appreciation for a great line there from Mr. Cyril Shroff, delivered in a soft-spoken manner, which I think underlines the point as well. Let me come to the trade aspect. It seems a given, almost a no-brainer. Yes, you have this corridor, it's going to be huge for trade. But for India, I'm just going to start with the Indian perspective and then the global one. Right now, when I think trade relations has become top of mind for everyone around the world because of the era we live in, trade wars, trade negotiations, trade concessions, that's all that we're talking about right now. In that era, how important does a corridor like this become, where you will, because of the way it's made, have to take everyone along?
I think short answer is very important. as well. And I think the PM said in his letter, this is an old trade route, an old investment route, which goes back centuries, and it's a civilizational connect. You're effectively reviving it and putting fresh energy into that route, which is bound to do well. And just take some data. See, even after the India-UAE SEPA, trade has doubled. So these things do work, and with the trade disruption that is going on in the world just now, until the dust settles on that, I think these type of mini trading systems are going to be extremely important. The regional trading systems as well, which will create a framework which is insulated to some extent from the global disruption. I can see supply chains being changed. I mean, we must have seen the Apple announcement that they're going to source their phones from India, and I think you're going to see many of these examples of this where supply chains will be so. I don't know where the US-China balance will settle, but I can certainly see that India is going to be a beneficiary of that fight, whoever wins, because we do stand differently. We have not weaponized trade. I think we are the beneficiaries of the challenge that is going on. We have all the basic ingredients. We have the demography. We have the legal systems. We have the geopolitical positioning as a kind of a benign force in the world, which makes us attractive to many business and trading partners who want to deal with us. I think we are going to come out well, and I think this corridor, the IMEC corridor, is going to be important.
The opportunity for India that you spoke about, Mr. Shroff, and I have these conversations, we have at NDTV Profit, we have these conversations consistently with companies across sectors who are speaking to us in this language, that we're seeing an opportunity now. But then it comes down to the question of how. How do you make the most of it? What is the kind of push that you need?